Good morning, everybody. Good afternoon, maybe evening to those who are joining us remotely from other parts of the country. And yeah, welcome to day 3, and very happy to have everybody here. And it's been exciting, starting from Tuesday where we had the PhD papers, and it was great to see some of the presenters here yesterday from the PhD. Then yesterday we had, as you remember, the regulators mostly. And it was also very exciting seeing people who've journeyed through the questionnaire design and remembering some of the arguments we used to have when you're trying to see what questions should come in, like the CMA insisting everybody has to, this intermediary question has to be in there. And then you're finding when you go to the field, you have to explain in Swahili what that means. And then, there's so much excitement just seeing and remembering how it was. But well, today is also going to be an interesting day, and it's day 3, and I'll hand over to Amrik at some point after I've just gone through the program. We'll start with, if you have your programs, we have three main sessions. The session 1 will be around the financial inclusion journey, being fair, inclusive, and value-adding. Then the second, after the break, we'll go straight to the climate, environmental risk, and financial inclusion. The presenter has also been introduced. And then after lunch, we go to the third session, Kenya's financial sector serving women. This is about the gender bits, yeah. So we'll go into that in a few minutes. But just to let the online audience know that we are following on your questions. And if you give me about 5 minutes, I'll quickly go through the ones that we got yesterday via Zoom from 3 very keen followers. The first one is from Stephen Juguna from Faulu MFB. The question is, it would be interesting to know how provision of financial products that support better livelihoods, that is clean and renewable energy, WASH, water, sanitation, and hygiene, WASH, accelerate improvement of the welfare to the vulnerable segments. So thanks, Stephen, for the question. So what I can say here is, in 2021, we really tried to have many questions on green finance and renewable energy, but we're still trying to figure out how best to capture that. And in the next session, the second session, I think we'll hear more about that. But what is oh yeah, thanks, that's a question. So, but what we currently have in the questionnaire is, we sort of know the levels of sanitation and types of houses, and also the fuel Kenyans are using, the source of lighting and all that. And using that information, we can sort of cross-tab with the financial products. So we haven't gone so much deeper, but I'm sure as we progress with the questionnaire, we'll be able to answer some of these questions. So thanks for that question, Stephen. The next one. Yeah. How did you confirm the existence of savings? That's when we have a very elaborate question. This came, I think, after the GSMA presentation, where the source of savings for mobile money, or how they save and what they use the savings for, I think was. So we have a lot of questions around savings. You can tell where people are saving, and then we have a whole product list of different types of saving products that Kenyans can utilize. But we keep improving this when new products come into the market. And that's the beauty of the FinAccess questionnaire, and working with different stakeholders, we get to improve the questionnaire. The last question, which is combined, it came from, Otieno Luther. He asked 2 questions related. So what is the disconnect between financial inclusion and quality of life? This is quite interesting and passionate, because we had a very, I think 3 days workshop on financial health. And for us, quality of life, we would be around financial health, and then also aspects of gambling, which my colleague Chironga can speak to. But the disconnect is we have about 84% of Kenyans formally financial inclusion included. When it goes to the financial health, it's low. So there's a huge disconnect, and we have a whole presentation that Amrik will give related to that, to that question. Right, we okay on that, Chironga? Do you want to add something? Yeah, thanks. As Chirunga gets a mic, just to encourage the online community to keep on sending the questions, we'll try and get them real time so that the panelists who I'm sure will cover most of the questions we'll have will be able to also cover those as we go on. Yeah, so as Chirunga comes again.
Yeah, thank you for that question. If we reflect on the papers by the PhD students, we had 2 papers on gambling, one on financial health and gambling. What comes out is, what do you do with your money? And how will that one affect the quality of life or the impact on your well-being? So I think as part of deep dives, this area, we want to go deeper and look at how people use their money, their behavior when they get access to money, and that, of course, will define the quality of their lives. So they are very good questions, which raises even further research questions amongst us. Thank you. Yeah.
Thank you so much, Chirunga. So Capitas Chirunga is from Central Bank of Kenya, and he's part of the FinAccess team from Central Bank. And I myself, sorry for not introducing myself, I'm Lukania Makunda. I'm part of the research team at FSD Kenya, and I've been managing the FinAccess data since I joined, and I've seen a lot of transformation in terms of what's changing in the market. And because of time, maybe I won't go into all the details, but yesterday we got a chance to see how the regulators are using the FinAccess data. But I know a lot of industry players are also using it. If Kipra was here, they've also used a lot of the FinAccess data. And yesterday we didn't get a chance to hear AFC, but I know they use a lot of data, and they actually came with a product for women. And then we also have a good partner of ours, FarmAccess, who've used the FinAccess data to come up with solutions for health. So I think as we look forward to having the next session, I just want to encourage you to start thinking beyond this research conference. What next to get into products that will speak to what Kenyans can use. At this juncture, let me invite Amrik here. So Amrik here and I have been working together with the teams who have done the deep dives. And it's been a journey. We put out the call for proposals a few months ago. And we had about 20 people participating. And then now we've had the 4. We started yesterday. And we'll have Amrik talk about the next 2. And they're topics that make sense to what we're battling as Kenyans. And I'm sure we'll have an interesting discussion. Thank you.
Thanks so much, Lukanya. As Lukanya says, we've sort of been partners in crime in trying to really develop these deep dive studies to deepen our understanding of the FinAccess survey. And this was really part of an effort to mine the data in a way that hasn't really previously been done, and connecting it to policy. So our effort here was to go deeply into the survey data and see how we could make it more relevant for policymakers. Now, our first session this morning is on the core financial inclusion journey. Other sessions, other panels that we've had have really dealt with the impact of finance in the real economy. So yesterday we had a session on finance and economic opportunities. Today we also have sessions on finance and climate risk, finance and gender. But this session really gets us to tackle what impacts has Kenya's financial inclusion journey had in terms of inclusivity, fair and responsible finance, and financial health. So it It's looking at the journey itself and its impact on Kenyans' financial lives. We're going to have 3 papers this morning. The first is by Mariangela Pensa, who is here for joining us from Zurich. Well, Italy, but her firm is based in Zurich. She has a consulting firm, Pensa, that does a lot of work on sort of social and financial inclusion, sustainable financial inclusion, and impact investing. And she's worked closely with a team of colleagues. So we have also with us Lynette Orissa, Moses Muzija, who is not able to be with us, but was with us on the first day on Monday, and Davide Castigliani, who will join us he will join us virtually from Italy, from the University of Bergamo. And they will be presenting on a paper on measuring Kenya's financial inclusion journey, which really looks at how inclusive that journey has been. The second paper is by Christine Hurad. Have I got that right, Christine? I've been practicing that name. Who is a technical director at CENFRE, the Center for Financial Inclusion and Regulation, based in Cape Town. And she is going to be presenting a paper on, the CENFRE have developed a new and rather experimental and interesting tool to measure fair consumer outcomes. So really looking at the extent to which Kenya's financial sector has been sort of fair and responsible for users. And then the last paper was a sort of a paper that we commissioned at FSD. It's by Paul Gubbins and myself, and I'll be presenting on our behalf. It's on the state of financial health in Kenya, and I'm really focusing in this paper on the drivers and implications of financial health, or what's driving financial health really, rather than the index itself, because we covered that in great detail in a recent workshop in Naivasha. So those are the 3 papers for this session, and I'd like to start, please, with Mariangela. Lynette, do you want to come and sit? No? You both wrote it, you could sit there. It's up to you.
Good morning, everyone. Thank you, Amrik, for the introduction. It's a great pleasure to be here and to be able to share the results of our project. It's been a really interesting journey with our team and with Amrik and Lucania throughout these few months to deep dive into the Finaxis data. So we are glad that we are able this morning to share some of the results of our research. So the objective of our research was to create a toolkit that would allow to measure financial inclusion over a long period of time, with the idea of being able to track and measure Kenya's financial inclusion journey. And in terms of financial inclusion definition, we set from the start a higher bar, whereby we did not simply consider a binary measure of included, excluded by looking at whether an individual has or an account, but rather at whether this individual has access to a full set of services such as credit, savings, and insurance and pension. We created, sorry. Sorry, small technical problem. So as I was saying, so we, in terms of financial inclusion definition, we set a higher bar, not to look at simply a binary measure of included, excluded, by looking whether an individual own or not an account, but we considered a full measure of access to a full range of financial services, such as credit, savings, insurance, and pension. We then created a series of indicators to measure how much individuals are included based on the set of products they have access to and understood as usage. And to simplify, although we'll take a look a bit more in detail at the indicators in the following slides, in our indicator, if an individual uses a broad range of financial products, she obtains a high score, while if the same individual has a small range of products, she will obtain a lower score. We then categorized products between formal and informal and created two sets of indicators. One that measures the usage of financial services regardless of whether they are formal or informal, and another that considers the formality dimension within an individual's product portfolio, giving then a higher score for the usage of formal financial products. And in addition, in order to better understand financial inclusion in Kenya, we wanted to look at different segments of the population to understand which ones have benefited more throughout the financial inclusion journey. And we considered different population characteristics. So we look at gender, age, residence, as in rural versus urban, education levels, sources of income, and location, for which we used the previous Kenyan provincial categorization, because we wanted to be able to track this over time, and based on the data, this is the information that was available over such a time span. And finally, the idea is also to be able to use these indicators and test them when we want to analyze the impact of certain events, for example, shocks such as the impact of the COVID pandemic, as well as the introduction of innovation as for example, mobile money. In the following slide, we will provide a taste of some of the results that we have obtained using our indicators. But the main idea that we want to put forward is that we wanted to create a flexible tool that allows to measure different aspects of financial inclusion over a long period of time, considering a more meaningful definition of inclusion that looks at access of a full financial of a range of financial services. So in this first slide, we will look at both our formal and informal indicators to measure the percentage of the population that is relatively excluded when we consider access to a full range of financial products. So the first indicator, it's the formal indicator, where we have set the score between 0 and 26, depending on how many products are used. And we have set a threshold at 13, which is the score that an individual obtains if she has one formal account and two other formal products, like a loan from a formal financial institution or a saving product. We decided to set the threshold at 13 because we have seen from the data set that a large part of the population was around this score. So from the graph, we can see that based on this logic, we are, and based on this more meaningful measure of financial inclusion, a large part of the population can be considered still partially or relatively excluded because they don't have access to a full range of financial services. We do, however, see also a declining trend of this indicator between 2006 and 2021. If we now take away the formality and look at products irrespective of this dimension, so we can consider, for example, an individual who is a CHAMA member and will have an account and likely also credit and savings, we see that we obtain a similar pattern and trend. So following a similar logic as for the formal indicator, we set, for the neutral indicator, we assign a score between 0 and 9 with a threshold at 5 for individuals who have 3 products. So the threshold at 5 is again because we saw from the data that's where a large part of the population was. So the same way as for the formal indicator, we see that a large part of the population remains partially excluded. And when we look at the two indicators together, we can really appreciate the similar pattern and trend over time. We then move on to look at 2 other indicators that we have created. The first one is a simple count indicator, whereby we simply consider the number of products used. And when we consider a score of 0, we see that based on our calculation in 2021, 13% of the population still has no product whatsoever. The second indicator is a little bit more complex and is an attempt to measure how inclusive or exclusive a product is. It can be, in a way, considered as a proxy to measure equity, and in the sense that we look at whether an individual is relatively more excluded if she's not using a product which is widely used by other individual within the same population characteristic. And so here, perhaps we can use an example to explain these indicators, moving away from financial. Sorry, yeah, you're right. Yeah. So yeah, move away a bit from the financial product example to explain this indicator a little bit better. So if I own a luxury car, which is considered to be an exclusive product, by this indicator, I will obtain a high score. However, if I do not own a luxury car, I will not be strongly penalized because by definition, a luxury car is owned by only a few individuals. However, if we look at a different type of product, like a small car, which is owned by a large part of the population, I obtain a low score compared to the individual who has a luxury car. But if I don't own it, I get strongly penalized because I'm not using a service that a large part of the population is using. So by this indicator, we show that exclusion has decreased over time, but between 2013 and 21, only by 9%, showing that our equity proxy only marginally improved. We then moved on to look at the aggregate effect of a cross-hole wave, calculating an average over the entire data set. And in this slide, we show the average gap in the score for different population characteristics. So, for example, if we look at the gender population characteristic, we see that the score for women is on average 7% lower than the score for men when we look at the neutral indicator. However, if we consider the formality-sensitive indicator, the gap is much larger at 15%, indicating that there is a substantial difference in the use of formal financial services between men and women. In a similar way, when we look at residents, we see that rural dwellers are in general more excluded relative to urban dwellers. And the similar thing for youth that generally score less than adults. And finally, if we look at education as a characteristic, the uneducated population score considerably less compared to the population with tertiary education, with this gap decreasing as the level of education increases. This large gap, which we will see also in other results, seems to indicate that education is a strong determinant of financial exclusion rather. We then looked at the change between 2006 and 2021 in terms of catching up and filling the gap. And we can see from this slide that some categories have been catching up while others still lag behind. So this result shows that, for example, always in the case of the gender characteristic, the neutral indicator for women increased by 14% more compared to the indicator for men. And so this higher indicator indicates that women have been catching up to men in terms of financial inclusion. So we see a definite improvement for female for the neutral indicator. However, when we look at the formal indicator, we see also catching up, but at a much lower pace. So in the same way, we can see that other categories like rural dwellers, the score grew, for example, 21% less compared to urban dwellers. And here we indicate, this indicates that urban dwellers still lag behind compared to their urban counterpart. And similarly, we see a similar trend for the education characteristic. And for youth, we see some sort of gap remaining, but reducing, particularly in the use of formal financial services. So we then did the same exercise by looking at the main source of income. And here, our calculation is done using aid assistance as a basis for all other categories, so to also make them comparable. And in terms of the gap, the data indicates that government employees tend to score higher than all the other categories, while when we consider change through time, business owners show the strongest improvement. And again, we did the same analysis across regions, and we observed, particularly looking at the evolution through time. So sorry, here the base is against Nairobi. So we see that Nyanza and Western regions still lag behind with a significant gap, while Northeastern and Coast have been catching up over time. Then at this point I will hand over to my colleague Davide, who is online, and we will continue with the presentation of some additional results. Thank you.
Okay, good morning to everyone. Can you please show the presentation again? Because I don't see it. Okay, thank you very much. So, good morning again. So here what we have been trying to do is to analyze each population characteristic by holding the other population characteristics constant. And what we notice is that there are still some characteristics that play a major role. For example, age is very important, so the youth versus adult in terms of financial inclusion, as well as education is still a very important characteristic. So uneducated and individuals with primary education versus individuals with tertiary educations are much less financially included. The same if we compare individuals who depends on aid assistance or individuals who are employed in the private sector compared to government employees. So we see again the main results also here when we compare all the characteristics together. What we notice or what we can see is that when we control for all characteristics, including, for example, the province of residence or also the wave, we see that the financial exclusion of, for example, females is very limited. So it means that education, age, and being, for example, employed in the public sector are much more important than other characteristics. Okay, let's move to the next one, please. Thank you very much. Here, the model that we saw before was, the base for most of the other analysis that we did. For example, here, what you see here is a comparison between the financial inclusion of individuals in 2019 versus 2021. Here, we wanted to look at the impact of pandemic, and so how the indicators changed during 2021. And again, what we notice is that junior youth and uneducated individuals were the most impacted by the pandemic, while, for example, the rural population of women, their change was not different from urban population or the male population. So it means that they were not affected by the pandemic. So, and we also noticed that there was an impact especially in the access to formal financial service, a negative impact for government employees, but we have not been able to find a proper explanation so far of why they were so impacted by the pandemic. Please, next one. Thank you. Then what we did was to also look, we used the Bayes regression analysis to look who were the main adopters of mobile money in 2013, and then to look at the performance of mobile money adopters in the following years. Okay, so what we notice is that there are, again, here three characteristics that play a major role in explaining the probability of adopting mobile mobile money. The adults versus junior youth. Okay, again, so individuals with tertiary education versus individuals that are uneducated or with a lower level of education, and then government employees. So what you see is that there are still three characteristics, major characteristics, that also explain the probability of adopting mobile money. We also notice that if we control for all other characteristics, so we hold all other characteristics constant, we can also notice that in the case of females, with respect to men, there is a small higher probability of adopting mobile money. But that's, we notice that only when we control for all other characteristics. While in the case of the rural population, they were less adopters of mobile money in 2013 with respect to the urban dwellers. So you see here also the same dynamics that we have been seeing so far. So next one, please. And then finally, what we did, okay, that was the main characteristic that explained the adoption of mobile money in 2013. And then we wanted to look at how mobile money adopters perform in the next waves. And so what we noticed is that the adoption of mobile money has been a very important driver of financial inclusion in Kenya. And you can see how the mobile money adopters, they have been performing at a much higher level of financial inclusion for all types of financial inclusion indicators. They also were less affected by the pandemic, as you can see, while in the case of the no users of mobile money, they were affected by the pandemic. So they saw their financial inclusion to diminish during the pandemic. So these suggest that the digital revolution has made a major impact in the financial inclusion in Kenya, but has also created, a gap between adopters, users, and non-users of mobile money. So yeah, that's the main message here. Okay, thank you very much.
Okay, thank you, Davide. So yeah, as just to conclude, as Davide was saying, we have seen that financial inclusion clearly made a huge impact in terms of improving financial inclusion, although for those who remain excluded, it may be a divide that can increase exclusion and inequality, and which may have strong implications for the participation of these segments that are excluded in the wider economy. So it stresses really the importance of reaching that last mile of the population. And in addition, as a general conclusion, we can say that by looking at this broader measure of financial inclusion as the usage of a broader range of financial services, there remains a large part of the population which is partially excluded. So that still a lot of work needs to be done. Sorry, just saw myself there. So yeah, sorry. So it's indicating that there is still a long way to go to improve financial inclusion using this broader measure. So thank you very much for your attention, and I hope you enjoyed the presentation. Thanks.
Lynette and Moses, that was a real sort of tour de force. It was a fantastic piece of work. And now I'd like to introduce Christine, who will give our next presentation on fair consumer outcomes.
Thanks, Amrik. Morning, everybody. I'll say good morning so long while we're being set up. Habari za asubuhi. Why is it not displaying here? There we go. Okay, I think we're all set up without any glitches. So as Amrik said, I'm here to talk to you a little bit this morning about the insights that the FinAccess survey can render on what I always see as a very tricky balancing act that regulators throughout the developing world globally indeed need to balance, need to find. And that is that on the one hand, you want to promote financial inclusion, you want to promote innovation and all the benefits that come with that. On the other hand, and especially as risks increase in the light of digital financial services, as consumer vulnerabilities continue, on the other hand, you want to make sure that there's adequate consumer protection in your market. So it's always sort of finding this fine balance. If you have to strike that balancing act, it's useful not only to look at measures of financial inclusion, as we saw now, that tracks how many people are excluded, or what are the features of the excluded. You also want to know a little bit beyond just whether they are excluded, whether they're included, whether they use financial services. You want to know, are they actually getting value from what they're using? You want to understand the quality of the usage of financial services that you see in your country. You want to understand how protected and how empowered are consumers in practice. And that's basically what we set out to do through this deep dive. So we embarked on a journey to establish a proof of concept for a financial consumer protection outcomes index, which is a bit of a mouthful. I'll call it the FCPOI from here on. So a financial consumer protection outcomes index that can track the overall effectiveness of financial consumer protection across the financial sector. And this is very important from the consumer point of view, because that is what makes FinAccess such a marvelous tool. Now, just to give you a little bit of context, when I talk about financial consumer protection, it's really a very multifaceted concept, and there are numerous principles and components and elements of financial consumer protection globally. You need responsible market conduct, you need fair pricing, you need disclosure, adequate disclosure, you need financial education, you need effective recourse channels. More broadly, you want to build a financial sector that instills confidence and trust in consumers. So you need to protect consumers' assets, prudential regulation. You need a competitive financial sector, so you need competition. You need data protection. You need cybersecurity to be in place. And you need a comprehensive regulatory framework that encompasses all these elements and sets up appropriate oversight bodies across all areas of the financial sector. So financial consumer protection is not something simple. It's a big task. And what I've put on the slide for you is just to give you a sense of, in Kenya, all the different pieces of legislation flowing right down from the constitution into the sector level and at a cross-cutting level across numerous different regulatory authorities, all contributing to this concept of financial consumer protection. Now, how do you measure it? Traditionally, if you're looking at financial consumer protection, each regulator would require their regulated institutions to report to them, and they would do their on-site and off-site supervision. And then you would be looking at things like, are you complying? Do you have the right policies and procedures in place? So it's sort of compliance output measures that would traditionally be tracked. You could also ask institutions to report on things like number of complaints and whether they had the complaints resolved. So then you're trying to proxy indicators of consumer satisfaction through the data that you get from the financial sector. However, if we say that we want to try and measure financial consumer protection outcomes from the consumer perspective, which we set out to do with this index, then you need to think about what are the indicators or the proxies that you can use that is framed from the perspective of the consumers. And that was the point of departure for our compilation of this Financial Consumer Protection Outcomes Index. So the framework that we used, we found it useful to start off with the set of 6 fair consumer outcomes. So that's the FCO, the blue blocks that you see there. And that framework was developed by CGAP in line with the global treating customers fairly principle. So what it basically says is if you have a financial sector that treats its customers fairly, what would be the outcomes as they transpire, as they manifest in the lives of consumers themselves? Now they defined 6 such outcomes. First is suitability. That basically means that the products that are available on the market must be suitable to my needs as an individual on the ground. It must be appropriate to my context, where I live, my features, my household. Secondly, there's choice. When I'm in the position where I have to take up a financial service, do I have an appropriate menu of options available to me? Can I actually exercise an effective choice that aligns with my realities and needs? The third one is safety and security. I think that's very front of mind for everybody. So is my money safe? Can I know that it is safe? Can I trust? And do I have control over my personal data and how that gets shared? The fourth one is fairness and respect. That means when I engage with a bank or an insurer or a SACCO, am I treated with respect? Do I feel intimidated? Do the staff give me due respect? And does that continue throughout my user journey? Then, voice. Am I able to communicate with my financial service provider? Do I have accessible channels to communicate with them? Am I able to raise queries and have it resolved? Am I able to raise issues and have it resolved? And then finally, meets purpose. Is my usage of financial services actually allowing me to take control over my financial life? Is it allowing me to better cope with shocks, with resilience? Is it allowing me to save or to attain or reach life goals? So is it meeting the purpose that it should for me as an individual? So those are fair consumer outcomes from the customer's perspective. To this, we then added 3 further components or elements to the index. Disclosure, or from the customer perspective, that would be access to information. That could be covered in those other outcomes as well, but for the purpose of this index, we decided to separate it out because it's a clear element of financial market conduct that manifests or lands at the consumer level. So we thought it would be interesting to also measure it separately. The same for financial education. Do I have the knowledge? Do I know concepts like interest? Do I understand charges, etc.? And am I actually equipped through the skills to act responsibly in the way that I engage with my financial services? And then finally, recourse, which we decided to split out from voice so that voice deals with queries and communication channels, and recourse says, if I have a complaint, can I have it resolved from the consumer perspective? So basically what the index does is just to try and measure as best possible from FinAccess each of these 9 components, and to then average the scores across to express it as an index value that can then be tracked over time, more or less to hold up the mirror to the financial sector to say, is it really doing what it said or fulfilling its promise in terms of fair consumer outcomes? Now, just very briefly in terms of the methodology, it was done over 3 levels. So if you read from the bottom up, firstly, we combed through the FinAccess survey to think through what would be the relevant sub-indicators from the survey that can speak to each of those 9 components. And these were then always expressed as a positive score. I'll explain to you now. Positive score just means that if you ask something in the negative, like if the survey asked, did you lose money? You would invert it to say, now I'm looking at the percentage of people who did not say that they lost money, so that all scores are expressed in the positive and they can be added up, like for like. Just to give you a sense, I can't go into the details now, unfortunately, of the types of questions that were then covered in different types of indicators. So under suitability, we would look at whether people say, oh, I don't use it because the price or the functionality doesn't work for me, so it means that the features aren't really in line, or there were too many charges, it was too expensive, or minimum balance, or the requirement for a regular income. So it just means that the features are not in line with my needs. And we would track that across different, like if you're a mobile money customer, if you're a SACCO customer, MFI or bank. For fairness and respect, for example, we would look, there was questions in FinAccess on did you receive poor service? Maybe if you engage with a digital lending app, was there harassment? Did you not feel that they treated you fairly in the process? Disclosure, for example, where do you get your information? Who do you depend on? Were you surprised that there were hidden charges or fees that you didn't know of? So those are all sort of sub-indicators that can tell you a little bit about the outcomes that people experience relative to this indicator. And then just the last example, safety and security, would be something like, did you lose money because of fraud or cybercrime, especially on mobile money, but also across different other financial services. Okay, so that's where you start. You define the sub-indicators. Then out of the sub-indicators, you then compile a single weighted average score for each of the 9 principles. And I think it's just important to mention the weights. So weights just mean that we take into account how prevalent the underlying financial services is in the population. So if we ask both SACCO clients and mobile money clients whether they lost money, mobile money clients will get a larger weight relative to the fact that more people in the population have mobile money than belong to SACCOs, just as an example. And then out of that, you would then calculate the overall index as a single index measure. Index just means that it's stated relative to 100 in percentages, so that you can track progress over time. And then also importantly, differences between groups are then standardized as a gap relative to the total population score. So if the total population scored 20% and this group scored 11%, then if you state it relative to the total population as 100, then the group would have an index score of 55, and you could standardize the differences between groups. Okay. I hope that gives you a sense of the methodology, and I hope I do have enough time to now do the findings justice, because I think it's very interesting. I just need to state a disclaimer, because this is a statistics conference, that we are putting this forth as a proof of concept to be refined further over time. And it's not the be-all and end-all to say, oh, this is the score on financial consumer protection in Kenya. It's a measurement input as a contribution to the dialogue on meaningful financial inclusion in Kenya. Right, so if we add up whatever we could from the survey across all those sub-indicators, we get to an overall baseline score of 67%. And I must say, intuitively, when I look at that and I see 67, I think, well done. Obviously, there's a comprehensive framework, and obviously the financial sector is coming to the party, and it is transpiring in the way that consumers answer relevant questions in the survey. Just looking at the overall is not that interesting, however. It's much more interesting to see what are the difference between the different components that we measured. Now here I must just make another disclaimer, and that is that the magnitude or the level of a specific indicator or component is very much dependent on the specific questions asked in that indicator and the incidences that we found for that. So for example, if choice just asks you whether you didn't have any other choice when you took up that service, it's not sort of that meaningful to say, oh, choice is 93% and something else is lower. So it's much more meaningful to compare progress in choice over time than it is to compare the score for choice to the score for fairness and respect, if that makes sense. Nevertheless, where an indicator is quite low, it does show that that is where there's most room for improvement in future based on what is measured in that indicator. So I hope that makes sense. So with that in mind, it's very interesting to see meets purpose. And I think this would link to what Amrique will discuss later on financial health, is the lowest, voice, the people's ability to effectively communicate and feel that they will be heard with their financial service providers, and suitability, the functionality and the features of the products in line with the customer's realities. Now, progress over time. The FinAccess survey changed in 2019, so we can't really consistently track these indicators before 2019. And actually, the changes made then is what enables us to track a lot of these outcomes. There is small differences between the 2019 and 2021 survey. That means it's not 100% like for like. But if you take this as indicative, it is still very meaningful just to see that, you know what, actually there's been a slight increase in the index score from 2019 to 2021. And then again to see sort of where exactly in the different components did you see most increase, and meaningfully, which was the only one that dropped, which was meets purpose, and that dropped by 21%. Interestingly, we see financial education, for example, jumping quite significantly. And here it's interesting to dig a little bit deeper to understand what lies behind this 20% increase that we see. We see that this is largely driven by people's understanding of theoretical concepts, so being able, or saying that they understand what interest is, saying that they understand the charges, etc., and not by the other sub-indicators that looked at things like, do small businesses budget, or do you keep records, or do you as a household actually budget. So it's an increase driven by, let's say, theoretical awareness or knowledge rather than necessarily practical application. So again, just as we dig deeper into this, it's very important to always remember the context within which the questions were asked for these components. Okay, now what is also very interesting just to look at is how does the index compare across different groups? Maria Angela's presentation mentioned how the uneducated and women and rural people are still at a disadvantage in financial inclusion. And it's interesting just to see that also playing through in measures of financial consumer protection outcomes. So firstly, if we look at gender, and remember, as I explained earlier, this shows the relative gap between different population groups. So don't look at it at the absolute values in the scale, look at the gaps that we see in the spidergram. So overall, there's a 6% index gap between men and women. So women are at a relative disadvantage, and it's interesting to see where they're experiencing the greatest disadvantage, namely in disclosure, financial education to some extent, meets purpose, and voice. Women, we also did some qualitative focus groups where it was very clear women feel intimidated by the M-Pesa agents or the banking agents. Males, sometimes, they feel harassed and intimidated by, and you're seeing that in their ability to exercise their voice. We also see a difference when we look at livelihood types, where the orange is those that are in formal employment, and the light green, those that are self-employed, and the rest would be more casual and farming, and dependents being those who receive remittances or gifts or are dependent on state. And it's very interesting, again, to see those biggest gaps. Where do they lie? Disclosure, so the access that people have to information, where they turn to for the information, whether they're able to borrow or save to mitigate a shock or to achieve a life goal, whether they're able to effectively communicate. Those in formal employment still do have, I think as expected, a definite advantage. As also expected, this picture then looks relatively similar by income level, because formal employment would be suggesting that you have a higher and a more regular income in many instances. So financial education, disclosure, meets purpose, voice, for all of them, having a higher income really does matter. So for me, it says that even though I said at the start that financial consumer protection is so multifaceted and a complex concept, it's even more complex because it's not only about financial sector policy, it's also about economic policy and improving livelihoods, and the two go hand in hand. When we look at age differences, it's also very interesting. This becomes a little bit busy, but I'm going to just try and help you navigate this. If you look at the blue ones, dark blue is the youngest and light blue the oldest. And you see the oldest, they lag behind in financial education, and for them this was mostly due to not knowing, not understanding the terms. So it shows an education sort of lag that needs to be made up, that older people still feel. They are much less likely to feel that they can communicate and have a voice and have their queries resolved. And also in terms of disclosure and access to information, they lag behind. What is interesting for the youth is that, so the dark blue, is that they score very highly on suitability. And that was basically when they were asked, do you not have something because it's, you know, not the right features for you? They just didn't say that that was an issue, so it didn't come up as an issue. But where the youth do lag behind is under meets purpose. So especially for being able to use insurance or a loan to help them reach life goals, they don't feel that they're in a position to do that. So I just thought that that was very interesting. And then also when we look at location, so again it confirms the picture that we started to see from the first presentation. There is a substantial urban-rural gap. I think the relative gap is 12% on the index overall. And this just shows up the challenges that the financial sector still faces in effectively serving the rural target market. And again, it's just very interesting to see that where do you see these big differences lie? Financial education, disclosure, meets purpose, and then suitability and voice to a lesser extent. I'm nearing the end. You don't need to worry about the details of the slide. Just what I want to try and convey here is, as you would have seen in those spidergrams, in a lot of instances, there's not much variation across the groups. That would be for choice, safety and security, and interestingly enough, fairness and respect. So there's not much variation across groups within those indicators. Where you see more variation, be it positive or negative, would be on mostly meets purpose, and then your disclosure, financial education, suitability indicators. So that just tells us, if you're wanting to dig a little bit deeper, understand more what lies behind this, understand what can be done from a policy and market perspective, maybe look at those and just understand them a little bit better. Finally then, the implications. So I do think that overall this index tells us, even if it's still indicative, that the financial sector is delivering on the promise of fair, financial consumer protection, and it confirms the significant progress in financial inclusion in Kenya to date. So it in no way negates that. But the underlying nuances that we saw across the indicators and across population groups do show us some remaining pain points. As I said, suitability, voice, meet purpose, those are particular concerns, especially for more vulnerable consumer segments. So understanding where the vulnerabilities lie, I think, is a huge part of the value that this index tries to bring to the table. And then obviously, if you want to further increase this score across all the components, it would require a concerted effort. It's not just a regulatory matter, it's not just a market matter. It requires a concerted effort. And what we try to achieve with this index is just to add to the dialogue by offering a stylized way that you can track progress over time, in addition to what you're doing to monitor market conduct, but from the consumer perspective. And we're also putting this forth as a proof of concept so that in future we can refine it further, find maybe a smaller set of proxies that are most likely to predict financial consumer protection outcomes for Kenya. Thank you.
Thank you very much, Christine. That was fantastic. It's very nice to see the flow of these presentations. Mariangela and Lynette there took us through the inclusivity of Kenya's financial inclusion journey and where we're still seeing gaps with respect to inclusion and exclusion. And then Christine's work. Oh, you've got it. Actually, no, let me use my laptop and make some changes. And then Christine's work sort of really takes us into some of the detail of what may or may not be driving that. So we're seeing quite strong outcomes in terms of the sort of the supply side and how the market is actually delivering to consumers. But we're also seeing there's some big gaps on things like meeting purpose, the extent to which the financial sector is able to meet consumer needs. And in fact, that's a very nice segue into this short presentation. Sorry, let me just get it to the beginning. that I will now give very briefly, just to round us off here before we go into the panel discussion. I just want to give us a brief taste of some of the work that we've been doing on financial health, because in a sense, what we've seen, we still have deeper levels of exclusion with respect to access to a meaningful range of products. We're seeing that finance may not necessarily be meeting the needs and purpose for which it was designed for consumers. And perhaps that might partly explain the result that we're seeing as well with Kenya's declining financial health. So this is a paper, this is a sort of just a taster, as I said, really, of a paper that Paul and I have written just to try and use the data to dig into what might be driving declining financial health measures. We're seeing rising levels of financial inclusion, but as you can see from the pink bars there, we're seeing more people struggling with lower financial health, and correspondingly the green shows that there's also a decline in people with high financial health across the population. So we've only, our analysis shows that only 15% of Kenyans, by our metric, can be considered to be financially healthy in 2021, whereas in 2016 it was 40%. And that's in parallel with the continuing growth in terms of access to financial products, financial inclusion. So we wanted to dig into what could be explaining that. And I think Christine sort of alluded to that in her talk just now by saying, actually this relates not just to the financial sector, it also relates deeply to the wider economy. So in terms of people's financial health, it's partly dependent on their liquidity, on their purchasing power, on the sort of budgetary capabilities that they've got. And we've really seen that these household budgets have been put under huge pressure between 2016 and 2021. One of the things that we've seen is rising inflation, which has put pressure on expenditures, particularly basic foods and services. I'm going to run through this quite quickly because I want to get to the panel discussion, but you can also read the paper on our website. We've also found that median incomes have either fallen or stagnated. And, oh, goodness, we can't see the bottom of the screen. Oh, it's okay, I think the legend is up there. So we can see that that's true across all wealth groups. We've seen declines for the poorest, poorest 20% of the population, poorest 40%, middle 40%, and the richest 20% of the population. Interestingly enough, the steepest declines have come within the richest segment of the population. That is our top 20%. And that really drives outcomes for the rest of the population, because as we know, many of our wealthier Kenyans actually support lower income Kenyans through remittances and social networks. So that has big reverberations and implications across the population. Part of the reason for this is possibly sort of the decline in the quality of jobs that we saw from the presentation yesterday. Again, Paul does these wonderful, slightly complex charts, but you can see the sort of squeeze in the dark blue and purple at the top. This is really the share of the population earning income from employment and business, which is actually reduced as a sort of a share of the total population. And correspondingly, the yellow at the bottom shows the increasing percentage of the population that are dependent on transfers, often coming from those top bands actually at the top. And then correspondingly, as Bobby and Jess discussed yesterday, we've had a huge increase in dependence on casual labor during this time period. So apart from the quality of jobs and economic opportunity reducing and possibly driving the squeeze on household incomes and budgets, we've also seen a sort of a shift in our demographic pattern, our demography. Increasing numbers of youth of secondary school age particularly, which is also, and sort of an increasing burden of care for households, so somehow an increasing sort of ratio of dependence to income earners. So we've got income earners having to support people within their household and their wider network, who are both older and younger. And particularly with the premium on secondary education and this fantastic expansion that we've seen in secondary education, there's also a lot of pressure on household budgets to pay for secondary school in particular. In addition, this slide shows the proportion of the population who are receiving remittances over this time period. And we see during the pandemic, between 2019 and 2021, there was a huge increase in the percentage of youth who were dependent on social transfers. We've seen a similar increase in those of what we call retirement age over 55, 65, although I'm certainly not intending to retire at 65, but anyway. But, you know, our elderly population. But what's so interesting about that, and I think it came out in one of Mariangela's slides where we saw that those who are retired actually fared the best during the pandemic. We see that, you know, there's an increasing access to government social pensions for the retired population. And I think this really underlines a sort of a pet you know, project of mine, really, which is to make the case for the fact that social transfers are so important to supporting the conditions, not only for well-being, but also for growth. And we've really seen the impact of that somewhat on the elderly population with the older person's cash transfer. Now, what have been the implications of this scenario for finance? So here, for one of our metrics, actually, which relates to the last chart, is showing that, you know, the increasing proportion of savings and credit which are being used for education purposes. So we've seen a big uptick in that between 2016 and 2021 across the population. Actually, the steepest uptick in payments for education or investments in education through finance has been for the poorest, interestingly enough. The poor have a huge premium on education, we often find. We've also seen that in this context of sort of reducing liquidity and the squeeze on household budgets, we've seen that finance for short-term needs and emergencies has become the predominant use case for savings and loans, rather than finance for investment. So finance for emergencies is the red line, the investment finance is the pink line. Interestingly, for the wealthiest, although they still have the highest level of use of savings and credit for investment, we've seen that their use of savings and credit for emergencies has actually bypassed that. So that really shows the pressure on those wealthier groups. This shows that the kinds of financial services that have been used really over the past, since 2016. We've seen a big uptick in saving with a mobile money account and a sort of corresponding decline in people who are saving informally and through a bank or a non-bank financial institution like a SACCO. We've also seen a big uptick in the use of formal digital loans, mobile money overdrafts being one of them, and also in social network finance and loans from shopkeepers, family and friends. So that's what the sort of changing pattern of the usage of different financial services is somehow quite closely related to these patterns that we're seeing with respect to financial health. Both are obviously influencing each other, but you know, declining levels of financial health are leading people to sort of turn more to digital offers, which have fairly low barrier to entry, and social and informal finance. So I just wanted to just have a few sort of concluding thoughts here, but really this is questions. I think it's really the audience to help me make sense of all this. But you know, in terms of thinking about, well, how can we turn the situation around? How much power does the financial sector have, particularly through financial inclusion, really, to turn around the situation that we're seeing with regard to financial health? I think that's really quite a valid question. I mean, financiers might argue that, look, with all these declining trends across the economy, declining opportunities, you know, rising pressure from inflation and so forth, there's not much wiggle room for the financial sector to be able to offer meaningful products and services that can actually improve people's well-being and incomes and opportunities. However, you know, we've certainly seen in some of our analytics, we did a paper in 2019 which showed a strong correlation between financial health and, for example, savings behavior, and yet we're seeing a big uptick in the use of credit formal credit, mainly for consumption. So how can we encourage more savings? How can we sort of encourage this saving behavior which has been shown to support financial health outcomes? Similarly, you know, how can we develop solutions which are more tailored to livelihoods and which can stimulate growth and investment even within these difficult conditions that we've got? And that kind of leads me to the next one. I think there's a lot of opportunities in the information universe. I mean, the digital universe is able to capture incredibly granular information on a very sort of rich range of segments. So even within businesses, for example, if you're a metal worker on the one hand versus a hairdressing saloon on the other hand, I mean, you have very, very different business dynamics, and you're subject to very different forms of seasonality. Having the data available through these digital trails on the sort of liquidity flows of those different segments could actually help the financial sector to really create tailored products which would enable them to bridge their liquidity needs and actually perhaps support growth. So there's still a lot of wiggle room, I would argue, for the financial sector to do a much, well, I would say better job, really, of supporting growth as well as resilience for lower-income households. But we also need to accept that, you know, finance is impacted by a much broader range of factors within the economy and not just by financial inclusion. And here again, financial sector has a very important role to play as a key driver of the economy at macro, meso, and micro levels. So how can we get those macro flows to be sort of really driving inclusive growth? What can we do at the meso level, working with firms and businesses and at that kind of middle layer of the economy to stimulate growth that can actually create jobs? We had a long discussion on that yesterday in the Economic Opportunity Panel. And that really does point to the role of finance, I think, at all these levels in catalyzing inclusive growth. So I just want to leave it there and hand over to Francis Guer, my colleague from FSD, who's going to be moderating our very distinguished panel today. And we will hopefully be able to discuss some of the issues that have come up in the papers. Francis, over to you, and please could the panelists also, for the first panel, come to the stage. Eva, Rob, Andrew, I'm not quite sure if I've got all the panelists' names right in my head. And then we have Adano, Dr. Adano. Thank you very much. Over to you.
Thank you, Amrik. As stated by Amrik, my name is Francis Guer. I work at FSD Kenya as a financial sector policy specialist. And it is my extreme honor to moderate the first panel for today. And we are privileged to have with us a stellar cast of individuals, both from public, private, and international organizations who in their own ways contribute and work towards the topic of our discussion today morning. So before we dive straight into the substance of the panel, I'll request my panelists to introduce themselves, state their name, the institutions that they represent, and their roles within the institutions. Thank you.
Good morning, everyone. My name is Eva Mwasho from the Communications Authority of Kenya. I'm a senior analyst, and I work in the Competition Management Department.
Good morning. My name is Rob Burnett. I work with a youth-facing media business called Shujaz Inc. We work with young people across Kenya and Tanzania. We make media that reaches them and helps them to think about the future in different ways. And then we run very thorough research activities to try and understand what's happening among young people in East Africa. Thank you.
Morning, my name is Andrew Young. Work at Safaricom, specifically at M-Pesa. My role is I'm a lead for commercial management within M-Pesa, just looking at how do we drive more value for customers and also be able to have more insight-led decisions that can get better customer outcomes as we engage with pretty much the population of Kenya. Thanks.
Good morning. My name is Dano Ario. I work at Competition Authority of Kenya. I direct research and policy, and I support competition and consumer-related research and complaints analysis.
We have one more who is joining virtually. Are we able to dial him in?
Yes. Do you hear me? Good morning. Do you hear me?
We can hear you.
Thank you. My name is Luis Treviño. I'm the Senior Policy Manager of Financial Inclusion Data in the Alliance for Financial Inclusion, a network of financial policymakers promoting and enabling policy solutions for financial inclusion. And Central Bank of Kenya and other organizations in Kenya are members of AFIS, so it's really a pleasure for me to be here this morning. Thank you.
Thank you. So I want to start with Dr. Dano. One of the frameworks that Christine from Senfree put up on Kenya's competition and consumer protection framework is the Competition Act. And sections 55 to 70 of the Act give the authority broad mandate to oversee consumer protection in the market, including addressing issues related to customer complaints and unconscionable conduct. From the authority standpoint, what could you say are some of the key consumer protection concerns and risks that you see in Kenya's financial services sector?
Thank you, Francis, and I would like to thank the organizers for inviting the authority. And the section of the Competition Act that Francis alluded to basically outlines the provisions of the Act in relation to how we handle consumer issues and also consumer complaints. Having said that, with regard to concerns, we look at concerns in terms of sector complaints that has been submitted to the authority. Therefore, over the years, we have seen growth in consumer complaints, and more particularly, we have seen over the years as well that about 60 to 6% of consumer complaints, of all the ones that we handle, actually come from financial services sector. So that has been growing over the years, and we have seen that complaints are actually indicative of people's engagement with the authority and as well as the sector. With regard to risks, I can more broadly give 4 risk patterns that we have seen. One is with regard to disclosure and transparency. That key services that are provided by financial institutions, they don't disclose or they are not transparent with regard to fees and charges. Therefore, those becomes complaints that are submitted to the authority for analysis and also for remedy that might be offered by the law. And the second one is unconscionable conduct with regard to providers filling of forms that relate to loans and borrowing by the consumers. So what we have seen over the years is that forms that are filled in by consumers are often not completely filled in. Therefore, there are areas that remain gray with regard to financial service providers, and therefore how that translates to additional costs for consumers at the end of loan repayment, for example. And the third one is unconscionable terms and conditions. Most of the conditions and terms in the loans agreements tend to be more legal in the sense that they are very difficult to understand by consumers. And they also tend to be lengthy, spanning 3 to 4 pages of the agreement. Therefore, this becomes of challenge to consumers in terms of understanding what are the legal interpretation of those terms and conditions in the agreement loans. And the fourth one is relating to unavailability or rather ineffective dispute resolution mechanism that exists between the providers of financial services and the consumers. In this sense, what I can say is that if there are any disputes, if there is any disagreement between service providers and the consumers, are there mechanisms which addresses those complaints by the consumers. Therefore, those are broad, in more broad sense, the 4 risk areas that we have seen from the analysis of consumer complaints that have been submitted to the authority. Thank you.
Thank you. And would you say that there are certain segments of the market where these risks are perhaps more pertinent than others?
What I've said is the fact that the way we analyze consumer complaints is looking at complaints that are brought to us. In rare cases, do we go into the market to find what are the some of the areas of issues. But based on the analysis of complaints that are submitted to the authority, we do see that financial sector accounts for about 60%. Others are all other sectors of the economy, because the mandate of the authority covers the entire sector of the economy, as opposed to also specific sector regulators which look at the specific sectors.
Thank you. Turning to Eva. So the first paper that was presented today morning by M-Pensa, showed that those who do not have access to mobile money services tend to be more excluded compared to other segments. And here it's not just excluded from financial sector, but also economically excluded. And from the standpoint of the authority, what do you think could be done to enhance access to the digital infrastructure that can then be the pathways towards these forms of financial and economic inclusion?
Thank you very much for that question. Indeed, ICTs play a very important role in enhancing digital financial inclusion. So when it comes to when it comes to infrastructure, there are 3 main issues that we look into. We look into access, which is the ability to access ICTs by end users. We also look at affordability of this affordability of ICT equipment, and also affordability of ICT services, and also availability of the ICT services. Now that points directly to infrastructure. So as the authority, there are 4 ways in which we ensure universal access to ICTs. So one is through market, is through the market. That's through the ICT sector has been liberalized, so we license various operators to roll out services into, to roll out ICT, different ICT services and infrastructure. The second way is through license obligations. So when licensees when companies are licensed, especially the infrastructure licenses, they're given rollout targets. So you'll be given, say, a number of sublocations that you must cover within the term of your license. And compliance is usually checked on a regular basis. And then the third way is through the Universal Service Fund. Now that's where now we cover access gaps where the market won't go and are not generally not economically viable areas. So that tend to be more rural, which speaks to actually the first paper that was presented, that most people who are excluded are actually in rural areas. So that's one of the areas of focus through the Universal Service Fund. And then the fourth way is through public-private partnerships. We are currently exploring how best to partner with different institutions to cover now the pockets that are extremely, extremely excluded. They're absolutely not economically viable, but they must be covered. So those are the 4 ways in which the authority is covering the infrastructure gaps. So we have various projects that are going on. So the first phase of the voice infrastructure project, which is aimed at providing mobile cellular services, which will go a long way in enhancing digital financial inclusion. So we aimed to cover 78 sublocations, and so far about 76, 75 have been covered. The second phase aims to cover about 101 sublocations, and the third phase is currently under the pre-feasibility phase. There are various challenges, very many challenges to covering those gap areas, and one of them includes insecurity. So you find that you put up a mast, the next day it's blown up, especially in the northeastern part of the country. We also have issues with terrain. The terrain is difficult to get to. People are living in very mountainous areas that are difficult to cover, or there are also issues of supportive infrastructure. There are no roads, so accessing those sublocations is very difficult. Access to electricity, there's no electricity in some of these areas, that's also another big issue. There's also community resistance, which is also another big issue. But in fact, those challenges are actually what are really hampering faster absorption of the funds and also faster rollout of ICT services in those areas. But the authorities currently, especially in the case of security, ICTs were designated as critical infrastructure earlier this year, I believe. And so that has also increased security around infrastructure that is built. And also we are engaging with different stakeholders and also different communities just to enhance community acceptance of these projects. Yeah, so that's what you have so far.
And could you also just add a commentary on now access to devices, let's say smartphones? And I would want Andrew to also comment on that when it will be your turn.
Okay. Access to devices, smartphones, I think is a wider conversation generally to the general public, like in urban areas and the like. Is a general issue of how do we make them cheaper, how do we remove perhaps taxation, what is making them so expensive, how do we enhance, say, local manufacture. I think that's a wider conversation. But with respect to the authority and the interventions that we're making are specifically targeted at disadvantaged and vulnerable groups. So for example, we're looking into ways of subsidizing, say, the cost of import of ICT equipment specifically targeted at the blind, or also target also local manufacture, seeing how we can enhance local manufacture of equipment to certain vulnerable groups. Yeah.
Thank you. Turning to Rob. The first presentation again highlighted that the youth tend to be one of those segments that are excluded from access to finance, and I would presume by extension to economic opportunities. From your standpoint, what do you think is driving that exclusion within that segment?
Thanks. I think there's an irony here a little bit, because I think when you look at youth income data separately from other adult segments, at least in our research, we find that young people are performing quite well. Young people are generally more financially healthy than the average adults in the country. And yet they are, and there are good reasons for that, I think. As young adults, they tend to be living at home. More than half are living at home. They're not burdened by the kind of routine expenses that their parents have. They're not responsible for household finance. And so they're enjoying a consistently healthier situation than the norm. And yet, as you said, and what we saw earlier, they're also significantly financially excluded. So there's a sort of tension there. But I think and even the financial inclusion, I think what we've seen is that it's driven mostly by digital loans and microfinance. So it's not sort of formal sector. But I think we also saw in, I think, Christine's presentation that in many cases there's I'm looking for your phrase, what did you say? Suitability, voice, and meets purpose are all three places where young consumers feel excluded by financial services. So there's a problem where banks really don't want to have young customers. Banks don't welcome young people into the services that they provide. They've sort of signaled that they don't want them, and we're seeing it again in the data we saw just now, that the design of products isn't suitable for all consumers, and particularly for young consumers. So the service may not be suitable for young people and their needs when they come fresh from school, they don't have a history behind them, they're not formally employed. And then on top of that, it's very expensive in most cases for young people to obtain financial inclusion services. We've seen a drop-off, I'm sure that Safaricom has seen it too, in use of M-Pesa, and it's a function of cost. Young people don't want to pay. So when we're talking about the young people that we've been observing, the high performers are earning 12,000 shillings a month. So even as high performers, they're still marginal in terms of their overall income. And on the $3 a day, which is what it breaks down to, the kinds of fees that they're having to pay for financial services to be financially included are prohibitive. So I think we would certainly agree with what we saw earlier on the screen, that there's a problem of product market fit. The kind of services being offered to young consumers, the financial inclusion services, don't yet meet the needs of the young people that we're working with, at least in Kenya. Thanks.
Thank you, Rob. And turning now to Safaricom, Andrew Young, and I think you'll tell us if there's any relation to the other Andrew Young. So, two questions for you. I think one, just to sort of pick up from what Eva said about access to devices, and again, secondly, to also give a commentary on Rob's perspective on the suitability of the products to meet the demands, sort of the needs of the youth. But also to now address the question that I had for you is that I think from the presentation on the Consumer Protection Outcomes Index, we saw that there's a positive trend across most of those variables, except one on those meeting purpose. And Safaricom has, over the years, been very successful in rolling out solutions, either through its own or leveraging other partners. And I just wanted to hear from you whether, as part of this process, there has been any surprising or unexpected outcomes, positive and negative, in the rollout of these products in the context of meeting the needs of low-income Kenyans.
Thank you. I think the presentations really speak to a lot of dimensions and facets of what we do. As M-Pesa, drives payment so that now we create the environment. We also be able to offer financial services that then empowers. And then now we are driving innovation. So I'll begin from the issue of devices. I think when you talk from a channel perspective, devices play in that scope. So if I can use my smartphone or use my feature phone. So as we move along, I think evolution puts it that now we should be able to do more on a smartphone platform. But the pricing of the smartphones a bit higher than people want to include for financial services. So I think Safaricom is looking at this from perspective of price. How do we enable more people to get on board to this? And so you have seen initiatives like Lipa Mdogo Mdogo, by helping you to have phones by paying 20 shillings every day till you pay off for the phones, so that they have better phones. Also, we have worked on distribution and being able to bring form factors that work within different geographical aspects. There are places by, as been mentioned, electricity is a problem. How do you have more longer battery retention phones and the likes, ones that can get signals even from remote places. And then I think the third thing is to see how then do we leverage to then accelerate some of the deepening or inclusion aspects of financial services. So maybe there's just from access to devices. In terms of suitability for youth has been mentioned. Youth forms a very big percentage of our, of our population, but we see they're not the leading in terms of the segmentation that we have. And I don't know, maybe we can align with my brother here. He says they're healthy, but the truth is they're also in the space whereby they're trying to go up the economic ladder. And you have challenges of unemployment, or maybe they have so much to do to catch up with those who are more financially stable. So what you see it is a little bit the older generation tend to have the money, but the velocity of what they do with the money tend to be very narrow and also not more of development type. They're more stable, but the young people who are savvy seem to, what they need is they need to be empowered more economically. So that's why they're more sensitive to price. And so I think some of the things that are coming across, it's the issue of awareness for or maybe that could be put as education, comes strongly for our young people. We assume they're aware, but they're not aware. They're more of consumer mentality, but that education financially seems not to be in place. So we are looking at areas like that. And the issue of cost and affordability, I think we are going through an evolution of different factors. And the way Safaricom looks at it, it's the issue of affordability. It is, as we continue to innovate and grow, we want also to be able to pass that benefit to pricing, so that now also there can be more inclusion. And so certain initiatives have come along, like, they make our issues of devices to be more affordable, or they can be paid at a pace they can be able to buy. So we're working on stuff like that. So we are addressing certain things. For instance, also, I know this also may go with politics. We are the only institution that actually brought cost of credit down, whereas all the other institutions took it up. So some of these things is to begin to talk to what are these outcomes. I think young people significantly, we see a lot of push for them towards affordability, that they can be able to access much more and not carry the burden, of course. The issue of choice also is a big thing for the young people. I think they consume things in different channels. They want certain things that sit with them that border on innovation. So we continue to see how do we bring to youth more innovation. Then to things like gaming, they do their businesses. It is online. They don't need a physical place. They want to do their business from home. So we are seeing young people are, the way their choice works is very different, and it's away from the traditional days. So coming to the purpose index, I think it's been from the last presentation. I think the indicators are very powerful. Where we are, especially for M-Pesa, as we move into developing our platform to become more agnostic and to be able to help the economy more, I think one of the themes that we have from the consumer side is to move into the space of consumer health. So it's not just them accessing, having deeper financial inclusion, and thanks to broadening how many kind of categories of services our consumers access, because there's a lot that is not done. Some things today, at Safaricom perspective, there are big things in 2007 when we started, like sending money. But that's no longer the thing. Nobody in this generation thinks it's such a big thing. So we are moving into a space where we're looking at, yes, you have inclusion, yes, you're deepening even across the products, which is a level we're looking at now, but also how do we get to consumer health? So you'll be hearing Safaricom doing things like trying to bring things that are savings, culture-led kind of propositions that will be coming out soon. May not mention, but some of them have been approved. So we're looking into those kind of space. And for the youth, what also we are trying to do is we are working in a space to see how do we begin to bring inclusion even for high schoolers to begin to have awareness, so that by the time they are coming into the major population space, adulthood, they're already more literate, and therefore the issue of purpose can fit better. But where we are from looking at the way, because of our needs are short-term, and therefore we go for short-term facilities, which then has driven the issues of loans, which are expensive and are a burden. The issue of purpose is coming more and more, that our consumers need to be educated more in terms of the responsibility and the fit for purpose for different products that we take up. And so when you look at challenges in the economy, I think sometimes we are dealing still with the basics of the economy, because if you have to eat, then somebody will borrow then to eat. So sometimes what they're borrowing or the product they're using is not sustainable for the kind of challenges they have. So we continue to innovate and see how do we position different products that then meet outcomes in the long term in terms of affordability and then purpose. So we are trying to shape that conversation. So one of it is awareness in a big way, education, and also being able to position different products for different purposes.
Thank you. Turning back to Rob, the paper on financial health, it showed that payments for education is placing a strain on incomes and especially for the poorest. And for the segment that you work with, that is the youth, what are some of the mechanisms that we can put in place to ensure that these investments yield some dividend for the youth?
Thanks. I mean, I think it's a natural response, isn't it, for parents to want to educate their children. I think for the poorest segment, of course, it's what we spend our money on, and I think that it's troubling to see. I think from the chart we saw earlier that it's the poorest amongst us who are spending the greatest proportion of their income on their children's education, and I think it's tragic in a way because the future is not bright for educated children. That we've been running an annual cross-sectional national youth survey for 7 years, and at no point have more than 5% of 15 to 24s told us that they have a formal job. So there's a terrible cruelty that we've indicated to our parents that their children will enter the formal sector, that there are jobs waiting for them, and that if they work hard and if they study hard and if they invest what they have in their education and their college and so on, that there's a formal sector job waiting. And what we're seeing is millions of families going into debt to buy an education that then does not secure the formal, that white-collar job that they're dreaming of. And it puts a terrible tension, I think, into the lives of young people because they're under such pressure that their families have invested in them. Their expectations are so high that surely you are our investment, young person. So when's the job? When are you coming back to support us? And yet there are no jobs. And there's a syndrome that there's a vulnerability there that actually what's happening, what we're seeing is that in fact, for many people, more education means fewer opportunities. That actually people are educated for something they can't obtain. And it's very difficult for a highly educated young person to accept the informal sector reality that waits for them. Another framing of that is this idea of cruel optimism. You've been told to be hopeful, but the truth is you're going to have to settle for something less. And that's a very hard thing for people to do. I thought I was going to get a white-collar job, but now I realize I'm going to have to be a hustler. And that's a tough one for people to accept, to turn back and pick up the reality. So there's a big problem, I think, where the education system and society and all of us are promoting one track, which is the track towards formal opportunity, the track towards formal employment. And the education system is teaching people for that market. And the reality that 95% of the million or so young people who will enter the job market this year will never get a formal job. They're going to work in the informal sector. And that requires a different set of skills and a different set of aspirations. So I think perhaps what we're seeing with the new government, this notion of the kind of the hustler narrative can be extremely helpful in that because it will allow people to be proud of their informal sector lives. Because what we're seeing is that many young people are indeed flourishing in that space. Something like 25% of 15 to 24s are hustling in the informal sector. In fact, what we've seen since 2016 is a doubling of young people who are working. In 2016, we found that 47% of 15 to 24s were earning income. But in 2021, that number was 100%. Almost every single young person out there is finding some money to support their family. So I think it's supported by the numbers that we've seen. So the future is informal. The skills that young people need are the skills of the informal sector. The education system may not be currently the right path to acquire those skills. There are some other avenues available. There's some informal trainings, some informal systems, and increasingly informal types of employment in the gig economy and so on that actually provide, I think, a better path, and for which we ought to be preparing our young people.
Thank you, Rob. You've mentioned the gig economy and providing other tracks that could lead to more economic opportunities for the youth. My question to you, Eva, is there a role for the authority in sort of enhancing digital literacy amongst the youth? to sort of meet the aspirations that Rob has painted?
I'd say the role of the authority would have to be within the scope of our mandate, insofar as consumer protection is concerned. So for us, the authority's role is mainly to empower and protect consumers of ICT services so that they're more aware, to create more awareness and also more and more ability for them to use ICT services. So we're looking at things like, okay, so are you aware of your rights? Are you aware of your obligations? Are you aware of some of the services that are there when there are issues? Are you aware of the channels of redress? And also issues of cybersecurity come into play. So how are you safe online? Are you, what are the risks that are there when you're consuming ICT products and services? And so our role and our activities so far have been mostly around that. But indeed, there's a lot more that needs to be done to enhance consumers' digital literacy, and a lot of programs that we can also partner with other institutions to enhance digital literacy. But largely, it's not, our role has mainly been towards consumer protection and empowerment as they consume ICTs in general.
Thank you. And of course, one of the institutions that you could partner with is the Competition Authority, Dr. Dano. And I'm also aware of the campaign that the authority has been running, I think, on Kachonjo, I think on just enhancing safety within the digital space. Thank you for that. Dr. Dano, on Christine's presentation, she had a graphic that showed the need to balance financial inclusion and protecting consumers. And I think there's a comment that she made that protecting consumers is not easy. And the authorities, competition authorities' mandate is in most instances enforced ex post. In simple terms, it just means that the authority will pursue any enforcement or remedial action after harm has been done. Would you say that this approach is effective when it comes to consumer protection?
Thank you, Francis. I think that's the issue with regard to regulation is at the core of both competition and consumer issues. And just for information purpose, the other form of regulation is ex ante, which means that issuance of license allows players to play in that market. And therefore, once, for example, CA give a license to any agency, then they're allowed to play in that market. Or if there are issues to do with trade, they will be also licensed to be active in that market. Therefore, that's extant, which is forward-looking approach to regulation. And as you put correctly, our role more so is on ex post regulations, which means we look at consumer redress after the event has happened. And therefore, what we do is either we receive consumer complaint of any harm that they have experienced or any misinformation that they have encountered. And those are the sort of complaints that we receive and we analyze. And not all consumer complaints are also taken forward for remedial purpose. For example, if there's no clear evidence that links the complaint to the substance of the complaint, then it's become difficult to follow up. However, in most success cases of complaint redress, what we look at is we receive complaint, analyze, and therefore take remedial action based on our analysis. The other option is for us to have an on-motion consumer complaint addressed. If we have any intelligence that indicate that there is consumer harm in certain sectors, then we do consumer analysis more broadly as per the sector, as opposed to individual consumer complaints. And in that line also, what we do is we work with other competition agencies in the region, like the COMESA. If there are ban of consumer products that are harmful to consumers, then we can also recall those products from the market. But in terms of achievements of what the authority has done with regard to ex-post analysis of consumer complaints, is we have gone into market and seen that some of the issues that regard to fees and charges are today disclosed. So you see if you are transferring, paying any bills for your utilities or transferring money to any relatives or friends, then you can see how much it costs you to send an X amount of money. So that allows us to have a proper approach to remedy consumer complaint. In financial institutions, we have also in certain instances followed non-deposit taking financial institutions and penalized them, and also compel them to pay for charges and fees which are not disclosed. So we have taken those measures to address a consumer complaint in that sense of ex post. And therefore what we have done is to follow the law and also see that consumer complaints are redressed. So in terms of actual implementation of Competition Act, we have not seen any gap in the law that allows us to reconsider and review. But there's an opportunity for us, if there is any gap that we experience on practice, then for us to amend the law and address consumer issues. But as of now, and I think it's comprehensive enough to be addressing consumer issues.
That is clear. We've not heard from one panelist. We didn't forget him. It was by design, and that is Luis. And he sits at AFI, and we wanted Luis to just give us a commentary, just to give us his thoughts from the pre-presentations and from the pre-panelists, or from the four panelists, on his perspective from a global standpoint on where Kenya stands compared with other countries in terms of financial health, consumer protection, and financial inclusion. Luis?
Thank you. Thank you so much. Thank you so much for the opportunity. I want to thank the Central Bank of Kenya and the FSD Kenya and all of the partners for this conference and for inviting us. Really, well, I'm really pleased of this session. In terms of financial inclusion, my response would be that Kenya is. I have a very optimistic overview, right? I think has been evolving very positively, especially thinking and has been explained, right? And we all know the mobile money, digital finance is one of the key enablers, right? But I think it has expanded beyond just. I'm sorry. I'm so sorry. It has expanded beyond transactions, right? And it has been able to cover. And if you see the recent Global Findex results, Kenya is among the countries, especially the Saharan region, that have led, right, the financial inclusion, right? Of course, there are opportunities, right, and there are gaps, and I think the presentations today provided an overview on some of these opportunities, on some of the groups that still are not included, right? Especially thinking on rural. Also on the gender gap that is still persistent, right? But in terms of gender gap, women financial inclusion has evolved positively, right? It has evolved, but has evolved in a different pace than men, right? If you compare this, but still, there are these challenges. Thinking also, looking at the presentation from Senfri, from Christine. I really commend the work that they have done in terms of this index on financial consumer protection. I think this brings more information in terms of quality, right? That it's so relevant. And in these regards, the results that she presented are quite positive, right? We can see that choice, safety and security, and fairness and respect are very high rated, right? More above the 90%. That's very positive. Still, there are opportunities in terms of, and it was mentioned also during this panel, the recourse in terms of disclosure and financial education, right? at least the rates in this measurement are lower, but still are quite positive, right? Another aspect, I think that's very important, the one mentioned on suitability of financial products, right? That it's also a challenge not only in Kenya and in all the countries, right? To really fine-tune the financial products to be suitable to populations, right? And we can see here, for instance, that there's an opportunity in terms of reaching out more rural population, right? Youth, but especially I think rural, not so much youth. So that, I think that's there are opportunities that well, in terms of that requires, you know, partnerships between the different stakeholders, the policymakers, but especially also the private sector, right? And it's, you know, and we are in this panel with different stakeholders. I think, you know, and in terms of financial health, you know, we have been discussed also in AFI, and it's right now one of our, you know, key thematic areas, this financial health in terms, you know, not only on measurement, but also in terms of other related policies. And, you know, financial health, we see this as measurement. In terms of measurement, we see this as mentioned by UNSGSA, it's like a temperature, right? It's like having a quick temperature of how is the financial health of the economy, right? Of the different sectors, right? Of course, and I think it should not be surprising for us the decrease in financial health, especially in the last finances, given the very difficult context, right, that was lived not only in Kenya but in a global scale, right, in terms of disruption of employment, disruption of value chains. You know, this has a negative impact in every way. So well, we should expect, right, that a decrease on this. But still, for instance, the aspect of what that's mentioned on families investing in education, that, you know, I know that you know, and the panelists here also have like a kind of a negative opinion, but I think in terms of financial health, that also tells us about how it has been, you know, families are thinking on long-term goals, right? That are investing in long-term goals. Of course, there's the markets are the markets always, you know, there's a structured economy, right? And but in terms of you know, in terms of education and also thinking in this context, we can see that these last 3 years have suffered a disruption in education, right, at all levels. So we should not be surprised to have this, you know, like families really trying to invest more in education, because, you know, the education was disrupted in a global scale. Yet this can also provide some important information for making decisions in the long term in terms of public policy, right? In terms of how can education be supported, right? In these terms, and also what was mentioned, I think was important in the panel. Not only education with the focus on formal employment, but especially on really form and, you know, develop skills for entrepreneurship, for SME, for developing the economy, right? And we know, as many countries, I am from Mexico, and also in Mexico, the informal economy is very, very high. But in that regard, investing in SMEs and entrepreneurship, and also financial inclusion, can be factors that eventually reduce the level of informality, right? In the long and medium term. So You know, I'm really quite optimistic right now. I'm not so pessimistic in terms of, you know, we know there are a lot of challenges and the context right now, it's very difficult. But in terms of financial inclusion, I think Kenya has done the right steps, right? Also, we can think right now, you know, before the conference, there was announced the launch of the payment system strategy in Kenya. That also it's an important, right, payment systems innovation to also expand the different financial services offered, right, to the population, not only the you know, transactions. And also in another way to also you know, keep the safety and security of the financial system. I think that you know, I'm very optimistic right now. I know there are a lot of challenges ahead, but I think the, you know, Kenyan authorities and also the private sector are in the right path right now. Thank you.
Thank you, Luis. Sorry, thank you, Luis. And on that positive note, we've come to the end of our panel discussion. I want to thank all the panelists, and can we give them, or can we appreciate them? Thank you. Who?
Thank you so much, Francis. Thank you, Louis, from AFI. AFI was one of the funders for the FinAccess survey. Also want to thank all the panelists. I know we are hoping to have questions. From the audience, I don't know whether we have any questions. I know we had one online. Okay, I see one there from Adrian, right there. But from the audience, as we wait for Adrian to take, we had one for Daktari about the mechanisms that consumer CAK is taking to come up with the mechanisms you talked about. And I know you've already mentioned them, but you could probably just quickly say one or two mechanisms that you're taking to protect the consumers.
Yeah, thank you. In terms of handling consumer complaints and how we redress them, as we said correctly, the fact is that we address consumer issues ex post, which means there's already grievance between the consumer and the service provider. And the way we do that is we receive complaints either physically at our offices and Kenya Railways, or we can also receive them online. And once we receive them, we get in touch with the complainant and see if there are evidence to support the complaint. And the first point of instance is to reach out to the service provider to ensure that there's concurrence between what the complainant is saying and what the service provider says. So there's what we normally call a hearing conference. We call both of them and verify that's the fact actually on the ground. And in some instances, they actually agree to resolve the issues by themselves. But in absence of that, if we have enough evidence to show that consumer is actually on the right, then we can penalize the parties. And therefore, that becomes part of our remedial measures. But what is key in all this consumer complaint is the evidence. And consumer can come to us and complain, but if it doesn't have evidence, then that becomes a very weak complaint. Therefore, we cannot pursue it further. But what I will urge, what we do urge consumers in most cases is to ensure that they have proper documentation to support any complaint. And if they purchase products, they should have receipts that show that evidence. Or if it's a purchase of a product online, there will be communication to that effect. And if they have already addressed it to the service provider, then they have not taken any action, then that can be brought to us and we can handle them.
All right, thank you. Thank you, Adano. So that was from Dr. Martina Mudeo from University of Nairobi. So we can have the next question. Just need to say your name and the institution and then who it's directed to. Thank you.
Okay, thank you. This is I'm Adan Shibia. I'm from Kipra. Just two questions to Dr. Adano. One is the analysis report, the complaints analysis report. I wanted to know whether, as part of the policy conversation on the subject, whether CAK do publish and the regularity of the publication in terms of the nature of the complaints and then per sector. I think that's also part of it helps in terms of taking forward the conversation. Then secondly, you identified 4 risk areas, which I think can also be viewed in terms of the challenges. Perhaps maybe just focusing on 2 areas, dispute resolution and perhaps terms and conditions. What opportunities do you see for improvement? Perhaps, I think as a country we have done some positive steps over the last years. Perhaps from your view, what more need to be done? Thank you.
Thank you very much for those questions. With regard to the first question, almost all the consumer complaints we handle are published on an annual basis. And our annual reports are available on our website. So those can be accessed by anybody or public based on their interest. So those are available on our website, and you can access them. And also within the annual report, they are provided as per sectors. But there's a long list of annex in terms of all the consumer complaints that we have received within a given year. But one of the challenges we are facing of late is the number of complaints we receive. In the past, they used to be in the tune of 50 and 60. Now they are going to hundreds, 300, 200. That's what we are receiving. So they make the annual report voluminous, but they're also available on our website. In terms of the risk areas that mentioned earlier, particularly with regard to unlimited mechanism for providers to resolve complaint, there are 2 areas which we have seen more prevalent with regard to issues of relation between buyer and suppliers. And what we have developed is what we call code of practice. Code of practice are developed by players to ensure that among themselves they are able to regulate, and that allows the authority to just oversee or becomes the third party to play in that complaint process. So what we have done, therefore, is to ensure that they handle among themselves first, and therefore, if they are not able to resolve them, they can come to us and we can handle the complaint on their behalf. In terms of financial institutions, where I've mentioned about unconscionable conduct, is those ones are actually handled very well within the provision of the law. And one thing that maybe is becoming more difficult is with the digitization, most of the information or evidence takes place online. Therefore, we cannot access directly, or in some instances, complainants cannot access them directly. So that's one area I think that we have to look at. And as Francis mentioned, we do have an MOU with the CA in terms of how we look at those issues. And there are instances, not in financial sector necessarily, we have resolved issues of that nature.
All right. Thank you. I think we have time for one more question because of time, and I think we'd have to figure out how to manage the next session. So you can quickly ask your question.
My name is Annalise McKenna, and just a follow-up from Dr. Ray from the Competition Authority. Just wanted to ask whether the public is aware of your authority and the level of awareness.
Right. Terry can quickly respond to that, then yeah, thank you.
Thank you, McKenna. That's actually one of our strategic objective as per our strategic plan, in terms of public being aware or not being aware of our mandate and whom to approach in terms of any complaint. In terms of consumer issues, there are also sector-specific regulators who handle specific issues within their mandate. What happens is that we have more than 10 memorandum of understanding with sector regulators that in areas of concurrent jurisdictions, we can resolve issues together. But in terms of informing the public of our mandate and how they can handle issues, both in terms of competition and also consumer, is on annual basis we have annual training where we build capacity of our stakeholders, and stakeholders include all the sector players, all issues that relate to energy, telecommunication, lawyers who present businesses in terms of any complaints or any business practices, which in our view are not in line with the provision of the Act. In terms of consumer-specific ones, the strategic plan also provides for us to collaborate with consumer bodies. And we have worked with a number of consumer bodies. What we see as a main challenge is how to reach to individual consumers in large numbers. But consumer bodies allows us to reach to the relevant consumer bodies in that realm of areas of concern. So I'm aware that we have tried to reach out to consumer bodies, and also taken one of the annual events of the authority. There's a World Consumer Rights Day that we take to different counties on an annual basis. We have been to Kisumu, we have been to Kakamega, we have been to Eldoret. Of course, we are in Nairobi, and therefore awareness of the authority within Nairobi is higher, but it's much lower in other counties.
Thank you so much. So final hand clapping for the guests, Andrew, Rob, and Eva, and Dr. Adano. You can have your seats. Thank you very much. Sorry, we've run out of time, and I think Francis had wanted us not to have questions at this point. But, well, we'll go for break. And for the sake of those joining online, we'll start at 11:20. And we'll coordinate with, because we have other panelists coming, also joining us, so we'll make sure that we start at 11:20 at the dot, and then we'll take it over from there. So if you could take your break quickly, then we come back. Thank you.
Haya, kwa majina naitwa Penina Wahu kutoka LD, but nakaa hapa Kawangware, ndio nimeka biashara ya salon hapa Kawangware. Kenye naona inanisaidia na hii biashara yangu ni mambo na chama za wamama. Chama za wamama zinasaidia sana sana. Kama umelemewa na business, wanakuja wanakuinua. Kwa saa hizi mimi niko na chama 4. Mimi nimeona hizo chama zimenisaidia juu kama hii ya Utugi, naendanga kutembelea wazazi. Kupitia hizi chama za wamama tumeungana. Mtu akiwa na jambo, kama umelemewa, kama uko na ugonjwa, wanakuja wanakutembelea. Hapo awali nilikuwa na circle, but nikakuja nikaona afadhali nilikuwa tu kwa hizi chama za wamama kuliko circle. But nikaona chama za wamama zinasaidia juu nikitaka kitu emergency, naenda tu kwa chama nawaambia, alafu kama ni kitu kunisaidia kama pesa kidogo tu ya kuinua biashara yangu wananipatia. Hata kama sijaweka stock ya kutosha kwa kazi yangu, lakini natarajia nitaweka ya kutosha kupitia hizo chama. Tena na wakopa kidogo kidogo na kuja naendelesha biashara yangu. Kuna watoto wawili, mmoja ako class 7 na mwingine ako class 1. Na kupitia hizo chama za wamama, at least sijaiona mtoto wangu amefukuzwa. Mi kulingana na kwenye chama zimenipeleka na kwenye zimenifikisha, mi sioni maana ya bank ama circle. Mi nategemea, naona tu afadhali tu nikae na hizi chama za wamama. Juu kwa bank tuweka pesa, umeweka, lakini at last maybe kama unataka loan itabidi ufuate procedure kubwa. Sasa mi sioni kama naweza fungua any circle. Acha niendelee tu na chama za wamama.
My name is Kevin Mulwa. I sell suits in town. We've been in this business for the last 10 years, much experience, challenges here and there. There has been challenges like you save with the bank, then when you go for loan maybe to boost your business, you think you get they want so much. I had another bank which I used to operate here in town. They add so much hidden charges where you find when you are getting your statement, you get they have charged you so much, and when you go back there and you ask, they have no answers. You are taken from one manager to the other. You are told come tomorrow, we'll sort you out, and it was very frustrating. Most of the banks we get, you will find people who are employed there, like they don't have information. Maybe they have the information, but they are not willing to give out the right information because they want to sell fast. They want you to open an account with them, and they have been given targets. So the information which they give you, they'll give you information which will make you open the account. Basically, we need to get the right information right from the start when you are opening the account, so that you get to know where maybe there are some deduction of your money at the end of any transaction.
Majina yangu naitwa Nancy Wanja. Mimi ni mwanabiashara wa Githurai. Mimi ni muuzaji wa minji, ni wholesale na retail. Kuna challenges zile zinapatanga watu kwa biashara. Sometimes unakuta biashara imeenda chini. Saa nyingine unakuta biashara inaenda juu. Kwa hivyo wakati biashara ziko chini, ndio tunahitaji mikopo ya hapa na pale. Tunaenda kukopa hapa na pale. Unakopa on daily basis. Mimi nikilinganisha pesa ya banki ama ya sako. Kwa sako interest ya chako ni kidogo sana. Lakini kwa bank unakuta saa hii wamekupatia a loan of 100,000, lakini unakuta umelipa kama 1,300. Lakini kwa sako haikuangi na faida kubwa sana. Kwa hivyo na prefer sako instead of bank. Sababu nikienda kwa bank kila mtu atakuwa anajua mpaka nitaitishwa maseginitors wa kunisainia, lakini ya talama ya mswari haitisi seginitary, haitisi mambo mingi. Kwa hivyo mimi naenda tu na nikukanyakanya tu kwa simu, alafu pesa inaingia. Kwa hivyo tumefurahia sana mambo ya tara, mambo ya mswari, KMBC. Those are the quick means of mikopo ile tunapenda sana.
Okay, my name is Edith Onyango. I'm a managing partner in a catering business that is owned by two ladies. With regards to financial services, we have two bank accounts. since this is a partnership, we both jointly have to sign in order to access services. Yeah, so either way, we still have to use the traditional method, going to the bank to actually get cash. With regards to payments, we're able to accept M-Pesa payments. So for this course, we realized that we're able to get a lot more money because people don't always have to carry cash around with them. And over the time, yeah, I mean, I don't have to go to the ATM at all. I even have an ATM card that I will only use because it's a Visa, I used to pay bills. I don't really use it to access money. When I need to get money, I'll just go onto the line, I'll use my phone to go into the online mobile app and access money. And this definitely makes things easy. And well, so far, the individual clients also pay us using mobile money, so still very good. The bigger clients, of course, will pay by bank transfers or by check, so that means those have to go into the bank account. Yeah, I think the banks need to be more friendly or come up with something that, because for us being a partnership, when I need to get money, I still have to physically go into a bank because I have to walk in with a check, signed by both signatories. We cannot have an ATM card because this is a partnership. So I think the banks should consider doing something. I think mobile banking has helped increase in terms of volumes. Sometimes the people who, when they walk in here, the first thing they will ask is, do you have a till? So in that case, there are people who will comfortably come here because they know that they can pay by M-Pesa even if they don't have cash. Because as it is right now, there's so many requirements and so many small prints that banks require before they can actually give you even the minimum of loan, regardless of the fact that you have lots of money with them. So getting an overdraft facility is close to impossible. So I hope that this initiative is going to help them understand our needs so that they come up with a product that will help us.
Naitwa Paul Suyanka na niko na miaka 29. Niko na watoto wawili. Mmoja shule, mwingine bado hajaingia shule. Mimi na savingi na natumiaga Equity, lakini sijapata pesa ya kusave. Ningependa kuanzia biashara, lakini sasa ndio naanza kujipanga nipate pesa ya kuanzia biashara. Mwaka uliopita singeweza kusave ama kujipanga kwa vile niligonjeka na ikawa matumizi yangu yote yameingia kwa gharama ya hospitali. So ile pesa nilikuwa nimeweka yote ilitumika. Kwa hivyo saa zingine life inakuwa ngumu. Kama uko na familia, ukigonjeka, unaweza tumia pesa vile ukuwa umejipanga. Yeah. Lakini kulingana na vile umejipanga naona itarecover tu. Nitarudisha ile mali nilipea ama ile pesa niliyotumia. Kufanya kwa kusave na kwa kuweka kwa bank nipate kuanzia biashara. Sijaitumia Tala M-Shwari kwa sababu wanapatiana loan kidogo, mkopo wa chini sana ambaye haiwezi anzia biashara yoyote. Sijaipata kuchukua loan kwa banki yoyote ile ama kwa Equity kwa sababu ya inahitaji mtu ambaye ana save ama anapata pesa kila mwisho wa mwezi. So sijawahi fikiria kusave na kuchukua loans.
My name is Boniface Kithara Kimathi. Okay, I'm an entrepreneur at Kangemi Business Center where I have a cyber cafe. To start my business, I started with my own capital, and towards growing the business, I decided to take some loans from Tala, from KCB M-Pesa, after which it wasn't enough. I decided to partner with a saving circle that I had been since 3 months ago, where I took a loan of 80,000 and added up to my capital so that I could rent a house where it's strategically accessible by my customers. These loans, first of all, the one I took from Tala, I borrowed from KCB M-Pesa so that I can pay it because the period was almost. Actually, I like betting a lot. I love football, and I like placing my bet, even though I don't know the results which will come after. The little profit that I make, I take at least even 50 bob, which I take it to SportPesa, and at least see if I can get some casual money to juggle in between my other responsibilities. For the medium loan givers, they should reduce how they pressure a client to pay that money. Sometimes business is bad and you cannot be sure that you'll pay within that 1 month. Banks give the loans, but the process of processing the loan is like too much. The processing of the loan is too much. You have to be told to bring how many guarantors, and the interest rate, I find it so high than SACCOs and these other small scale loan givers.
The role of FSD Kenya for HSNP was that of a payment service manager. And that included, to start with, the design of the payment solution. So both in the first phase and the second phase of HSNP, FSD was the one designing the payment solution.
The role of FSD in developing a solution for HSNP began with what I would call a challenge from DFID, where they asked us to place $20 in the pocket of a person in Turkana on a regular basis every 2 months, and to make it affordable. What we did was we set up what today is known as agency banking. At that time there was no agency banking in Kenya, but with a special dispensation from the Central Bank of Kenya, we were able to set up an agent in Turkana, in Kakuma, and we registered about 500 initially beneficiaries using biometrics, because we wanted to make sure that we were able to positively identify and authenticate the individuals or beneficiaries who are receiving these funds. And also we wanted to make sure that this was a process that could be used by people who are not literate. We then went out and advertised for a payment service provider, somebody to come in and help us to roll out the solution. And out of about 18 applications, Equity Bank emerged as the best candidate. So we're looking for a partner who was really keen to work with the bottom of the pyramid and to continue to develop solutions for the people of Northern Kenya.
In terms of payment processing, FSD Kenya was responsible for just making sure that the payroll was in order, coming from government, and making sure that the funds that were coming from FCDO and also from government in the second phase were processed in good time and delivered in good time. There was also another role around SLA management, that is the service level agreement. These are agreements that were part of the contract, and FSD's role was to ensure that these had been maintained by the payment service provider, both from a beneficiary point of view and in delivery of the payment. One of the things that we did was to do a beneficiary satisfaction survey, basically going out to beneficiaries and asking, are you satisfied with the service that you're receiving? From the payment service provider side, we were to ensure that the payments were delivered in good time, accounts were opened in good time, cards were delivered also within the framework that we had agreed on. Some of the key design principles that we took into consideration, especially in the design of HSNP, were one, predictability and timeliness of payments. In a program such as a cash transfer program, it's important that you get the payments out on time. So in the case of HSNP, we were able to pay on the 5th of every payment month. Another key design principle, I'd say, is keeping personal data of the customer, private, especially in the age of internet, where some of this personal data can be misused for fraud or other things. It's important that you ensure that this is covered. The other thing is accessibility, ensuring that beneficiaries are not walking long distances to get to a payment point was key for us. There was an SLA requirement around making sure that 80% of beneficiaries lived within 20 kilometers of a payment point, which was adhered to.
Hawa mama wakifika, ako na ATM card na kitambulisho. Kwa hizi zote mbili unahakikisha majina yenye yako kwa kitambulisho na yale yenye yako kwenye kadi ya ATM zinafanana. Kisha utachukua kadi uingize kwenye mashine. Ukishaweka itakuitisha kidole. Utachukua kidole chake uegeze kwenye mashine. Kisha ita-verify. Kisha verify utaweka pesa. Ni shilingi 5,400. Kisha toka utamlipa pesa. Kisha tuko na kitabu ya benki, unaandika maandishi. Utaandika majina yake, ile pesa amepata na kuna na hiyo transaction.
Pesa ikikuja, agent inapiga simu. Wanasema wenye wanapatanga pesa ya Lopetuni wanatakana wapate pesa tarehe fulani. Chief kwanza ndio anatangulia. Nasema pesa ya Lopetuni imekuja, itapatikana tarehe fulani. Agent anasema msanya watu wote wakuje tarehe fulani wapate pesa. Nilikuwa napokea 4,000 sijui na 100 ngapi. Alafu wakarudi tena wakaongeza. Saa hii tunapokea 5,400.
Some of the challenges in implementation of the HSNP program is about the IDs, and we saw this when we were opening bank accounts in the second phase. Once we set out to open the bank accounts, we realized about 40% of the beneficiaries did not have IDs, and that sort of set us back in terms of our work plan and in opening those accounts. One other challenge is about getting viable agents at the time when we were starting, because the businesses were quite small, and depending on the amount of money they were paying out, then that could be a challenge. So that was an issue, but currently we have about over 500 agents across the 4 counties that are serving beneficiaries.
The program has had very positive impacts. Each time there's a drought, the household lose assets and poverty increases in those households, because now you've lost your sources of income, livelihood. In the households where we have this program going on, the poverty did not increase as much as it did in the other households that were not benefiting. Regardless of whatever was happening, the shocks and all this, at least they could eat. They could have something to eat because they had cash, they knew the cash was coming, it was predictable.
We have seen economic impact to our vulnerable households. The money that the household gets can utilize from other things. The household can buy foodstuffs. The household can purchase medical supplies for ill household members. The household can venture into small-scale businesses. And that has brought a shift from dependent population to what I may call resilient.
Hii pesa nimefungulia naye kibanda. Nimeweka mabasta, nimeweka unga, nimeweka nini, kila kitu tu iko, hata peremende. Na hii pesa inasaidianga saa zingine natuma kwa shule. Saa zingine kama maneno ya shule ijokuja nanunulia vitu naweka kwa duka.
Evidence shows us that providing cash is actually between 2 to 7 times more efficient than providing food assistance or food aid, which was one of the key objectives of the program at the very beginning. Cash transfers have also been shown to have wider impacts, including on supporting the local economy and supporting the local markets and small traders within the communities that are affected. Use of cash has been shown to preserve dignity of the individuals or the beneficiaries, and has been also shown to have a very positive effect on their mental well-being during a crisis.
Mimi huu mradi umenisaidia sana. Kuna ile commission mimi napewa baada ya kulipa hawa mama kila tarehe 6 nikienda kule benki, na nashukuru Mungu kwa sababu imeniinua. Pia imefanya biashara yangu imeimarika, kwa sababu wakati nilianza kama ka kiosk kadogo, kati ya watu wanapata pesa they buy. Wamefanya sasa niko saizi na duka 2. Pia imenisaidia kwa sasa ninauza retail wholesale kutoka kwa kioski na kupima sukari ya shilingi 10. Saizi naweza pima gunia niuze nusu gunia, niuze quarter ya gunia.
Since phase 1 of cash transfer program, a lot of lessons have been learned. There would be need to complement cash transfers with capacity building. Cash payments are not sufficient to transform people. They solve instant problems, but if we did capacity building, then we could put the beneficiaries on a path of self-sustainability.
So in terms of lessons learned is having the community support the project, because initially when we went into northern Kenya, there was a lot of resistance initially to the program. So we brought in, I would call them local elders, etc., to talk to the communities. And once they spoke to them and we got their support, that changed the perception of HSNP.
Sustainability was a key success for us. The original intention was that once FSD exits the program, that the program will continue running. And this has been the case after 2 phases of running or implementing, being part of the project as a payment service provider. We transitioned successfully to National Drought Management Authority, which is now the program or the agency that is running the program, and it's doing so successfully.
Namwambia hii watu asante sana 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 sana. Mwambia hao asante sana. Kama wako na uwezo ya kusaidia tu, tena aongezee sisi pesa, aongezee.
Okay, I think but you can stay here. Good morning again, everybody, and I hope you enjoyed the tea break and feel a bit refreshed after that very intense session that we had to start us off today. So we're now going to have a very interesting session, which is, this is a bit of a new area for us in terms of our exploration of financial inclusion. It's an area where still the data is a little bit nascent in terms of available data on the relationship between financial inclusion and this very important area of climate and environmental risk. So we've got with us today an exciting set of presenters. We have Joe Ugutu from the University of Hohenheim, is it, Joe? Sorry. Hohenheim in Stuttgart, who's with us today. And Joe is really one of the, I would say, the sort of biggest sort of fundies of climate data in Kenya. He's been personally digitizing many of our data sets, which have been in existence since the 1970s, even going back to the 1940s. So he has an incredibly long-term perspective on environmental and climatic change in Kenya, and he's going to give us some of his data today as a sort of a background to a broader paper that he and Michael King from Trinity College Dublin will be doing between now and the beginning of next year. They're going to create a panel data set that merges our financial inclusion data together with environmental data so that we can start to really track those relationships over time. So this is a sort of a prequel to that paper. It's really a background section. But I think Joe will finish with some sort of reflections on implications for financial inclusion from his data. And then we have the Samarkand Research House team with Camilla Chebet presenting a very interesting paper on digitization and how digital financial services can, or the extent to which they can perhaps mitigate or help to manage environmental risks. And again, they're going to be using Finaxis data to draw those conclusions. And then we also have a short presentation from AFI again, which is great because they're really leaders in the inclusive green finance space. So they will be also presenting to us thereafter. And then we're going to have another exciting panel discussion for you. So I'm going to hand over to Joe.
Thank you. Yeah, good morning, everybody. As Amrika said, I was requested to talk about the impact of climate change, environmental change, and how these two things can affect financial inclusion, and then how financial inclusion can also affect them in turn. I work at the University of of Hohenheim in Stuttgart. I'm a statistician there, specializing in artificial intelligence with a focus on machine learning algorithms, but we apply those techniques also in areas like climate change, environment, livestock, molecular breeding, and other areas as well. So today, I just want to give a generalized talk because we are in the process of analyzing this data, Finaxis data. We are looking at spatiotemporal dynamics of these things that are being discussed here. It takes time to get that data in shape because we got it a bit late, so we are not yet ready to go into the data itself. I'm presenting this talk here on my behalf as well as on behalf of Michael King, who's a professor at a professor in Ireland. Okay. Oops. Yeah, so the first point I want to make in this presentation is that when you are talking about products like financial inclusion, it is important to have a clear understanding and to take into account the biophysical template that determines what people can do with the land. And biophysical template, in addition to biophysical template, you can also maybe think about geomorphic template. Somebody said that even the provision of these Finaxis services can be affected by the ability to access where people are living. Some places are just so difficult. So one thing that is important in a country like Kenya is just to look at what are these biophysical controls or template. I mean, what can you do with the land? In this country, it's broadly divided into two types of areas. One is what they call the high potential areas. So this is about, it's just here. Here. Can you see this? I can't even see it myself. Yeah, the green areas there is showing you where the majority of the Kenyan population is living. And these are the places which have high rainfall, and they also have high soil fertility. You will see in the next slides that about 67% of Kenyan population is found in these areas. So the potential of the land for agriculture is high. Water is available there, and so and temperatures are cool. So land-based activities can be undertaken, but of course there are other factors like human population. I mean, the density of the people and the settlements is increasing to a level that makes it difficult to undertake certain types of agricultural or land-based activities. Then that needs to be taken into account. The second type of area is the largest in Kenya. 88% of the country is classified as rangelands in the old language. We could also call it drylands. So these are areas which characteristically they are hot, they are arid or semi-arid. Rainfall is low, erratic, and variable, and so the potential of land for like agricultural production is limited, but they are suitable for extensive livestock production enterprises such as pastoralism and or also conservation of biodiversity and other ecosystem services. So given that, I mean, this 12% can be increased slightly to 17% if you take into account some medium potential areas which account for another 5%. There are 21 counties in Kenya that fall in this 88% we call the drylands or rangelands. And there are 26 counties in Kenya which fall in the green areas. So this sets the stage for what is achievable in terms of agricultural potential if you are considering financial inclusion that is directed or targeting land-based enterprises. Yeah, another thing, of course, here is, which is part of that, is soil fertility. Again, as I said, you can see the green areas there, the very forest green, and then the lime green or spring green. Those are the areas with slightly high soil fertility. Mostly, again, they're confined to the high potential islands, and then there are patches here and there. The large area, which is 88%, is actually also having low soil fertility. So soil fertility is low, rainfall is low, temperatures are high. As a result, this combination is not really good for like very intensive agricultural production. So these things need to be taken into account in deciding where to target what kind of financial services you want to offer to the people. Yeah, the other thing, of course, is the human population. That is really significant. This is the human population distribution in Kenya. What is mapped here is the number of people per 25 kilometers square, grid cells, throughout the country. This, I think, was the second survey that was done in Kenya. The first one was done in 1948. So we have mapped all of them from 1948 to 2019, and you can see the high potential areas of Kenya. The red areas there, at that time already, had a lot of people, very high density of people, and so, which means that intensification of land use in terms of things like cultivation and so on was already taking place at that time. In the other places, the arid and semi-arid areas, there was still a sparse distribution of people, And that made it possible to undertake things on an extensive scale, such as pastoralism, wildlife conservation, and other things as well. So again, the number of counties involved in this is also displayed here. So as the population increases, the opportunities that will be available, I mean, the high population will present great opportunities for financial inclusion because there are more people who you can target. But then again, the kind of things they can do, particularly those which are focusing on land, will be constrained by the people themselves. Secondly, of course, what these people are doing on the land, if they intensify land use, then that will also have impacts on the land, both for the environmental health and may also, as a result, affect their resilience to climate change. Now, I've jumped other surveys which have been carried out in Kenya from 1962. This is the last one, the latest one, 2019. You can see that those areas which were sparsely populated in the drylands in the early years now are much more densely populated. The population around 1962 was about maybe 8.65 million people. But by 2019, I think we were approaching about 50 million, which is 47.6. And the distribution, you can see there that 67.1% of these people were actually concentrated in the high potential counties, the 26 of them. And the remaining 32.9 are found in the 88% of the country that is having low potential. So the people are increasing there as well as in the high potential areas. And it is important, I think, in any consideration, even when you're looking at the low potential areas, to pay attention to what is happening at this high potential area because of the spillover effect. Because when people become so many, they're going to look for land outside of those areas as well. And when they go there, they take a lot of kind of activities there. Now, the next thing I want to show you is how the trajectory of human population evolution in Kenya, in Uganda, and Tanzania, just to give you a sense of what it is in East Africa. And you'll see from that the future presents both opportunities and serious challenges as well. If you look at this figure here, you can see the blue line is the historical and projected population evolutionary history, where it's going to go in the future. And the dusty green line is for Uganda, and then the red line is for Tanzania. Now, you can see that the projections for the year 2100 is that Kenya will have about 150 million people by that time. And then Uganda will already surpass Kenya before even 2050 in terms of population. And Tanzania is projected to have 300 million people by that time. And already, I think they did a census this year, and I think it was just this month. The results are indicating that Tanzania already has 61.5 million people. So it's already overtaken Kenya. Now, this will present considerable opportunities for financial inclusion, but you can also see that there'll be serious challenges in terms of the impact these people will have on the land and the demand for food to feed them, and so on and so forth. So these things need to be taken into account, and it is also important to note that this population growth is actually exponential, so it's really growing. And because most of the people who will make it grow are already born, and so we expect them to have children, we will expect, this population is difficult to slow down. I think the Kenyan population, for example, doubles nearly every 20 years. So in the next 20 years, we expect almost a doubling in that. Now, what is an example of the impact of such a population? I took just one slide for the Athi Kapotiei ecosystem. Sometimes people refer to it loosely as Kitengela. It's this ecosystem bordering Nairobi. Nairobi National Park is part of it. We have looked at what has happened to that system from the 1800s to date. And this is a map based on what we did there in 2005, 2006. I was working as a scientist at the International Livestock Research Institute at ILRI. We did this with the communities there. We found that there were 15,000 fences that had been erected in that region at that time. there were so many settlements. There were many quarries for stones and for gypsum for making cement. The quarries are so big. I was there actually about 2 weeks ago. And there are so many that most of the landscape looks like you are just walking on the surface of the moon. They are not filled in there. So it's a lot of changes there. And I think as people look for places to build houses and buy land, Nairobi is getting so expensive, they are expanding into that area. So this area once supported one of the most spectacular wildlife migrations in East Africa. If you look at the descriptions by people like Joseph Thompson when they passed there in the 1800s, there was such a massive numbers of zebra and the wild beasts and gazelles. They shot them till the guns fell too hot, they just dropped them. It was not possible to eliminate all of them. There were just so many, if you look at those accounts. And we've collected all of them from the archives from the 1800s. So we are talking about what we have studied in detail over the last 10 years. So if you look at this place here, it's really damaged. I mean, there's extensive land transformation like that. One of the essential ecosystem services like wildlife migration has collapsed there. In fact, the collapse happened in 1999. The wild beasts used to come from Kajiado and Amboseli into Nairobi National Park and out. Now that is not going anymore. From about 30,000 animals in 1977, when monitoring began, we now only have less than 250, and they're not moving anymore. So just a matter of time before they really did you. So what I'm trying to say is that the changes taking place in this system are so fundamental and dramatic that they really constrain the opportunities for many things, like the natural water cycles, the clean air services, biodiversity, essential things that we need to have a functioning ecosystem. And to go to when you have money, I mean, even if you invest money and you become rich, you need to go somewhere to have a green space. You need breathing lungs for the city, but that is now gone. So what I'm saying, as human population increases, this will become a common feature of what you will see in the landscape. When we did this map in 2005, 2006, we thought that this was unique to Kitengela and that places like the Mara were safe. But now, as we're speaking, we are writing a paper we're going to release soon, which will demonstrate that this thing actually has spread to the Mara. And the reason Mara survived may perhaps just be because of the distance of the Mara from Nairobi or a major city. So this is what's happening in the Kenyan landscape. This area was already declared as an endangered ecosystem. And so I think it can be said that it's no longer now functioning as a natural ecosystem anymore. We are writing a paper about it, but that paper can be said more to be an obituary of an ecosystem than describing how it is functioning. But that's the truth. Then I want to show you, because we're talking about climate change, we need to demonstrate how the climate really has been changing. So here I have some samples of historical patterns that we have analyzed for the Lake Victoria Basin, the first one on the left, and then for Kenya, Tanzania, all those countries which form part of the Great Lakes region. You can see that based on actual figures from 1920s to date, that the temperatures are going up. And here we're looking at the maximum temperature. So the temperatures are increasing steadily, and in some places they've increased by maybe 1 to 3 degrees. And I'm going to show you also later on how we have projected these temperature increases under 3 different scenarios to the year 2100. So what we're having now is warm, but it will be much warmer still in the future if any of those 3 scenarios we are looking at will come to pass, and if policy and action does not change the course of what is anticipated. So this is the same for all of them. If you look at the minimum temperatures, actually, this is the component of temperature that is increasing even faster than the maximum. I've done similar analysis even for Kruger Park in South Africa and across Kenya, and the pattern is the same. Temperatures are warming all over this place, and it's warming very fast. For example, in Narok County, for which we have data from June 1913 to date, and we have looked at that data and verified every single data point against the original ledger book, which was recorded with handwritten record from that period to now. The temperatures used to be around 7 degrees Celsius minimum in 1960, the minimum temperature. Now the minimum temperatures in Narok are 11. And very soon, they're going to go up to 14 and then 18. So with that kind of temperature, what happens is that evaporation rate becomes high, so the surface becomes dry. The vegetation then desiccates and dries out over time. So the water available for wildlife, for people, for crops, then reduces over time, and conditions become more difficult. Now, if we look at the future, we're forward-looking. Here, we're going up to the year 2100, and we have averaged 30-year, blocks of 30 years for 2030s, 2050s, and 2070s. So that takes us from up to the year 2100. We are looking at 3 scenarios here. We call them representative concentration pathways, which gives you an indication of carbon emission. The RCP 2.6 is the best scenario, and RCP 8.5 is the worst one if you don't do anything and we continue on the path that what we are doing now. If policymakers do not act now to change things, so you can see that some places will increase by up to 4 degrees Celsius relative to what we have right now. And this is the maximum and the minimum. So both from above and below, things are getting pretty hot. And of course, we've looked at rainfall as well. We don't seem to see a directed trend in rainfall, but we see increasing variance. So it's the variability in the rainfall and the change in the periodicity that we are seeing there. Now we can now go back to something that has got more direct relevance to FinAccess here. The first one is that just to make 3 points here, that making finance available to people can actually, in some instances, increase environmental as well as climatic risk if certain conditions are not taken into account. One example is this insurance instruments, which is index-based. And for example, at ILRI, I think one was implemented in northern Kenya in Marsabit for over 10 years now. And if this instrument is not well designed to take into account climatic risk or environmental risk, then they can have an adverse effect. We have seen that this can promote restocking, because herders are now able to buy livestock soon after a drought like this one. When they do that, the vegetation has no opportunity to regenerate itself, and therefore it gets degraded over time, and then the habitat becomes worse and worse, and then the system becomes much more sensitive to the impact of climate. So even if you have a drought of the same magnitude, it will have a greater impact under those conditions than otherwise. And a second situation where FinAccess can increase environmental and climate risk is if it's used to stimulate investments, and these investments then stress ecosystems which are considered fragile. And this only happens mostly if planning is not accompanying this kind of investment. So people can then end up extracting like a lot of water, like along the Mara River, denying wild beasts and migration access to this water. People can expand cultivation into Kilimanjaro, which is supposed to be used by migrating wildlife. People are constructing fences which block migratory pathways, for example, for wildlife. And in Kajiado County, which is neighboring this place, our calculations show that the length of fences there is now about to exceed the circumference of the whole Earth, 43,000 kilometers. And still going. So these are scary statistics. I'm not here to scare you, I'm just telling you how it is. So if you can promote in those kind of areas extensive livestock production, and then FinAccess can also increase livelihood risks in environments which are variable. And if you give credits to people to do intensive cultivation in areas which are experiencing frequent and severe droughts, and this can result in long-term asset depletion. We know many farmers who have taken big loans to invest, like in wheat farming. When the rain fails, like now, they're forced to sell their land and everything to service the loan, and they become poorer than when they were at the beginning. So it can increase poverty as well as create wealth. And then lastly, it can, if FinAccess is applied intelligently and with appropriate safeguards, then it can actually reduce these risks So an example is it can support livelihood diversification, which is taking place like in these arid rangelands we talked about. And in those rangelands, there are things like businesses, small-scale manufacture, and the education of the youth, especially the women and the youth in these areas are exploring various kinds of things as livestock die, for example, due to climate change. And the youth and the women often don't have the livestock, they don't have the land, so they can do this kind of things. And FinAccess can help them to diversify their livelihoods and have a decent livelihood there. Alternatively, or in addition, if you can incentivize adoption of technologies which are appropriate for sustainability and productivity in this kind of areas, then you can also create conditions which lead to enhanced environmental health as well as reduced climate risks. Things like water harvesting, solar drip irrigation, and even also breeding technologies, molecular breeding for livestock, for plants, and supported also, for example, by artificial intelligence, like even computing algorithms. And then lastly, you can integrate this FinAccess with proper planning and appropriate or scientific management of the land so that the land is not destroyed as a result of investment, or the people are not encouraged to invest in places which are fragile or important for sustaining natural ecosystem processes such as water cycles, animal migrations, or vegetation. So all this needs to be taken into account. It's not just making the money available to people and making profit, it is also sustaining the environment in which you live. And I leave you with a remark that after looking at the history of investment in these pastoral lands, in Kajiado and Narok in particular, from around 1800 to date, I found that so many industries which had been created there, cooperatives, investment in ghee and milk, they all collapsed because of climate change. We need also to learn from history and then improve our system. Thank you very much for listening.
Thank you very much, Joe. That was hard to listen to, but probably very salutary. I think sometimes when we focus a lot on our sort of specialism, which in this case is financial inclusion, we sometimes fail to pay enough attention to the broader context in which our markets are operating. So that was actually very, very useful. Thank you very much, Joe. I would now like to call Camilla, who's going to focus us back into the FinAccess survey to see what we can learn from the survey with respect to climate risk and financial inclusion. Thank you, Camilla.
Thank you, Amrik. My name is Camilla Talam. And firstly, I wanted to say that the work that I'm going to be presenting broadly on digital financial services and climate risks is part of work that has been undertaken by a larger, strong team. I just want them to stand as I appreciate them. Dr. Anne Kamau, Dr. Samuel Kiemo, and Irene Rogiri, future doctor. My former colleagues at the Central Bank of Kenya. So our FinAccess Deep Dives just aims to understand populations that are vulnerable to climate risks and the role of digital financial services in helping them to better manage their climate risks. My presentation will provide very basic context of climate risk context in Kenya. Joe has done a very good background in the way of the climatic effects in Kenya and the region. I will then be discussing stylized facts, dwelling on the climate vulnerable population and their usage or lack of usage of financial services. This will then form a background of our research question and the methods that we applied. We'll draw on the findings from both the qualitative and the quantitative research that we've done, and then we'll conclude with some policy recommendations. So the data that we're going to be looking at is Finaccess data, and all the metrics will be for the adult population, those aged 18 and above. So Kenya contributes 0.05% of greenhouse gas emissions, but it is disproportionately impacted by climate risk events. In fact, according to German Watch, which derives or measures climate risks for 180 countries, climate risks in Kenya have actually been rising, and Kenya now forms part of the 25 countries who are highly vulnerable to climate risks, either by facing a great impact of the climate shocks that they incur, or facing more frequent climate changes. So when we look at the average credit risk index for Kenya between 2000 and 2019, Kenya has moved up 9 spaces and is actually facing greater climate risks compared to its counterparts in the region. As a result of this, KNBS, in a report in 2018, estimated that Kenya lost 8% of its GDP for the 5 years to 2018 due to the frequent droughts, with the most recent one being in 2017 that had been experienced over that time. Annually, they estimate Kenya loses 2.8% as a result of flooding and the destruction caused by flooding. The impact of climate change in Kenya is not only directly but also indirectly. Empirical evidence finds that temperature variability and rainfall variability actually lowers agricultural productivity and feeds into food inflation. We've seen food prices being significantly driven by climatic shocks, both globally and domestically. For example, in the past 2 years, coffee prices have been high, while wheat prices have been high prior to the Russia-Ukraine conflict as a result of poor climatic conditions experienced globally. In Kenya, food is the main driver of inflation, and this disproportionately affects the vulnerable, the poor, who spend a large proportion of their income on food. And digging a little bit deeper into the Finaccess data at the household level, we find increased incidences and impact of climate shocks. So in the Finaccess cycles from 2006 to 2016, climate change has been measured in 2 ways. Between 2006 and 2016, the Finaccess data actually looked at climate risks that were likely to impact households, meaning impact them in a large way, impacting their finances in a large way. The measurement then shifted in 2019 to 2021 to capture the proportion of households in Kenya who actually faced a climate shock. And from these 2 periods, we see a rising trend in climate risks as perceived by households between 2009 and 2016. And we see an increase in the incidences of climate shocks between 2019 and 2021. And drilling deeper, we see that climate shocks are actually affecting the most vulnerable who bear the burden. Looking more closely at the 2019 to 2021 data, drawing your attention to the graph on the bottom, out of the 2% more populations who faced climate shocks between 2019 and 2021, 25% more had to manage climate risks in a way that was welfare reducing, meaning they had to either sell assets, get additional work, or cut back their expenses. And we're now wondering who are these vulnerable populations who had to incur and bear the burden of climate risks. And from the FinAccess data, we find most of the vulnerable populations who are impacted by climate shocks, all the way from 2006 to 2021, were mainly the agrarian community and rural residents. So already there is intersectionality because those who are involved in agriculture or who derive their main income from agriculture form a large proportion of the population in Kenya, and they also form a large proportion of the rural population in Kenya. And we see from 2006 to 2021, 52% of respondents who derive their livelihood from agriculture faced a climate shock, compared to the counterparts, 30% who did not face a climate shock. And if we compare this to those who derived income from other sources, we see the population that did not face a climate shock was actually higher for all other segments except those involved in agriculture. Similarly, between the same time period, 81% of rural residents faced a climate shock, compared to 64% of their counterparts who did not face a shock. Other vulnerable segments of the population were women and those in the lowest income quintile. There is also intersectionality here because women are actually form the largest proportion of those who derive a livelihood from agriculture. And although the numbers are on the margins, women were faced higher incidences of climate shocks compared to their counterparts in the entire population. The poor were the most vulnerable to climate shocks and risks. Approximately 1/3 of the poor faced a climate shock compared to those in the lowest quintile who did not face a shock. And when we compare with the rest of the wealth quintiles, the populations that did not face a climate shock were actually higher. And now that we've narrowed down on who the climate-affected populations, we would like to understand a little bit more about how they were using financial services. And from the FinAccess data, we find that these climate-affected populations were more excluded than the general population. And just starting on DFS, looking at the prerequisite for accessing digital financial services, for example, mobile money, we see that mobile ownership was 18% lower for these climate-affected populations than for the rest of the population. And feeding into this is formal access, which was 20% lower for these same respondents compared to the rest of the populations. So climate-affected populations are already vulnerable, meaning they're already more likely to be excluded, but facing climate shocks adds a disadvantage to them. And looking at what financial services are available to help households in general to manage climate shocks, we see that the penetration of traditional finance has been low. Firstly, looking at agricultural insurance in general, insurance penetration as a proportion of GDP has been low, but it is encouraging that this has been growing from 0.3% in 2014 to 0.8% in 2021. But this is significantly low because it's less than 1%, meaning insurance premiums only account for 1% of GDP. Drilling further into agricultural insurance, we see that it is an important way that helps households to manage or respond to climate shocks. I'd like to draw your attention to the table on the left-hand side. Here we find that crop and lifestyle insurance has actually been rising from 2014 to 2018. But the most interesting message from this chart is that during periods of adverse climate events, such as the drought that was experienced between 2018 and 2019, and other adverse conditions experienced in 2018, the proportion of claims actually increased fivefold. And similarly, the payouts increased at a similar rate, meaning agricultural insurance is actually responding and helping households to manage shocks, particularly for those who take it up. On the other side of finance, we see that there is underinvestment in credit to agriculture that would support sustainable agriculture, as well as underinvestment in finance that would support climate adaptation. So I'd like to draw your attention to the table, to the chart on the right-hand side. And here we see that the trend of agricultural credit, the one in green, has been declining from 2010. It remains below 10% and below the average private sector credit, indicating that there is underinvestment in supporting the agricultural sector. And then other measures of financial products that the households or vulnerable populations could draw on to finance climate adaptation technology, such as renewable energy sources or water conservation equipment, in the way of credit to private households or credit for consumer durables. These are in orange and black respectively. These have actually been declining, and credit to consumer durables actually remains below general private sector credit. So from here we see that there are limited financial solutions that can help households in general, not just those who are vulnerable, to manage climate risks. So a gap exists in the market. And from these gaps, some very innovative firms have come up with products to help respond to these. I wanted to speak briefly about 4 different products that have emerged, leveraging on digital financial services. One focuses on renewable energy, which is M-KOPA, while the other focus on insurance. So M-KOPA, in its lifetime, has provided over 1 million solar panels or solar systems to 4.5 million people, and this accounts, in terms of monetary terms, to about 600 million of credit that has been forwarded to those in need. And then for looking on the other side of insurance, which is Kenya Livestock Insurance Program, this actually specifically targets a niche, which is pastoralists who tend to be very remote and more likely to be excluded. This program benefited 20,000 households, dispersing to them 1.3 million to support them after they faced drought. Kilimo Salama is an index-based agricultural insurance. It leverages on mobile food technology, and it's benefited 73,000 farms in Kenya and Rwanda. And finally, Pula has partnered with a traditional insurance firm to insure over 13,000 households, dispersing to them 85 million to help them mitigate the damage from losses during the recent poor rainfall between March and May 2021. Although these numbers are encouraging, that there are innovative products that are out there, you can see from the impact that they're only scratching a surface from the 27 million adults who are in need of these products. And this lays the foundation for which we want to investigate our question. And our question is basically looking for answers as to whether there is a scope for digital financial services to help vulnerable households to manage their risks when they face them. And here we are applying both qualitative and quantitative approaches using the 6 cycles of data all the way from 2006 to 2021. The quantitative model is a Probit model, and in our Probit model, basically we want to predict households' uptake of DFS and other financial services for those who face climate shocks. So we want to see whether, if you're a household, if you face a climate shock, are you more likely to take up DFS, or what other financial product are you likely to take up? And this is supplemented by qualitative assessment of the same data, looking at some of the climate risk trends, how these have been changing over time, to draw on the impact of DFS over time. So the first finding indicates that insurance uptake has remained low for the climate-affected population relative to the total population. Firstly, it is encouraging to see that more than half of those who took up insurance in the entire population were actually farmers. So this indicates that farmers are proactively taking up financial services to help mitigate their risks. However, we see that gaps still exist. Insurance is actually the lowest for the poor, meaning the lowest wealth quintile. And we can see this from the graph on the left-hand side. We see that insurance usage has remained constant and low for the lowest wealth quintile, while insurance has been declining for rural residents. And as we identified before, these are 2 out of the 4 vulnerable populations, meaning they are more likely to face climate shocks compared to their counterparts. And when we dig down a little bit further to understand the lack for insurance, or know why these populations are not taking up insurance, the main reason that comes up is the high cost of premiums. It is encouraging to see that there is appetite for insurance, as we can see from the chart on the right-hand side. Those who indicated that they would like to take up insurance but could not afford it has actually been increasing from 2016 and 2021, and they comprise the majority of those who do not have insurance. And it's also encouraging to see that some of the efforts to increase uptake have actually been bearing fruits. For instance, we see that insurance awareness has actually been increasing because only 14.3% of those who do not have insurance cite it as a reason. And more people are starting to see the benefits of insurance because only 3.1% don't take up insurance because they do not see the value in it. But we know that behind these numbers, there are various factors that might be intertwined as to why people are not taking up insurance, even though they need it. And one of this is drilling down further into the financial literacy metrics. Here we see that looking at those who are aware or know about the cost of using financial services, we see that the gender gap and the rural gap are reflected, meaning those who are more vulnerable are less likely to be financially literate. They're less likely to understand, for example, the cost of taking up insurance. There might be other issues of financial capability, meaning they might not have a positive attitude towards taking up insurance, or they might perceive it to be highly costly than it actually is. And then looking a little bit deeper into the latest data in 2021 to understand what solutions those who were affected by climate shocks took up as a way of managing their risks, we see that 61% of those who are affected by climate shocks did not have a way to manage these shocks, so they either waited for government assistance or they did not do anything. It is encouraging to see that 31% relied on financial solutions, and out of this, 13% were obtained digitally, indicating the positive DFS effect in helping to mitigate these risks, but we can see the gap still exists. And looking at the other element in terms of finance that is available to finance climate adaptation, which is a proactive way to manage climate risks, we see that there is low investment in green energy, particularly for farmers. From the FinAccess 2021 data, we see that only 6% of farmers invested in green farming technology, for example, renewable energy or water conservation equipment. And out of this 6.2% who did invest in this type of green technology, majority of them relied on income from either their salary or a business, and formal credit only accounted for 15%. This indicates that there is still a gap in climate adaptation finance, not just for the big firms, but also for the vulnerable populations. And then now moving on to the quantitative analysis, our Probit model confirmed the rise in insurance uptake as a result of climate shocks. Here we find that when we looked and we tried to predict the proportion of the population who would take up or who would be formally included if they face a climate shock, we see that this population is higher compared to the population who would be formally included if they did not face a shock. And this has a positive impact both on increasing formal and informal financial inclusion. And the main product that would drive uptake would be insurance, and this confirms some of the FinAccess data that we just discussed previously. When we compared this to the FinAccess trends, we see that over time, the uptake of formal financial inclusion has actually been higher relative to the general population that was not affected by climate shocks. And so here we're just looking at the chart on the right-hand side, comparing the informal climate-affected population to the informal general population. Similarly, the Probit model also confirmed a positive DFS effect, increasing financial inclusion, particularly for the climate-affected population. So we see populations who are impacted by climate shocks and use the DFS financial service were more likely to be formally included than those who did not face a climate shock despite using mobile money. And we see a more positive effect in increasing bank usage. This is corroborated by the FinAccess data. And here we see a faster rise in mobile money uptake. I'd like to draw your attention to the table on the right-hand side, where we see between 2009 and 2021, mobile money uptake increased from 15% to 88% for the climate-affected population, which was significantly faster than for the general population. Excuse me. And we also see insurance has actually been increasing at the same rate for the climate-affected population relative to their counterparts. So in the way of conclusion, we see that vulnerable populations, those who are already more likely to be excluded, are more likely to face negative climate shocks. And these populations are women, the poor, rural residents, and those who depend on agriculture as a form of livelihood. We see that uptake and penetration of financial services has remained low. And the main reasons for this have been cost, suitability of products, an element of financial literacy and maybe financial capability, and the availability of services in general. And we see that the capacity of these vulnerable solutions to take up mobile money or any digital financial services has been hampered by lower mobile money ownership, which is a prerequisite for using DFS. And this has had an impact on reducing their formal inclusion relative to the rest of the population. A quantitative assessment confirms that households who face a climate shock are more likely to be formally included, meaning they're more likely to reach out for a financial solution. And we confirm that DFS has a positive effect as a driver of this form of financial inclusion, particularly if paired with the insurance. Excuse me. So we conclude that facing a climate shock is an impetus for increasing financial inclusion. And one of the key drivers of this is DFS. In the way of policy recommendations, we find would like to recommend 4 policy recommendations. Firstly is on the supply side, and this is to encourage financial services providers to develop targeted and suitable products targeting these vulnerable populations. And so we are encouraging them to provide affordable products, accessible and usable financial products. We're encouraging them to increase awareness of their financial offerings and to illustrate their benefits to those who they're targeting. We are also recommending that they pair this with tailored financial education initiatives, and this may help to build financial capability of the vulnerable populations so that they can understand and build positive attitudes towards embracing financial solutions that can help them to mitigate their shocks, particularly climate shocks. In the way of the demand side, these are those targeting the households themselves. We are recommending for interventions that target vulnerable populations, particularly increasing mobile money ownership and initiatives or interventions that help to build their financial capability, enabling them to use their financial awareness and financial literacy to make decisions that positively impact their financial lives. We're also calling for an increase in awareness of other ways to combat climate shocks. We know that finance is not the only way, and a lot can be done in attitudes that help to protect the environment. But in the way of a financial solution, financial service providers could allocate more of finance towards financing climate adaptation that are targeted at vulnerable populations. For example, enabling them to purchase renewable sources of energy such as solar energy, enabling them to invest in equipment that helps them to conserve water, and this may help these vulnerable populations to take preemptive steps to mitigate the climate shocks and not just rely on solutions after the fact. Thank you very much for your attention. I welcome your comments, and I look forward to the discussion.
Thank you so much, Camilla. That was fantastic. It's really great to see the Finaccess data being used so richly to address this very, very important question. We haven't really done that with Finaccess before, so thank you for really opening the way for us there. Now we're going to have two more short presentations which are really just speaking to the enabling environment for green finance. First of all, we're going to have Dr. Molly Ochuka from the Adaptation Consortium, who will talk to us a bit about an enabling inclusive green finance for county governments. And then we're going to have Mr. Dieter de Schmet, Policy Manager for Financial Inclusion Strategies at AFI, and he's going to talk to us on effective financial inclusion policies, regulation, and national strategies for promoting inclusive green finance. So that's kind of the national kind of perspective on this enabling environment. And then Molly will really give us the perspective from the county level. So I'd like to invite Dr. Molly, please, now to give us her comments, her presentation. Thank you.
I think you're on mute. Is she? Try talking again, please. We still can't hear you. All right. Dr. Molly, please disconnect and reconnect.
Can you hear me now?
Yes, we can. Yes. Thank you.
Okay. So, sorry about that. Okay, thank you so much. I'm honored to be part of this conference. I'll be making a presentation on enabling inclusive green finance for county government. So globally, data has become a fundamental aspect in making informed and evidence-based decisions. The government, the private sector, CSO, community, and households need relevant and timely climate data for making informed decisions in planning and implementation of the priority areas. And for effective operation of such data, we found that we'll need this climate data to be anchored on a specific ecosystem, and we have the climate data ecosystem. Climate data is increasingly becoming important in the wake of climate challenges facing the world today. Harnessing climate data has been a priority since the launch of the Sustainable Development Goals because access to quality and use of data is imperative for informed decision making. FSD Kenya supported Adaptation Consortium to pilot a project with the Makueni and Wajir counties aimed at strengthening climate data ecosystem. This is expected to contribute to data-driven decision-making on climate response and sustainability investment at community levels and also household levels. The The climate data work builds on other FSD Kenya work on County Climate Change Fund mechanism, a framework that facilitates access to climate finance. So this is an outlay of how the fund mechanism operates, and it operates right from the grassroots. We have the community operating through the World Climate Change Planning Committee, then with the technical support from the County Climate Change Planning Committee. Whatever decision that is made for public good investments is an involved one, involving both parties. So it's actually inclusive in that manner. And then we have the funds that are channeled into these investments generated from various financiers. We have the donors, we have the treasury, we have the global aspect, and also we have other sources as indicated. I can't see clear it well. Yeah, thank you. So we have 4 major components for the operation of the climate change fund mechanism. We have the fund, we have the county and ward planning committees. So the ward planning committees are the link between the county and the local communities. Then we have the climate information planning services and public participation. Then we also have monitoring, evaluation, and learning that is keeping check on the operations of this mechanism. So the rationale for the operation, rationale for FSD initiating this work through the adaptation consortium is that you find that in most cases the existing climate data ecosystem are so much fragmented, and then there's lack of information also hinders the climate resilient investment. Then we need also a robust climate data ecosystem to enable the interpretation of climate information in a way that is consumable by the users. So I found that the current work that we are doing now in Makueni and Wajir aims at strengthening the climate data ecosystem for informed decision making. So at also level also, it will enable the financial decisions such as uptake of loans and insurance, thereby enhancing financial inclusion. There are 4 major objectives of the climate data ecosystem: to assess, test, and foster the usage of climate relevant data. Secondly, we have support counties to promote generation and use of climate relevant data in decision making. Thirdly, we have linking counties to existing sources of relevant climate data and information. Lastly, we have engaged in local community to use climate data towards resourcing resilience to climate change. So these are the key achievements that have been realized from our activities that is ongoing. We have 18 counties have enacted the CCF legislation, 13 counties have validated community climate information services plans, 11 counties have established climate change planning committees, 11 counties out of 47 counties have strengthened the county integrated monitoring and evaluation system, that is CIMES. The CCCF mechanism curriculum has been developed and domiciled at the Kenya School of Government. Then 30 TOTs have been certified by Kenya School of Government. Then CCCF is still being scaled out across the country, and hopefully we have a vision that all the 47 counties will be covered in the long run. Then with the financial inclusion and climate data aspect, we have the integrating climate issues into the county integrated development plans provides an opportunity to access finance. So currently, as at now, we've achieved some policies at the county levels in Wajir. 2% of the development budget is allocated to climate change fund action, while in Makueni, we have 1% of the total county budget is allocated to the climate change action fund. Then the legislative structures and climate data ecosystem framework provides opportunity for counties to attract funding. So the work is still ongoing, and several gaps, opportunities, and strengths have been identified and we have already some policy recommendations. So the county policy makers should facilitate mainstreaming of climate change into county policies and projects. The public-private partnership for inclusive investment. There should be integration of scientific and indigenous weather forecasting to ensure co-production, co-designing, and co-sharing of climate data. And also need building data capabilities and skills for counties to generate, analyze, interpret climate into solutions for communities. There's also need for expansion and mainstreaming of climate data into CIDP plans across all the 47 counties in Kenya. There's also need to enhance the communication of climate information into a layman's language, a local language that can be understood by the local community to ensure that the climate information or data is not just received, but also utilized to enhance resilience to the impacts of climate change, the community, and at household levels. Thank you so much for listening, and have a nice day.
Thank you very much, Dr. Molly. That was really great, actually, because that really shows us that now there is stuff being done at the local level to bring data to bear on actually stimulating investment in climate adaptation and climate resilient investment at the county level. So I think that's really, really important. It somehow relates very well to what Joe was speaking about in counties like Kajiado. And in fact, we have some representatives of county government in the room actually today with us from Meru, Nyeri, Kitui, and Wajir. So I just want to really appreciate them and thank them very much for attending, because it is so important. You guys are at the forefront of change, really. And now, sort of moving up to the national and even global level, I'd like to welcome Dieter de Schmidt from AFI to speak to us on national climate strategies and enabling environment.
Thank you very much, and I hope everybody can see my PowerPoint slides properly. So first of all, thank you very much for inviting AFI to be present here today virtually and discuss this very important topic. My name is Dieter de Schmidt, and I'm the Policy Manager for Financial Inclusion Strategy at AFI. And today, for the next 10 minutes, I will be presenting on the topic of effective financial inclusion policies, regulations, and national strategies for promoting inclusive green finance. So when we're talking about inclusive green finance, we're looking at the link between green finance and financial inclusion. Climate change and environmental degradation affect vulnerable groups disproportionately, and this leads to social inequity and tensions, which in turn affects financial stability. It's important to define inclusive green finance, and at AFI we define it as policies and regulation that aim at enabling mitigation and building resilience to the negative impacts of climate change through financial inclusion. And this concept is of course linked to savings, credits, insurance, and payment systems. And as a cross-cutting team, we have digital financial services, which are increasingly more important to enable the spread and use of savings, credits, and insurance, as well as humanitarian assistance after extreme weather events. So when you think about positioning IGF policies in your NFS, we recommend using the AFI NFS policy model here on your left-hand side. And this is a very important document since it's a condensation of best practices of developing and implementing an NFS over a period of 10 years, which has been tried and tested across the AFI network. So this basically contains a standardized NFS policy framework with different components that you can choose and select depending on your country context. On the right-hand side, we have a rather recent publication that I developed together with my colleagues from the Inclusive Green Finance Working Group, which focuses specifically on the approaches on how to integrate inclusive green finance in your NFS. So for the purposes of today, I will extract the NFS lifecycle from the left-hand publication and illustrate one of the approaches from the right-hand publication on how to integrate IGF in your NFS. So if you look at the life cycle of an NFS, we can distinguish three very important phases: the pre-formulation, formulation, and implementation phase. All of them are equally important, but they build on top of each other and they need to be sequenced, of course. So the pre-formulation phase focuses on the institutional structure. It's very important to develop a proper, sturdy, and solid governance framework for your NFS. You need to develop your concept note and also dedicate efforts and funds to have proper diagnostics and analysis ready, which enables you to screen for gaps in your financial inclusion landscape. So once you have finalized phase 1, you can move on to the next phase, the formulation phase. And based on all the work you've done, you lay the foundation in phase 1. You can identify the relevant policy actions that you want to take forward. You will devise your implementation plan and also establish very important, the M&E framework, the monitoring and evaluation framework for your NFIS. Once you've completed phase 1 and 2, you're ready to launch your NFIS and you're ready to roll out the implementation of your actions as devised in your implementation plan. As you can see, there's a constant feedback monitoring loop, which allows you to steer the progress of your actions in the right direction so you can achieve the objectives as set out in your NFIS and reach financial inclusion standards as you have predetermined in your concept note. Once the NFIS has come to an end, and typically NFISs have about a lifespan of 4 to 5 years, you will conduct an end-of-term evaluation and you will carry forward the lessons learned into a new NFIS, and the life cycle can start again from scratch. So if you want to integrate IGF in your NFIS, you will encounter many challenges. We sort of listed 4 buckets that we can see recurring on the left-hand side. The first of all is the building consensus. It's really important to establish an acceptable definition of IGF that can be used by all stakeholders. And this can be defined through a green taxonomy, or you can integrate the definition in other green policies that you link to your NFIS. This is extremely important. The coordination mechanism obviously is extremely important as well. Stakeholder coordination really depends on the alignment of policies and definitions used by other government ministries. And you will find that even before you launch your NFIS and even before you want to integrate IGF in your NFIS, lots of other government ministries have different policies and definitions referring to green finance or inclusive green finance. And it's important that your definition aligns as much as possible with what has been done before in order to make sure that you can properly coordinate these stakeholders as well. Determining IGF products then. We see a number of challenges arise here with regard to adopting the criteria that you will need to use to describe and include IGF products from different financial subsectors. So it's very important to keep that in mind as well and develop these criteria ahead of time. Monitoring and evaluation. This is the typical problem of lack of data on climate change impacts, vulnerabilities, and green finance data. And we typically refer our members to the sources here highlighted in green to improve their understanding on climate change mitigation and adaptation and how they can integrate it in their NFIS. But of course, if you have the funding for it, you can also develop your own diagnostics and analysis and mine for data with regard to IGF as well. So what you need to do actually to green your NFIS? Well, one of the approaches which is embedded in the knowledge product I talked to you about just now is the IGF policy frame model. Frame refers to formulation, resource, action, measurement, and evaluation. And the composition of this frame model may be interlinked, cross-cutting, or open sequence, depending on the member institution's characteristics and preferences. But if we go to the formulation part of it, and this is important to point out, briefly discuss the NFIS life cycle. Formulation here under the frame model refers to pre-formulation and formulation under the NFIS life cycle. So here it's important to list, identify, or plan your diagnostics and formulate your IGF activities and plans. And I selected a couple here in the interest of time. It's very important. IGF disaggregated data collection is extremely important here, including climate and financial vulnerabilities. Data will actually inform the IGF barriers. It's going to be much easier for you to identify barriers, challenges, but also opportunities with regard to IGF once you have that specific data. It's also important to think about the target groups that you have and the sectors that you want to involve, and link those with the identification of key stakeholders that you want to line up. They need to push forward the inclusive green finance agenda. So these are extremely important to line up and make sure that they all form one group that pushes forward a uniform, inclusive green finance agenda. I briefly also touched upon the green taxonomy listing. This is important as well. A green definition in general for sure is, and once you have that definition nailed down, you can actually use this for your preliminary IGF vision and mission statement, which then feeds into the concept note during the pre-formulation of your NFIS. For the resource part of the frame model, you need to think about what resources are required. How are you planning to mobilize your resources and for what purposes? We're talking here about human resources, capacity building, refinancing, and even national green budgets. Action then, you need to think about what IGF-related action items are foreseen for the short, medium, and long-term phases and set appropriate timelines if possible. And this will of course tie in with the vision and mission statement of your NFS, and of course the objectives and pillars of your NFS, and link it also to the green taxonomy as set out under your formulation phase of your NFS. Then measurement. When aligning your IGF objectives, set clear measurable targets. What measurement methodology and disaggregated indicators could be adopted in your organization? Segregate measurement indicators from both the supply and the demand side if possible. And then finally, evaluation. Align action deliverables and targets to achievement of status results and means of verification, and identifies those agencies and organizations that will be responsible for evaluating that specific amount of data. So we have a couple of examples here lined up that actually within our network use that frame model. For instance, Sao Tome and Principe, they actually have an IGF pillar in their NFIS, and they adopted the frame model in order to make sure that this is a very sturdy pillar in their NFIS. We also have the Solomon Islands, of course, and Bangladesh. These have been leaders for some time with regard to inclusive green finance, but we also see newer, recently published NFISs, for instance, for the Philippines, that is heavily focused on inclusive green finance as well. So in general, within our network, we see an increasing adoption of inclusive green finance in the NFIS, showing the importance of the topic on its own. So for those who would like to have more information, please go to the website here and download these two publications. And there's much more to dive into, but for the purposes of today and my 10-minute presentation, I'm going to stop here. So thank you very much for your time and attention, and I wish you a fruitful panel discussion. Thank you.
Thank you so much, Dieter. That was really great to have the perspective as well from the national level, and how helpful these frameworks can be in bringing us all together and providing a sort of a pathway to change. Now, I would like us to launch straight into the panel discussion because we're running a little bit late, but I think we still have a bit of time. So I'd like to invite Ansatsa Were, FSD's senior economist and researcher. And I would also like to invite Shalmeet Ngari, from the Nairobi Securities Exchange, and Jahil Oliver from Hello Tractor. And then we have Johanna Nyman, Head of Inclusive Green Finance from AFI, also joining us. Welcome, Johanna. And she's actually at the COP, and she's got another meeting that she's got to go to at 1, so we're actually going to kick off with her. But we're delighted that she was able to join us. Thank you, Ansat.
Thank you, Amrik, and really thank you to all the researchers. I mean, the intellectual rigor in those presentations was commendable, and as a researcher, I got really excited by some of the points that were being made. So I think I'll just start with the panel, and I'll just introduce those who are in the room. Shalmeet Ngari is the Business Development Officer for the Nairobi Securities Exchange that has a lot of interest and active work on sustainable and green finance, including a carbon exchange. And Jahil Oliver is the CEO of Hello Tractor, which uses fintech and digital financial services to better allow mechanization options to improve productivity and the welfare of farmers, particularly in Kenya, and I think more broadly in the region. And then Johanna is joining us from COP27. She's the head of Inclusive Green Finance from AFI. She's the colleague to Dieter, so she'll give us a bit more of a global and national perspective on issues. So I don't know, Johanna, if you can hear us. I'll just start with you because you know, you do have to leave, and we can link quite directly to the point that Dita was making, and indeed some of the presentations. So I think one of the things we saw in the presentations, and by the way, if you see me looking at my phone, it's because my questions are on the phone. It's not because I'm distracted, right? So one of the questions that we do have is that to what extent do efforts to increase financial inclusion impact or affect or encourage the adoption of climate finance? I think we saw some of the presentations allude to that, but I think it would be useful from where you sit to get a global perspective on that, and more specifically, how can financial inclusion metrics, which are very sort of mainstream and accepted in Kenya and many regions, better integrate the integration of climate and green finance considerations to make them more green?
Thank you so much, and really a pleasure being with all of you today. Just first checking, can you hear me okay?
Yes, we can hear you.
Perfect. And thank you so much for that question. And just to start off, I want to congratulate you on the seminar and the workshop so far. And I'm also really happy that this topic of inclusive green finance is now on the agenda as well in Kenya. I want to thank the previous presenters for sharing really rigorous and interesting presentations. And indeed, both of the colleagues in the beginning were stressing the current climate and environmental risks in Kenya. And I think, Joseph, you said, I'm not saying this to scare you, but this is how the land is laying currently. And I think definitely that is what we see from across the AFI network currently. The reality is quite bleak when it comes to projected and in some cases current climate impacts on the vulnerable populations. And that means action is needed right now. As mentioned, I'm coming to you from COP27, and there's a lot of conversations here, especially around adaptation and resilience building and how to channel resources to the most vulnerable populations. So that is my start to answering the question. It's quite crucial to establish financial inclusion, both because access to savings, access to insurance, to credit, to payment systems can in itself be resilience building. It can help populations to cope with both fast onset and slow onset climate change. So fast onset natural disasters, or slow onset droughts or desertification, erosion of the soils, rising sea levels, melting permafrost, etc. But also having access to financial products and services is a way of channeling climate finance to the end beneficiaries, those that are most vulnerable, those that need these resources the most. So in the global context and the global current policy conversations, financial inclusion is taken not center stage, but having more and more of a role to play also in the climate finance conversations, because it's not enough that that finance is channeled between countries, but also within countries to the ones that need it the most. And I'm quite happy to see that this conversation is also happening outside of the normal financial inclusion community. Then when it comes to the very specific products and services that can be put in place, and of course here it's partly financial service providers and partly regulator that needs to be in the conversation and to agree. And it's quite, what we see in the network is it's easy to have a specific intervention saying, okay, let's go for this, drought resistant crops or more better irrigation systems for smallholder farmers. But what we see is it's really important to have a more holistic approach on how to channel resources to the base of the economic pyramid for climate resilience, adaptation, and even mitigation purposes. And I think also we discussed with Amrit a couple of days ago, there have been initiatives in Kenya, in other places in the world, where a very a simple approach saying, let's fix this one issue, actually is more detrimental than helping the vulnerable populations. And what I'm trying to say is there needs to be a national level dialogue to understand what are the vulnerabilities, what are the current climate commitments, what are the environmental commitments, and how can this be translated for the financial service providers, for the financial sector in Kenya. Usually this is done through establishing a green finance taxonomy. A taxonomy is can be very complicated, like the EU did, or can be something more straightforward, kind of listing what are green resilience building projects in the specific national context. So in order to channel resources to the most vulnerable in an appropriate way through financial products and services, I would say a good first step is also defining what what type of interventions are needed in the national context, maybe even on the regional levels, and through that definition then move forward to incentivize or to put these kind of measures in place. I'll stop there and take any other questions.
Thank you. No, thank you. That does provide a lot of clarity and gives us the options on how to approach that. I think I'll just link to you, Jahiel. One of the things that we see in the agriculture sector in particular is that there seem to be certain subsectors in agriculture that are vulnerable to climate change, but also if you look at the value chain of an agricultural sector, there are certain parts of that value chain that seem to be more vulnerable to climate change as well. Sort of given your experience where you're sitting, how have you seen climate change show up in that way? But also what useful tools and strategies are you seeing communities and farmers and obviously yourself use to help address that specificity?
Thank you. It's a good question. So obviously at the production level of agriculture, you find the most exposure to climate change. Excuse me, my daughters gave me a call yesterday. They're testing my resiliency right now. But at the production level where we focus, there's a lot of risk. Climate risk, market price volatility risk, pest and disease. We're here to talk about climate risk. What we've done at Hello Tractor is kind of twofold. First, educate the customer on the benefits of building climate resiliency at the field level. And it could be basic things like promoting ripping and breaking the hard pan. So your root systems can have access to better soil moisture. You can retain more soil moisture. Keeping the crop cover on the field so that you have that layer to block that intense sun from drying your soils prematurely. So there's an education piece. But research, multilaterals, extension has been doing that education work for a while. So we came in at the beginning of the year to start to finance the kind of behaviors that we wanted to see on the back of this research and educational programming that was already in place. And so underwriting towards that behavior change, we saw a meaningful adoption of these best practices. And so in the first 6 months of the year, we financed $5 million, in excess of $5 million of tractors into the market, all servicing smallholder agricultural systems. And over a quarter of that portfolio is doing climate smart mechanization. Now, how did we get there? Because that's a pretty significant number. Oh, and by the way, all the borrowers are unbanked, right? So you're reaching deep into the credit markets, financing unbanked entrepreneurs with $40,000 worth of equipment that's going out and reaching 1,200 plus farmers a year with climate smart mechanization. And we got there by creating financial incentives within the credit program. All of our customers qualify for a loan by simply booking enough demand to absorb the machinery that we finance. It's just that simple. It's enabled by technology, so we can track the work being done, and they pay us for the work that they do. And we have tight rules around making sure you service the jobs that you book. But for those customers that book 1,200 plus farmers for climate smart mechanization, no-till, ripping, those types of activities, we waive the 5% down payment. And so we saw a significant uptick in that adoption, because the person who's booking those farmers have relationships with the growers. They have that relationship capital in the last mile. We can leverage on that to push the behavior change by providing that individual with the financial incentives. And that was successful for us.
Makes sense. And I mean, I think the specificity of incentives is what we see actually lead to that behavior change often. And so, Shalmith, I really want to talk to you about, obviously, green and climate finance is this massive wave that's entered, the Kenyan market. And one of the questions we have is, how is that showing up in the Nairobi Securities Exchange? What are the sort of things that now investors are looking for as they start to integrate green and climate considerations into how they're playing in the market?
All right, thank you, Nzetsa, for the opportunity. It is fabulous to be here and to hear all the fabulous presentations and what Kenya is doing and how the globe is coming together to address climate finance and whatever the effects of climate change are. So within the NSC, we are in the capital market space. And we have a product called a green bond. So lending to institutions such as yours, fellow panelists, to be able to develop their products so that they are in the green space. So we have Aecon that listed on the stock exchange recently, and they did a green bond, and it was actually oversubscribed. And the green bond was in terms of a DREIT. So a DREIT is an instrument in the financial space where an organization can come in and be able to raise funds that will enable them raise up a building, maybe a development project or an investment project in terms of rental income. So we had an Aecon come in, and they were very much oversubscribed, and they're doing well on the market. So in terms of what NSC is further doing, we have been developing the carbon exchange. So that is something that we're working on right now to be able to facilitate carbon credit trading. We have potential customers already there. I think Kengen is already doing some work in the space internationally. And we're partnering with Air Carbon. We've had a lot of engagements with yourself, FSD, and ZETSE, and appreciate that support. And we're just formulating the framework right now and coming up with the work plans that need to take place so that we can have participation taking place as soon as possible. So we're still at the inception phase in that area, and very excited about the government's commitment in terms of climate finance, seeing the partnership that is taking place at the COP27 with Rishi Sunak, the Prime Minister, and our own President William Ruto. So very fascinated about that. Looking forward to more developments in the housing sector also in terms of green buildings and green construction. And yes, there's a lot going on in the stock exchange. One of the things that I appreciate concerning maybe the bottom line, just getting to the bottom line, is the facilitation that we'll have in the future for trading online. So we expect that this can now go down to the masses. So it's not, I think we need to also demystify the stock exchange because it's seen as this big corporate institution where its corporate players come in. But we're looking at making sure that border operators can also come onto the stock exchange and be able to benefit from that. And if we have more green bonds listed, if we have more participation in that space, then ultimately we are playing into the global effect of reducing climate change. So those are my comments.
Wonderful, thank you. It's very dynamic, and I think you're right. If you're not glued into the conversations, then you won't know that. And I think Johanna, if she's still there, I want to ask her one more question. I know she had to leave at 1. So I don't know, oh good, you are there, okay, good. Let me just ask you one more question, because it is something that we do grapple with at FSD, is that if you look at the style of green and climate finance, it's very structured, it's very formal, it has a lot of rigor in terms of measurement, verification, disclosures, and that tends to be quite disconnected from the reality of the vulnerable populations that are actually bearing the brunt of climate change. So obviously informal, farmers, unbanked, as Jill pointed out. So one of the problems we're having is that even though there's this massive appetite to scale green finance, the way our economies are structured for very good reasons, it's just not, that supply is not meeting the reality of how we operate economically. So one of the things we're wondering is, how are you at FI, what useful strategies are you seeing to bridge that? Because obviously the supply won't change very soon in terms of how it moves, and of course the demand side, that's not going to change anytime soon. So how is that being bridged, and what useful things are you seeing there?
No, thank you, and that's really a key question in all of this. I think the AFI network is still early days with several of the developments in inclusive green finance, and as we always iterate throughout the network, there's never one solution that would fit all, so it's all very much up to the national context. Having said that, that's also why financial inclusion efforts in itself, with or without a green component, is really essential to advance resilience building and mitigation for vulnerable populations. So ensuring that there are more people onboarded, but also ensuring that there's more consumer empowerment and also financial education to ensure that the demand side has better tools to use the different financial products and services. So that's the very first point. The second one is that I see a slight risk with some of the discussions globally when it comes to climate risk disclosures and green finance frameworks, and there might be a lot of pressures on green finance reporting from financial service providers that might lead to financial exclusion, and that is a really important question to discuss before we have these reporting, these disclosure frameworks or even international standards in place to ensure that vulnerable populations, as you stressed, that are not formally included, that are not a part of the formal economy, that they are not further excluded by any type of green or climate risk reporting frameworks. So I would say those two are key. One, advance financial inclusion in tandem with green finance developments, and two, ensure on the global, national, and maybe even regional level that any disclosure mechanisms are not harmful to vulnerable populations. I'm going to be very honest, we don't have any ready solutions to share, but this is a lot of conversations and a lot of progress being made throughout the network. So I believe in the coming months and year, there will be more and more insights to share also from across the AFI network. I'm really sorry, I'm going to have to step out right now.
Thank you so much.
But of course, if there's any questions or anything, more than happy to be a part of this conversation moving forward. I really want to congratulate CBK, FSB Kenya, and other partners in the room for taking on this conversation and becoming more active in the inclusive green finance space. And I want to iterate that from AFI's side, we're here to support you primarily through peer support and connecting you if you want and see fit with other regulators from across the network that can share their insights and their current questions and conclusions in this space. But good luck for the rest of the conversations today, and thank you so much for having me.
Thank you for joining us, and have a lovely day.
You.
Have a lovely COP27. One of our colleagues is there with you, so maybe you'll meet him. So I think, just moving to you, JL, one of the struggles that we see in the work that we do with agriculture is how do you deploy finance that obviously makes farming more climate resilient, but also more profitable? Obviously they're linked, but they're obviously not the same thing. And obviously in the work that you're doing with FinTech, what are the things in the ecosystem or in the business environment, what's the one or two things that would make your life easier to make farming more climate resilient and more profitable so that people do it more efficiently?
Thank you. So I would say that the two things that we focus on, number one, is the nexus of climate adaptation and farmer profitability. Our growers are not responsible for the sins of the industrial world. And so when we think about how we introduce and support our growers, we think about it from an income maximization perspective, and on a risk-adjusted basis, that means promoting climate-smart agriculture. Yes, it'll help sequester carbon, but it'll also build climate resilience. So that's the first piece. The second piece was when we launched our tractor finance program, we designed it as a pay-as-you-go product. And we pay very close attention to the unit economics of the grower who has to pay for the service, and the tractor entrepreneur who owns the machine, who's going to earn the necessary profits for take home, but also to repay and service the loan. And the reason that pay-as-you-go structuring was important was because agriculture is very seasonal, number one. Number two, seasons shift quite a bit. And that's happening at a much higher frequency. The predictability of when a season starts and the number of centimeters of rain falling within any given market is anyone's guess. And so being able to structure repayment around when the machine is moving and actually generating revenue versus a fixed term. It really helps our borrowers, and it also ties repayment to performance. And so if you aggregate repayments across the year, you still see a borrower keeping pace on an annual basis, but those payments are very lumpy. And so we use our technology. We put GPS on the tractors. We track exactly how much work is being done. For the data scientists in the room, we use clustering to do that in a very low-cost way. And then that tells us how much is owed to us by a borrower. If you're paying $5 an acre, you do 100 acres in the week, you owe us $500. And you may have made $1,200 total, right? So you took home $700 in profit. So that piece is key. But I think it's important to also point out, and this is always the elephant in the room when we find ourselves at conferences, is that our growers are not very well positioned competitively in the global markets. And our goal is to create a global breadbasket within the region to build more global resilience in our food system. And it's really difficult to do when our borrowers and our farmers don't benefit from the same direct subsidy that growers across every single breadbasket on earth, there's 5 of them, receive. And so, and you're competing for dollars as a service provider, as a technology company, and the dollars that our customers have is much smaller than the dollars that a grower on a per acre basis has in the US or in Russia, Ukraine, or in Eastern China or Northern India or any other, the Canadian prairies or any other breadbasket, Brazil, Argentina. And so we have to keep that in mind as we think about policies. There's always noise around not subsidizing the market, but I don't know if it's a surprise to folks in this room, but agriculture is not a commercial market, okay? And until the other breadbasket regions remove their subsidies, we should be thinking about smart application of subsidy to make our growers more competitive so we can establish our rural economies as not only stabilize the rural economy, but create our region as a global breadbasket, because you saw on the map, right? We have highly productive land. Some of our most productive farmers in our platform map very closely against what the professor showed in Western Kenya, Busia region, all these very wet, fertile soils, and these growers could compete, but they do need support, right? Farmers don't pay for crop insurance. I saw on the previous presentation, it was Pula. I love Pula. I love what they do. That's a public good in most markets. That is not something farmers pay for out of pocket. And you can go down the list. Half the things our farmers pay for come for free, and then you get pricing support on the marketing side. So just an observation that we have.
Yeah, that's a good point in terms of the different government policy tools that need to be deployed to create that change that we're looking for. And I'll just end with you, Shelmith, before we open to the floor for 1 or 2 questions. Obviously, we know there's a lot of excitement about carbon finance and carbon trading. And I think the new administration has demonstrated a lot of keenness in that. One of the questions we're having is, how do we make sure, obviously, we structure what we're doing in a manner that anchors in that appetite, global appetite for carbon finance, but how do we make sure that it actually leads to measurable usefulness to the vulnerable populations and geographies that are present in our economies that, to the point that you made, maybe are not that well integrated in the capital markets? So what are some of the, ideas that you think would help make that connection happen?
Okay. So in terms of developing the carbon exchange, it will create a lot of opportunities for the small farmers to not be able to trade their credits to organizations and need them. And what we're doing is we will begin inward. So we'll begin in Kenya and then grow the market globally so that now the traders will be able to trade beyond Africa and beyond Kenya and beyond Africa. So in terms of the carbon exchange, that's what we are planning. But right now, within the stock exchange, for the ACON listed bond, and of course, let me mention also that ACON is also on one of our instruments known as the Unquoted Securities Platform, where organizations can come in and just list their shares, even though they're not particularly listing on the main market. So it has a little less regulation and it's a bit more friendly. And for ACON, what they did is that they've come together with organizations and they've come together with individuals who are ready and willing to enter into that space of green finance. So they'll be able to come together as a group and be able to list, to be able to buy a stock within the ACON, rate. And you see, already ACON has facilitated green construction. So that is one of the ways that financial inclusion can come in. I think they're using an organization known as VUCA currently to just facilitate transactions through Ordinary Mwananchi. But as I said earlier, the carbon exchange will definitely come in a stronger perspective to be able to allow farmers and other traders just get into the market and trade the carbon exchange. So one of the other things maybe I can mention in terms of just reporting and what affects the uptake, or rather the security that is within the demand side of the projects that will be created in a green bond or in the carbon exchange market. And one of the things that the NSE has done is develop an environmental and social and governance structure. So there's a guideline that has been provided for that, and it's actually available on the NSE website to just make sure that there is value, there's return coming into the investor, and they're able to access the different information. So the organizations that get into the green space are expected, of course it's not stipulated for companies that are not listed, but for companies that are not listed, they can come in voluntarily to be able to disclose different aspects of the organization that would affect the social area, that would affect governance, that would affect the environment. So that makes it very open in terms of who can access the information. It should be available freely. And we're looking to partner in the future with county governments and water companies just to ensure that there's that level of governance. So linking that, then organizations and individuals can come in with small amounts of money within a rate structure that's within the USP, as I earlier mentioned. But the NSE is definitely out to support the common Mwananchi. The president, I think, when he visited the NSE on 11th of October, he really mentioned that he's willing for the NSE to be a platform for any person to come on board and be able to trade in shares. We're going into the future. Carbon credits, carbon exchange is the way to go.
Wonderful, thank you so much. And I think now we'll open to the floor for maybe 5 or 10 minutes. Key questions, please say who you are, your institution, and who you're asking the question to, including the researchers. Yeah, that intellectual rigor is something that needs to be engaged with, and of course the panelists, you can ask them. I think there's a question in the front, so if there's a mic, oh, Prof at the back. Let's start with Prof, and then we'll come to the front.
Yeah, thank you. Thank you for the presentations, all very insightful. Thank you for the insights from the panel. Really great, very excited. This is always an area that I like listening to, because I feel I always have a lot to learn in this particular area. So I'll just focus most of my comments on the presentation that was done on digital finance and whether it can help vulnerable populations address climate change. First of all, just to thank the team that worked on this, just for the innovation, because I think this is really cutting edge stuff, and I think there are a lot of potential insights that can be gained from there. So also their attempt to use mixed methods, quantitative, qualitative, I think is also commendable, because these methodologies are very complementary. But again, I would hope, I know this is a first draft of the paper, an early draft of the paper, so I know they are still improving it, and they're going to put in substantial work still. So I still would want more clarity on, like conceptual clarity. I felt that there should have been a conceptual, theoretical framework, kind of bringing out the mechanisms more clearly, especially because climate risk is so broad-based, and mitigating climate risk has so many dimensions. I think there needed to be a stronger conceptual foundation. They still need to give some thought to that, on the channels through which digital finance works. In order to mitigate this, how do you control for other factors as well that impact climate risk other than digital finance? So I think that there's some conceptual work that needs to be done there. But methodologically, also I had some questions. Given the nature of the data that they are dealing with, data from 2006, this is in different years, distributional assumption issues, etc., etc. What was the reason, justification for choice of a Probit model? I didn't get that. I just saw the Probit model is used, but why Probit model? How did they overcome the challenges of a Probit model? Because a Probit model is very sensitive to changes, even slight changes in distributional assumptions. What kind of robustness checks did they do? And particularly the biggest problem always is endogeneity. How did they deal with the question of endogeneity, especially reverse causality in that model? What was their strategy? Just some more insights into that. I know this is an early version of the paper, so I know they're still improving it, but I'd like more sort of insight into the methodology, how you address limitations, because when you're dealing with causal inference, you always have to think through some of these things. What problems could there potentially be in coming up with some of that inference? How did you address those problems, and so on? So maybe just a bit of comment and insight on that. I imagine they must have looked at some of these things, but just a bit more insight into that. Thank you.
Thank you, Prof, for that academic request that I'll ask the researchers. We'll take a few more, then we'll allow for the responses. There's a question in the front, and then there's one in the back there. I think that's it, so that we can break for lunch after the responses. Go ahead, name and institution, please.
Thank you, Ere. My name is Wandada, lecturer at University of Nairobi. So the presentations were very insightful, especially presentation by Ogutu, though I do have a few observations to make. One is on the question of the credibility of the data. Along 3 dimensions, maybe you would expound on whether the data was time series, cross-sectional, or panel. Secondly, the presenter seemed to be very silent on the methodological approach, because if we looked at the narration of the variables of interest that he presented, we could see a mixture of macroeconomic approach and microeconomic approach. So maybe you would expound on that. Then the paper by Camilla, I think Prof has made a comment on the same, on the distributional assumptions. When you presented the predicted estimates, so I was wondering whether there were odd ratios, marginal effects, or coefficients, because I was a bit lost. Then lastly, on the policy implications of your paper, the third policy recommendation, You recommended on expansion of mobile phone uptake among the vulnerable group, that is on the demand side. However, we should take note that mobile phone penetration in Kenya is very high. So maybe your team would reconsider looking at that policy implication aspect. Thank you.
Thank you very much. And I think there was a final question in the back. Yeah, name and institution, and then we'll allow the respondents. I think there are two. I think he's in the back, at the back row. He's back there, yeah.
Thank you. Thank you for the presentation, especially by Joseph Ogutu and Camilla and company and all the panelists in this discussion. My first question goes to Ogutu. His presentation paints a very grim picture on climate change risks in this part of the world and population growth. We know that there are population dividends where the growth of population reaches a lag phase. But the projections are that countries that have slightly low income and are growing fast now, they're likely to have a population explosion, and that will undermine vegetation cover and all those things. But there are population dividends where there is evidence that population will have to stagnate at a point in time. For example, Kenya has almost reached there. So would like him to make a comment on such population dividends which are experiencing by most of these economies. And second is, this goes to the paper by Camilla on how digital financial services can use to mitigate climate risks. So the driver here is there is a possibility that people who are using or who are vulnerable to climate risks tend to use financial services to mitigate them, but not the other way around. So they can make a comment on causality and the potential of reverse causality, so that we can be sure, or they can have make an informed decision on how we can leverage on financial services to mitigate population change, to mitigate climate risks and shocks. Thanks.
Wonderful, thank you. I think we'll start, I think if you can give the mic to Camilla and her team, and then we'll close with Prof. Yeah, I think you guys can go. Thank you. Thank you so much. Thank you. So Camilla, it's the mic. It's this lady in, that's her.
So I'll touch on some of the methodology questions, but then I also allow my team to step in and add where my answer might not be sufficient or comprehensive enough. Thank you, Professor Mudida, for your very valuable comments. We'll definitely take them on board and look at the conceptual framework as well as the methodology suggestions to improve the paper. In terms of the conceptual framework, basically macroeconomic and microeconomic factors are likely to drive financial inclusion, and we want to focus on the microeconomic factors through which macroeconomic factors are likely to be visible through the FinAccess data, and we want to observe controlling for those factors that drive financial inclusion at the household level. What other factors are likely to drive inclusion? For example, we observed during the COVID-19 period, the COVID-19 acted as a shock that increased demand or maybe liquidity needs that were covered by adoption of various financial services. Similarly, climate shock presents an opportunity or creates a need for a solution to manage that shock. Therefore, in the same way that the demand for financial services or even digital financial services increased as a result of a shock, a macroeconomic factor led to increased demand for liquidity needs, and the DFS was a solution to that. In the same way, climate shock creates a demand or an appetite to meet some of the liquidity needs that occur as a result of that shock. For example, loss of income, loss of livelihoods, and we saw this for the farmers and the agrarian community, and in the same way increases uptake therefore for that service. So that's the conceptual framework behind it, but I'll definitely, me and the team will definitely relook at that to ensure it's robust enough. In terms of the methodology, before embarking on this analysis, we did basic analysis to understand the data generating process and the distribution of the FinAccess data. And the reason why we chose a ProBid model is because when we compared it to other models, it fits well with the normal distribution. And therefore, when we confirmed that the data all the way from 2006 to 21 followed a normal distribution, therefore it was amenable to apply a ProBid model, we embarked to choose that model. But this was not the only check that was done. Before we focused and selected this as the most appropriate model, we actually ran many different models with the same conceptual framework, meaning defining what the independent variable, the regressors were, versus the dependent variables, which is formal financial inclusion or usage of DFS products and other financial services. So there was already rigorous testing to find the most appropriate models. So the other models that would typically be used for data that has a normal distribution, for example, OLS, Logit models, we applied those as well. And we found when we looked at the correlations and the output of the model, basically the relationships held across the model, including that for the ProBid model. And we went ahead to confirm the relationships of the ProBid model by running a marginal effect. And it's from that marginal effect then, when we confirmed the relationships that we were seeing, that we then made a prediction on the conditional probability, assuming all the regressors are at their mean value. So I hope that has answered the question. I think there was another question about the distributional properties of the data and whether those were taken into consideration before we settled for the ProBid model. The data, as we know, is not cross-section and not time series. We know that FinAccess data assumes a random sample that is representative of the population at a point in time. So we're assuming that because there is a random population that mirrors the general population over time, we sort of have a longitudinal type of data. It's not time series because we're not tracking the same people, and it's not cross-section because there is a time dimension. So the nature of the data is longitudinal. And I think this, we obtained this idea from looking at some of the studies that have been done, particularly with household data, large household data taken at different points in time, but ones that reflect the general properties of the population. Let me stop there so that I don't miss the rest of the population who would want the questions answered. And let me let others speak as well.
Thanks, Camilla. Maybe I'll just start with the last part where Wadeda wanted some clarification based on our recommendations that we encourage mobile phone ownership. Yet in Kenya, we know there is a lot of mobile phone ownership. In our analysis, when we did qualitative analysis, we found that women and people in the agrarian area, in the rural and the poor, are the most affected by climate risk. And then when we did the cross-tab and we compared in terms of mobile ownership, where we are comparing the mobile ownership for populations that is affected by climate risk versus those who are not affected by climate risk, we found that those people or those vulnerable populations that are highly likely to be affected by climate risk, they had lower mobile ownership compared to the normal populations. That's why we drove our conclusions that there still needs some work to be done. And number two, to encourage this population to own mobile phone ownership. And number two, even though there is high penetration of mobile ownership, we are still not at 100%. So still there is still some headlooms to achieve mobile ownership. So let me stop there. Thank you.
Thank you. And now we can now go to Professor Ogutu, who can respond to the questions that were directed at him.
Thank you. Maybe I can stand up. Thank you very much for the question. I think what I can say is that predicting the future is inherently difficult because there are so many uncertainties involved. So the projections that I said there have those uncertainties inherent in them. But having said that, you can see, at least looking at the trends that I showed there from 1897 to date, the population of Kenya, Tanzania, and Uganda has been increasing exponentially up to now. And so if you look at historical symmetry as anything to go by, we can assume that this trend at least will be sustained for some time into the future. And most importantly, because the young people who are going to make the population increase are already there. These people will have children. And so if you're going to have policies put in place to slow down population growth, this can only have effect later on, but they're not going to stop the people who are already there from having children. So I think we have to plan with the assumption that the population will continue to increase for some time. That's going to happen. And then it was said that I painted a very grim picture of what's happening in Kenya. I just want to say that the picture I painted is not as grim as it should be, actually. Because first, I've looked at the historical data in this country. I was hoping that there would be some environmental historians who would tell us how things have changed, but I was unable to find that. So I'm a statistician, but I decided to step back and go maybe become some kind of a historian. I've gone to the archives myself and collected material on Kenya from about 1884 to date and studied like how the wildlife numbers have changed, human population has changed, vegetation and so on. And I can report that the Kenyan population was only 2.5 million people in 1897. And now it is over 50 million, it's increasing. I can report that all the wildlife migrations in Kenya have collapsed. The only one left now is the one from Tanzania, the Serengeti Mara wild migration. All the ones we have, all the Kenyan migrations have collapsed. In Elementaita, Nakuru, that was one of the biggest in East Africa, it's collapsed. In Athi-Kaputiei, it has collapsed. In Mara Loita Plains, it has collapsed. In Amboseli, it has collapsed. All the 4 elephant migrations from Lorian Swamp in Wajir all the way here, it has collapsed. So all those are gone. So we have looked at data and we have spent 10 years verifying this data against the originals and analyzed them. So it has been a very serious and painstaking effort that we have invested in this and a lot of resources. So what we're saying here is not just out of lazy statement. It's based on what we've really carefully considered, and the situation is very dire. We could go into greater detail, but just take note that it is really serious. And in 2016, we published a paper which showed that, for example, the wildlife in Kenya throughout Kenya, we have lost over 70% of our wildlife since monitoring began in 1977 to date. So there's a lot of statistics there to show and to support this statement. But we could still do something about it. Thank you.
Thank you very much. I think we're going to close there. So I think I'll hand over to Lukania. Thank you.
Thank you. Thank you, Anzata. Thank you for all the panelists. Thank you for all the presenters. And thank you for the questions. I know we still have others that have come online, so we haven't forgotten you. That's Stephen, Mailu, Douglas. I know others are coming. Just 2 quick announcements because we need to go for lunch. We'll start at 2:30 p.m. So the online team, I hope you can join us. And then we have a cocktail after the last session, after lunch, which is on gender. And I'm honored to have that presented by FSD's CEO, Tamara, who's been with us throughout. So we look forward to that session. And then the last thing is we've gotten queries about the report. So they'll be uploaded on all the 3 websites, FSD, CanBS, and Central Bank. So we'll try and do that real time once we have confirmation that they're okay to go online. And then also we are having somebody taking notes who will summarize everything we have. And then also questions that will not have been answered within the session will also be part of the report. So you'll get all the information we have. Yeah, and that's it. So we can break for lunch and see you guys at 2:30 p.m. online guys, please join us again at 2:30 p.m. Thank you.
The role of FSD Kenya for HSNP was that of a payment service manager. And that included, to start with, the design of the payment solution. So both in the first phase and the second phase of HSNP, FSD was the one designing the payment solution.
The role of FSD in developing a solution for HSNP began with what I would call a challenge from DFID, where they asked us to place $20 in the pocket of a person in Turkana on a regular basis every 2 months, and to make it affordable. What we did was we set up what today is known as agency banking. At that time, there was no agency banking in Kenya, but with a special dispensation from the Central Bank of Kenya, we were able to set up an agent in Turkana, in Kakuma, and we registered about 500 initially beneficiaries using biometrics, because we wanted to make sure that we were able to positively identify and authenticate the individuals or beneficiaries who are receiving these funds. And also we wanted to make sure that this was a process that could be used by people who are not literate. We then went out and advertised for a payment service provider, somebody to come in and help us to roll out the solution. And out of about 18 applications, Equity Bank emerged as the best candidate. So we're looking for a partner who was really keen to work with the bottom of the pyramid and to continue to develop solutions for the people of Northern Kenya.
In terms of payment processing, FSD Kenya was responsible for just making sure that the payroll was in order, coming from government, and making sure that the funds that were coming from FCDO and also from government in the second phase were processed in good time and delivered in good time. There was also another role around SLA management, that is the service level agreement. These are agreements that were part of the contract, and FSD's role was to ensure that these had been maintained by the payment service provider, both from a beneficiary point of view and in delivery of the payment. One of the things that we did was to do a beneficiary satisfaction survey, basically going out to beneficiaries and asking, are you satisfied with the service that you're receiving? From the payment service provider side, we were to ensure that the payments were delivered in good time, accounts were opened in good time, cards were delivered also within the framework that we had agreed on. Some of the key design principles that we took into consideration, especially in the design of HSNP, were one, predictability and timeliness of payments. In a program such as a cash transfer program, it's important that you get the payments out on time. So in the case of HSNP, we were able to pay on the 5th of every payment month. Another key design principle, I'd say, is keeping personal data of the customer, private, especially in the age of internet, where some of this personal data can be misused for fraud or other things. It's important that you ensure that this is covered. The other thing is accessibility, ensuring that beneficiaries are not walking long distances to get to a payment point was key for us. There was an SLA requirement around making sure that 80% of beneficiaries lived within 20 kilometers of a payment point, which was adhered to.
Hawa mama wakifika, ako na ATM card na kitambulisho. Kwa hizi zote mbili unahakikisha majina yenye yako kwa kitambulisho na yale yenye yako kwenye kadi ya ATM zinafanana. Kisha utachukua kadi uingize kwenye mashine. Ukishaweka itakuitisha kidole. Utachukua kidole chake uegeze kwenye mashine. Kisha ita-verify. Kisha verify utaweka pesa. Ni shilingi 5,400. Kisha toka utamlipa pesa. Kisha tuko na kitabu ya benki, unaandika maandishi. Utaandika majina yake, ile pesa amepata na kuna na hiyo transaction.
Pesa ikikuja, agent inapiga simu. Wanasema wenye wanapatanga pesa ya Lopetuni, wanatakana wapate pesa tarehe fulani. chifu kwanza ndio anatangulia. Nasema pesa ya Lopetu imekuja, itapatikana tarehe fulani. Agent anasema msanya watu wote wakuje tarehe fulani wapate pesa. Nilikuwa napokea 4,000 sijui na mia ngapi. Alafu wakarudi tena wakaongeza. Saa hii tunapokea 5,400.
Some of the challenges in implementation of the HSNP program is about the IDs, and we saw this when we were opening bank accounts in the second phase. Once we set out to open the bank accounts, we realized about 40% of the beneficiaries did not have IDs, and that sort of set us back in terms of our work plan and in opening those accounts. One other challenge is about getting viable agents at the time when we were starting, because the businesses were quite small, and depending on the amount of money they were paying out, then that could be a challenge. So that was an issue. But currently we have about over 500 agents across the 4 counties that are serving beneficiaries.
The program has had very positive impacts. Each time there's a drought, the household lose assets, and poverty increases in those households because now you've lost your sources of income, livelihood. In the households where we have this program going on, the poverty did not increase as much as it did in the other households that were not benefiting. Regardless of whatever was happening, the shocks and all this, at least they could eat. They could have something to eat because they had cash, they knew the cash was coming, it was predictable.
We have seen economic impact to our vulnerable households. The money that the household gets can utilize from other things. The household can buy foodstuffs. The household can purchase medical supplies for ill household members. The household can venture into small-scale businesses. And that has brought a shift from dependent population to what I may call resilient.
Hii pesa nimefungulia naye kibanda. Nimeweka mabasta, nimeweka unga, nimeweka nini, kila kitu tu iko, hata peremende. Na hii pesa inasaidianga saa zingine natuma kwa shule. Saa zingine kama maneno ya shule ijokuja nanunulia vitu naweka kwa duka.
Evidence shows us that providing cash is actually between 2 to 7 times more efficient than providing food assistance or food aid, which was one of the key objectives of the program at the very beginning. Cash transfers have also been shown to have wider impacts, including on supporting the local economy and supporting the local markets and small traders within the communities that are affected. Use of cash has been shown to preserve dignity of the individuals or the beneficiaries, and has been also shown to have a very positive effect on their mental well-being during a crisis.
Mimi, huu mradi umenisaidia sana. Kuna ile commission mimi napewa baada ya kulipa hawa mama kila tarehe 6. Nikienda kule benki na nashukuru Mungu kwa sababu imeniinua. Pia imefanya biashara yangu imeimarika kwa sababu wakati nilianza kama ka kiosk kadogo. Wakati ya watu wanapata pesa they buy. Wamefanya sasa niko saizi na duka 2. Pia imenisaidia kwa sasa ninauza retail wholesale kutoka kwa kiosk na kupima sukari ya shilingi 10. Saizi naweza pima gunia niuze nusu gunia, niuze quarter ya gunia.
Since phase 1 of cash transfer program, a lot of lessons have been learned. There would be need to complement cash transfers with capacity building. Cash payments are not sufficient to transform people. They solve instant problems, but if we did capacity building, then we could put the beneficiaries on a path of self-sustainability.
So in terms of lessons learned is having the community support the project, because initially when we went into northern Kenya, there was a lot of resistance initially to the program. So we brought in, I would call them local elders, etc., to talk to the communities. And once they spoke to them and we got their support, that changed the perception of HSNP.
Sustainability was a key success for us. The original intention was that once FSD exits the program, that the program will continue running. And this has been the case after 2 phases of running or implementing, being part of the project as a payment service provider. We transitioned successfully to National Drought Management Authority, which is now the program or the agency that is running the program, and it's doing so successfully.
Namwambia hii watu asante sana 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 sana. Mwambia hao asante sana. Kama wako na uwezo ya kusaidia tu tena aongezee sisi pesa, aongezee.
Haya, kwa majina naitwa Penina Wahu kutoka LD, but nakaa hapa Kawangware, ndio nimeka biashara ya salon hapa Kawangware. Kenye naona inanisaidia na hii biashara yangu ni mambo na chama za wamama. Chama za wamama zinasaidia sana sana. Kama umelemewa na business, wanakuja wanakuinua. Kwa saizi mimi niko na chama 4. Mimi nimeona hizo chama zimenisaidia juu kama hii ya Utugi, tunaendanga kutembelea wazazi. Kupitia hizi chama za wamama tumeungana. Mtu akiwa na jambo, kama umelemewa, kama uko na ugonjwa, wanakuja wanakutembelea. Hapo awali nilikuwa na circle, but nikakuja nikaona afadhali nilikuwa tu kwa hizi chama za wamama kuliko circle. But nikaona chama za wamama zinasaidia juu nikitaka kitu emergency, naenda tu kwa chama nawaambia, alafu kama ni kitu kunisaidia kama pesa kidogo tu ya kuinua biashara yangu wananipatia. Hata kama sijaweka stock ya kutosha kwa kazi yangu, lakini natarajia nitaweka ya kutosha kupitia hizo chama. Tena nawakopa kidogo kidogo na kuja naendelesha biashara yangu. Kuna watoto 2, mmoja ako class 7 na mwingine ako class 1. Na kupitia hizo chama za wamama, at least sijaiona mtoto wangu amefukuzwa. Mi kulingana na kwenye chama zimenipeleka na kwenye zimenifikisha, mi sioni maana ya bank ama circle. Mi nategemea, naona tu afadhali tu nikae na hizi chama za wamama. Juu kwa bank tuweka pesa, umeweka, lakini at last maybe kama unataka loan itabidi ufuate procedure kubwa. Sasa mi sioni kama naweza fungua any circle. Acha niendelee tu na chama za wamama.
My name is Kevin Mulwa. I sell suits in town. We've been in this business for the last 10 years, much experience, challenges here and there. There has been challenges like you save with a bank, then when you go for loan maybe to boost your business, you think you get they want so much. I had another bank which I used to operate here in town. They add so much hidden charges where you find when you are getting your statement, you get they have charged you so much, and when you go back there and you ask, they have no answers. You are taken from one manager to the other. You are told come tomorrow, we'll sort you out, and it was very frustrating. Most of the banks we get, you'll find people who are employed there, like they don't have information. Maybe they have the information, but they are not willing to give out the right information because they want to sell fast. They want you to open an account with them, and they have been given targets. So the information which they give you, they'll give you information which will make you open the account. Basically, we need to get the right information right from the start when you are opening the account, so that you get to know where maybe there are some deduction of your money at the end of any transaction.
Majina yangu naitwa Nancy Wanja. Mimi ni mwanabiashara wa Githurai. Mimi ni muuzaji wa minji in wholesale na retail. Kuna challenges zile zinapatanga watu kwa biashara. Sometimes unakuta biashara imeenda chini. Saa nyingine unakuta biashara inaenda juu. Kwa hivyo wakati biashara ziko chini, ndio tunahitaji mikopo ya hapa na pale, tunaenda kukopa hapa na pale, unakopa on daily basis. Mimi nikilinganisha pesa ya banki ama ya sako. Kwa sako interest ya chako ni kidogo sana. Lakini kwa bank unakuta saa hii wamekupatia a loan of 100,000, lakini unakuta umelipa kama 1,300. Lakini kwa sako haikuangi na faida kubwa sana. Kwa hivyo na prefer sako instead of bank. Sababu nikienda kwa bank kila mtu atakuwa anajua mpaka nitaitishwa maseginitwas wa kunisainia, lakini ya talama ya mswali haitisi seginitali, haitisi mambo mingi. Kwa hivyo mimi naenda tu na nikukanyakanya tu kwa simu alafu pesa inaingia. Kwa hivyo tumefurahia sana mambo ya tara, mambo ya mswali, KMBC. Those are the quick means of mikopo ile tunapenda sana.
Okay, my name is Edith Onyango. I'm a managing partner in a catering business that is owned by two ladies. With regards to financial services, we have 2 bank accounts. Since this is a partnership, we both jointly have to sign in order to access services. Yeah, so either way, we still have to use the traditional method, going to the bank to actually get cash. With regards to payments, we're able to accept M-Pesa payments. So for this course, we realized that we're able to get a lot more money because people don't always have to carry cash around with them. And over the time, I don't have to go to the ATM at all. I even have an ATM card that I will only use because it's a Visa, I use to pay bills. I don't really use it to access money. When I need to get money, I'll just go onto the line, I'll use my phone to go onto the online mobile app and access money. And this definitely makes things easy. And so far, individual clients also pay us using mobile money, so still very good. The bigger clients, of course, will pay by bank transfers or by check, so that means those have to go into the bank account. Yeah, I think the banks need to be more friendly or come up with something that, because for us being a partnership, when I need to get money, I still have to physically go into a bank because I have to walk in with a check that is signed by both signatories. We cannot have an ATM card because this is a partnership. So I think the banks should consider doing something. I think mobile banking has helped increase in terms of volumes, because sometimes there are people who, when they walk in here, the first thing they will ask is, do you have a till? So in that case, there are people who will comfortably come in because they know that they can pay by M-Pesa even if they don't have cash. Because as it is right now, there's so many requirements and so many small prints that banks require before they can actually give you even the minimum of loan, regardless of the fact that you have lots of money with them. So getting an overdraft facility is close to impossible. So I hope that this initiative is going to help them understand our needs so that they come up with a product that will help us.
Naitwa Paul Suyanka na niko na miaka 29. Niko na watoto wawili. Mmoja shule, mwingine bado hajaingia shule. Mimi na savingi na natumiaga Equity, lakini sijapata pesa ya kusave. Ningependa kuanzia biashara, lakini sasa ndio naanza kujipanga nipate pesa ya kuanzia biashara. Mwaka uliopita singeweza kusave ama kujipanga kwa vile niligonjeka, na ikawa matumizi yangu yote yameingia kwa gharama ya hospitali. So ile pesa nilikuwa nimeweka yote ilitumika. Kwa hivyo saa zingine life inakuwa ngumu. Kama uko na familia, ukigonjeka, unaweza tumia pesa vile hukuwa umejipanga. Yeah. Lakini kulingana na vile umejipanga, naona itarecover tu. Nitarudisha ile mali nilipea ama ile pesa niliyotumia kufanya kwa kusave na kwa kuweka kwa bank nipate kuanzia biashara. Sijaitumia Tala, M-Shwari kwa sababu wanapatiana loan kidogo, mkopo wa chini sana ambaye haiwezi anzia biashara yoyote. Sijaipata kuchukua loan kwa banki yoyote ile ama kwa Equity kwa sababu ya inahitaji mtu ambaye ana save ama anapata pesa kila mwisho wa mwezi. So sijawahi fikiria kusave na kuchukua loans.
My name is Boniface Kithara Kimathi. Okay, I'm an entrepreneur at Kangemi Business Center where I have a cyber cafe. To start my business, I started with my own capital, and towards growing the business, I decided to take some loans from Tala, from KCB M-Pesa, after which it wasn't enough. I decided to partner with a savings circle that I had been since 3 months ago, where I took a loan of 80,000 and added up to my capital so that I could rent a house where it's strategically accessible by my customers. These loans, first of all, the one I took from Tala, I borrowed from KCB M-Pesa so that I can pay it because the period was almost. Actually, I like betting a lot. I love football, and I like placing my bet, even though I don't know the results which will come after. The little profit that I make, I take at least even 50 bob, which I take into SportPesa, and at least see if I can get some casual money to juggle in between my other responsibilities. For the medium loan givers, they should reduce how they pressure a client to pay that money. Sometimes business is bad and you cannot be sure that you'll pay within that 1 month. Banks give the loans, but the process of processing the loan is like too much. The processing of the loan is too much. You have to be told to bring how many guarantors, and the interest rate, I find it so high than SACCOs and these other small scale loan givers.
FSD has been working since 2005 to promote financial inclusion in Kenya. Kenya has made huge financial strides during this time. Over 75% of the population have access to a formal account, even if it's just a mobile money account. But are formal financial services really delivering value to low-income Kenyans?
My business partner and I went to the bank and we asked the manager if he could give us a loan, and then he asked us how much we needed at the time. The manager asked us if we have exhausted all our other options, if we've asked family, if we've asked friends before, because he was he wouldn't advise because of the interest rates and everything. So he was no, if we don't get anywhere else, now we can go back and he can see if we can get. Okay, it was a bit disappointing because I thought we bank with you guys, probably you'd give us a good rate or something, considering you can see how our account has been growing. After the first experience, it was a bit discouraging, so I'd rather I feel like I should just look for other options before I consider them as an option. So far I haven't gotten any loan from a bank.
Despite these achievements, our research shows that the relevance of these financial services in the everyday lives of Kenyans is minimal. So why is it that Kenyans just are not using banks?
Well, I think that's a really good question, because although we've seen the numbers of people having bank accounts go up, what we know is that they don't use them so much.
Yeah.
And I think, again, it's about the fact that when you put your money in the bank, it's not being put into this enabling you to build friendships, to build relationships. People would love to have a relationship with the bank, but then they find that it's really hard to get a loan from the bank.
Right.
And if they do get it, then they find it really hard to manage it, because maybe they've had some crises and the bank won't really listen to them when they need to change
not as flexible.
Yeah, and therefore that puts them in more of a problem than when they started.
What happened now, we had to go back and now ask our family members for money. So now I was lucky enough, my mom assisted, also my dad gave me some money. Luckily it was interest free, so I'd pay them slowly. Yes.
Unajua zina kazi ingine, kazi ile nafanya ni yangu ya mechanic. Saa hii nikifanya kazi hapa, tuseme nimepata 1,000, 500 naweza kwenda ni save kwa hiyo chama yangu. Hiyo inaitwa Best Rock Sacco. Juu na hao watu huwa wanapitianga hapa wakicollect hizo pesa, badala uende huko bank ufunge line huko na kenye unaenda kufungia line unapeleka 500. Sasa nikaona hiyo chama yangu wewe inafanya mzuri, na kila siku wakipitia hapa, tuseme hata niko na 200, niko na 100, nawapatia na wanachukua, na hiyo pesa wanaenda wanaweka, na hiyo pesa ni yangu. Hiyo Best Rock Sacco, ukiwaitisha tuseme loan, unataka loan, wanakupatia tu, hawakuangi na process mingi.
There are two really important realities to understand about low-income people's lives, and one is that their incomes are really, really small. So whenever they need to spend money for one thing, it means trading off with another. So the incomes are really tiny. And we also saw that they're really volatile. So from month to month, income goes up or down by about 50%. So that's very difficult to plan around. And we also saw that people were very rarely just putting money aside in a savings account or under the mattress even in large sums, because they needed every shilling to be working. It couldn't just be sitting there. To just leave it sitting there would be wasteful. So they needed that money constantly working for them, whether that was in a savings group, where when it wasn't with them, it was with a neighbor who was making an investment, there were lots of different ways that they wanted that money to be active at the same time as it was being saved.
Hii familia yangu mimi hutegemea hii biashara ya nyama, ndio wasaidia nayo. Mbuzi natoa sokoni, naenda sokoni, nanunua mbuzi, nakuja nazo, napeleka kichinjioni, naenda kuchinja. Nikichinja nakuja nauza. Mbuzi anaweza kama ni wa 3,000, anatoka kama 4,000. Sasa zile pesa nikipata nikichinja wale mbuzi wakiisha, zile pesa narudisha tena sokoni. Zile faida ile napata napeleka kwa chama. Capital ya kazi narudisha tena kazini. Kwa kusaturate namna hiyo inaenda ikizaana faida ambayo naiona. Ndio kwa banki ni sawa, sikatai. Lakini hii naiona nafanya kazi na immediately.
People have sort of two competing priorities that come out of that. One is stretching their budget to make it work when income is low or something comes up that they weren't expecting. And the other one is growing their incomes so that they're investing in a better future, whether that's in an actual income earning activity like a small business, or whether it's investing in school fees or buying a piece of land. And when you have such a small amount of money to use in terms of savings, you have to be really creative about balancing those two priorities of stretching the budget and growing your income. We found that people were using lots of different financial devices at the same time to try to make those two priorities work together. So they might be taking credit at the shop, borrowing formally and informally, belonging to a number of savings groups. We found like more than 10 in a household that were happening simultaneously.
Mimi ni fundi. Sana huwa nashona na mapato yangu ndio ninajisaidia nayo kutoka hapa kwa kibanda yangu. Huwa ninaingia kwa vikundi vya kina mama. Natoa tu kidogo kidogo. Baadaye nikipata huwa natoa karo ya shule, nanunua chakula, mavazi, najisaidia. Sasa si unaona vile nikiweka kwa vikundi vya kina mama, za zingine watu napeleka bank. Alafu sikikuja kwa nyingi tunakuja tunagawanya.
Chama niko na 2. Ya kwanza natoa 200 kila siku. Na inanisaidia mimi kulipa nyumba ama kulipa school fees. Hiyo ya pili nachukua, naangalia biashara venye inaendelea, nachukua doko napeleka bank.
Which of these services do you value the most? The bank or the chama?
Chama. Ndo napata pesa haraka. Ndo napata pesa kama pesa ni mingi.
When I did research, I found that Kenyans value financial services not just for what they can get in economic terms, but as we said, also for them to fulfill other well-being goals and well-being values. And actually, respondents and people I talked to say that they can have a lot of motivation in terms of saving in the bank and also in terms of planning for their expenses. But at the same time, it's very difficult for them to build relationships through the bank. So while the banks can give them a sense of social status, it's very difficult for them to actually build a sense of identity and belonging, because through a bank account, they can't really develop relationships and social networks. And at the same time, also, banks don't seem to operate on those modes of development that are typically in communities, so the mutual development and mutual support, because it's not clear when people put their funds into banks whether they can actually get these funds to work for the community through, for instance, loans.
Uplifting a friend means you cannot just focus on yourself. For example, sometimes a member of the chama may not have any money and she may not want the whole community to know she is struggling. The chama can help by supporting her so that people don't know what she is going through. That's how we run things. we agree not to expose each other's challenges to people outside the channel. We can't do that for people who aren't members of the group, but if they are members, then we are able to assist. So by sheltering one another like this, we cover each other's nakedness in times of need.
Tawaambia waingie waungane, waanze vikundi, watoe pesa, wakiunganisha pamoja wapate kitu ili waanze kazi.
And I think Mshwari is really interesting in the way it's come up, because of course it has got a bank behind it, but it's got a very different identity. Yeah. And what people are seeing with Mshwari is that they can take loans, they can learn about it, but they're seeing that the Mshwari is trusting them with their money. And I think there's a perception in banks that the bank doesn't trust people
trust the client
with its money. You have to trust the bank with your money before it will trust you with its money. And Mshwari is slightly doing that the other way around. And that's partly why it's very popular. So it's building a relationship which people start to value, because they want to be able to build that relationship and able to develop in the long term. They want a relationship which is around finance that can take them into the future.
Watoto wamesoma, niko na kijana amemaliza, niko na msichana pia, kijana amemaliza college na ameanza kujisaidia mwenyewe. Niko na msichana amemaliza last year, pia amemaliza form 4. Na pia niko na mwingine mdogo. Naendelea na mimi na babangu.
If formal financial providers want to develop solutions that work for people, they need to come out and talk to people. There is a lot to learn.
Kwa majina naitwa Penina Nashipai. Mimi ni mkazi wa Kibiko, Kajiado County. Mwanzo nilikuwa nafanya kazi ya beadwork, kushona shanga napeleka Masai Market. Wakati corona ilipoanza, ikawa ngumu sasa kwenda Nairobi. Nikakaa nikafikiria, nikasema ni biashara gani nyingine yenye naweza kufanya kando na hiyo. Nikaangalia, nikajaribu kuona kwa hii eneo yetu hakuna duka. Nikaanza kaduka kadogo. Customer wangu wengi wanalipa kupitia simu na inawarahisishia pia na wao, kwa sababu kama mtu ako na pesa kwa simu hata lala njaa. Katika boma yangu niko na mbuzi na pia hao ninawalisha kwa kununua unga, na si lazima nitoke nyumbani niende ninunue. Ninaweza lipa na kupitia simu na ninaleta hiyo chakula ya mifugo yangu hapa nyumbani. Wakati ninatumia simu kulipa, inakuwa rahisi kuliko mimi kutoka hapa kwenda pale. Hapo kitambo ilikuwa ngumu kidogo, kwa sababu huenda nitakuwa nimesafiri nimeenda mahali ambaye hakuna bank, na itakuwa ngumu kwangu kusaidika wakati ninahitaji pesa kwa uharaka. Sasa ninaweza toa pesa pali popote bila shida. Kwa kulipa karo, hapo kulipa na simu imetusaidia sana. Wakati mwingine tulikuwa tunaenda shule ikifunguliwa, tunakuwa na laini kubwa ya kulipa school fees. Unaona mtoto amechelewa kwenda shule, lakini kwa sasa imerahisishwa, kwa maana unaweza toa pesa kwa simu na ulipe school fees ya watoto na waende vizuri shuleni.
My name is Caroline Gina. I'm an entrepreneur. I run a cleaning company called Miss Clean, where we specialize in professional cleaning services, both domestic and commercial. We've been in business for the last 13 years. As a business, we run a lot of transactions that are money related. When we started, I remember mostly the biggest mode of payment was checks, especially for corporates, and individuals that could pay us via cash. Looking at the involvement of money handling and transactions has changed, and mostly even when COVID happened. I remember there was a big shift from cash handling to now more of online transactions. And most of my clients ask for bank details, and they currently do transfers, especially the corporates. They do just bank transfers. That walking and walking out of a bank was like something we had to keep doing. But these days we don't have such things. It's just at a touch of a button, either on your phone, on your laptop, and things are just happening. So that has even helped us as business people, such that we don't have to wait for money. I remember I used to go to the bank to ask them to give me an uncleared effect so that I can do my next job, especially when business was really still struggling with cash flow. But now, instantly, you have your client pays, and instantly you have your money. We do internet banking from our main account to mobile banking. When it's transferred to the mobile banking system, then it's transferred now to every employee. That has created a lot of efficiency, because the person paying doesn't have to go to the site where our staff are working from. It's just at a touch of a button, or while they're just seated in the office, they can easily pay people, pay them timely. By the time the work is ending, everyone has their money and they can access it and go home. A big part of our transaction, especially receiving payments, involve a lot of the domestic part, where clients, we serve them on a daily basis and they have to pay us on a daily basis, not waiting at the end of the month, like the corporate clients. So most of them use mobile banking. We actually cancelled cash payments years ago. We no longer receive cash as a company. We only operate with mobile banking. Internationally, we also procure mostly our machineries, because it's easier, of course, and cheaper to get them there. Once we've settled with a supplier, we go to our bank and we give them the supplier's details. Sometimes the bank also helps us also get to know the credibility of the supplier and all such details. And then they help us do now the bank transfer, which is all, again, instant. And once it's done, we have the transaction evidence, which we send to our supplier, and our supplier is able to just send the materials and machinery to us within our time. So yes, that has helped us a lot. We don't have to go through so much changing money here, taking the money, or picking the money in cash, or carrying the money in cash, which evidently would lead to enough times, loss of cash.
Kwa majina naitwa Susan Okol na ninafanya kazi ya samaki. Hii kazi nimefanya kwa muda mrefu. Sasa hivi niko na 15 years kwa hii samaki. Naenda Kikomba very early in the morning. 4:30 nishaamka kwa nyumba. 5 nishapanda gari. Kitu kama saa 12 niko Kikomba nachagua samaki. Cause ni ile original. Ukichelewa huwezi pata. Sasa naenda asubuhi kabisa by 6:30 shaisha. Nikishachukua tunapima, alafu tunalipa na simu. We don't pay cash. Saa hii biashara ya samaki ni mzuri na kutumia simu. Nimefurahia sana simu. Juu nikiuza na save. Inanisaidia tu kusave. Saa hii tu nikiuza tu hivi naweka kwa savings. At the end of the day ama at the end of the week unapata umesave mingi sana kwa simu. 0710 75 Brand Muvea. Asanti. Nina save pale nimekaa. Na save hata nikitembea, na save hata nikilala. Nikiamuka hivi, natoa pesa, natumia Kikomba. Hata kama sijafika Kikomba pesa yangu imefika hapo. Mimi nikienda napata tu samaki yangu. Pesa inaenda mbele kuniliko just because of simu. School fees pia ni simu. Juu saa hii account ya shule. Kama mimi watoto wangu walikuwa nasoma ushago. Tunaweka kwa account direct. Hatuendi na fee yangu imefika. Hata watoto wako wanafukuzwa na tunalipa tu na school fees na simu.
This anthropological project had as its first objective trying to understand how people use mobile phones here in Western Kenya.
M-Pesa is a mobile money sending service that was introduced in Kenya in 2007. Since then, it has become extremely popular. Many development economists approach the study of mobile money from a financial inclusion perspective. This project takes an anthropological approach. It sees the practices of mobile money as a part of an existing social and cultural background. This area is a rapidly changing but still predominantly rural area.
People are involved in agriculture, but also many other ways of making a living. Trading, having small shops.
One important source of income is mobile money remittances. Remittances have a variety of purposes in Western Kenya.
Ebulwale nalwala echa nanyolekha nende accident ano omundu wandumira chisende narumikhila kaba japu niye wandumira mala chanjenda.
Kama ukitaka kununua ng'ombe ama kujenga nyumba, ani shughuli kubwa kubwa, ama mtu amekosa school fees, unaweza kuenda ukatransfer ukamsaidia.
Remittances have economic uses, but they also have important social meanings. They express caring and create relationships based on the exchange of assistance.
When I'm just feeling good and I have a little money, then sometimes I'll send something to my grandmothers.
For urban or international migrants, they are a way of maintaining social relationships and social presence in a community. There's an interesting duality to the mobile phone. On the one hand, mobile phones create connections and relationships.
I think M-Pesa has made relationships stronger, and they help you save on time and energy and money.
On the other hand, mobile phones also highlight the ability of individuals to create and shape their networks. They give individuals a lot of autonomy or agency in shaping their connections with others. People use mobile money to participate in groups.
Through mobile, it's easy for people to send their monthly subscriptions or contributions.
A quarter of the money that is contributed in steering committees when we have funerals
by this.
This concept of money pooling has become very, very common, and I found it to be widely used amongst siblings, family groups, but also students.
In order to understand how money circulates in groups, I've been using social network analysis to actually draw the pathways of mobile money remittances in families and groups. As an example, Sarah is a Marigoli woman living in Kimilili. Her mother was the third wife of a polygynous man. At his death, the other wives chased her mother away from the homestead. They moved to Kimilili, where Sarah's older sister Joyce married a Dutch man. Joyce now lives in Holland and sends Sarah $200 to $300 each month. She uses the funds to support her friend and fellow seamstress, Cecilia. She also sends remittances to her brother, her mother's brother, and her mother's sister's children. Her 20-year-old niece, Flora, attends an accounting college. Flora receives the most remittances in this network. She receives money from her mother, her aunts, and her uncles. Using mobile communication, individuals like Sarah can shape networks based on dormant kinship ties and on the existing importance of siblings in Kenyan families. The project drew mobile money graphs for 14 families. This allowed us to examine the main properties of the networks. They are based around groups of siblings. They are often connected to other groups of siblings by relationships of descent or marriage. Men and women participate equally in these networks, and people of all ages and genders can become central in networks. Furthermore, these networks are dense. Individuals have many connections to other individuals. These are properties that maximize the distribution of mobile money across a family group. They represent the way long-term traditions of mutual support and reciprocity are now expressed through the medium of mobile phone use.
One thing we found was that women tend to receive a lot of remittances. Just because women receive a lot of remittances doesn't necessarily mean that they benefit from them in ways that we expect.
I know my grandmother, she has many friends, and they'll come to her for help. They'll be like, my sons are not working and I have this problem, can you help me out? So they'll be like reaching to her for help.
So the ethic of generosity also places pressure on people to recirculate remittances to a certain degree.
The individuality of mobile money and mobile phones often means that the secrecy, the privacy, and the exclusion that is allowed by mobile phone communication is very important.
People use their phones as a way to shut out people that they don't want to talk to.
People try to manage their participation in these groups that circulate money by turning off their phone. In an extreme case, you could even get a new SIM card. Yeah?
Okay. We are back. Good afternoon, good morning, good evening, and thanks for your patience. We'll get straight into the afternoon session, and I'll have two or three different presenters that Amrik will introduce, and she's coming up on stage. And just to remind us that the session will go on until around 5, and then after that we'll have a cocktail. So Amrik here, Senior Research Specialist of FSD Kenya. Karibu, and my colleague.
Good afternoon, everybody. I think we're getting to nearly the end of our second day now, and I think everyone's getting quite exhausted intellectually and physically. I certainly am, with this incredibly rich data that we've been seeing being presented and the discussions around that. So I don't want to say last but not least, because this is such a central part of what we're dealing with respect to financial inclusion, is really the extent to which women have and are being kind of left behind in relation to their importance in the economy. And we're seeing that as well with respect to their levels of financial inclusion, where there continues to be a gender gap, albeit reducing. We've seen from this morning's presentation the gender gap still persists in terms of access to meaningful suite of financial services and products. With respect to access to a formal account, it is now just down to 4%. However, there's a lot of variation across counties and across different population segments in that metric. So it's still something we need to be very sort of seriously concerned about, particularly because of the importance of women in the economy and the society. And so this session is really sort of going to dig into that issue a bit more in terms of looking at the drivers of the gender gaps that do exist at the county level particularly. And also we're going to have a session on mutual finance and the persistence of informal financial institutions, which have particular relevance for women who have a strong participation in the informal sector as economic actors. But also, you know, they're clearly going to, as we will see, they're very important for women as well as men, and we need to understand why this informality still persists and how it's adding value within our financial landscape. So I'm going to start off by a sort of, you know, just explaining that one of our presenters, unfortunately, was not able to be here in person. He had a family emergency, and he was very, very sorry not to be able to make it today. So, for better or worse, he deputed me to give his presentation, which is a bit of an irony because I'm an anthropologist and he's an economist. So I'm going to probably do a terrible job of giving his presentation, but you'll have to bear with me. And there's lots of economists in the room who will be able to help me out when I get stuck on the fancy analytics. However, some of the points he's making are kind of, you know, universal and important, and I think I've got a bit more of an understanding of his conceptual points as opposed to the technicalities of his analysis. So this presentation is by Kiplagat Josiah from the Kenya Bankers Association, and he's looking at unbundling the financial inclusion gender inequities in Kenya. So he discusses, you know, why do these gender differences matter? I mean, as we've seen, I think I've just given that introduction really, that they, even when they're slight, they do matter. They do matter because women are so important as actors in the economy, quite apart from the inequality issues that we should also be concerned about. Cross-country gender differences in financial inclusion, literacy and credit rationing do still exist, and he's going to look at these various sort of dimensions and drivers of financial inclusion to look at their influence on this gender gap. His paper will also sort of seek to sort of look at the correlations between things like financial literacy and income and so forth, mobile phone ownership with the gender gap, with gender and financial inclusion. And then he's really going to be sort of unpacking that further through doing some probit analysis and using a sort of a technique at the end, which I will explain briefly, to understand where we might not be able to explain all the gender gaps, but there do exist some unexplained drivers of this gender gap, which we need to also have a better understanding of. So women are, as Kiplagat starts off by saying as well, that women are very active in the economic arena, extremely important in household welfare and also in inclusive growth, and yet they're often disenfranchised disproportionately relative to men and often have to shoulder more of the burden of poverty. This also relates to their inequity in terms of access to resources, opportunities, and outcomes. And is also related, of course, then to their access to financial services, albeit we've seen a big narrowing of the gender gap in formal financial inclusion. But the fact that this gap exists, and certainly it's even larger when we look at the access to a meaningful suite of products, or, for example, access to bank accounts, where we still see quite a big gender gap, it means that we've got a sort of an untapped opportunity there in the market. So I'm going to launch straight into Kiplagat's analysis, because I think he's got some very interesting maps for us, really, to kick off the presentation. So here, he's just looked at the differences across the counties in terms of the inclusion of men versus women. When we're seeing the dark green, we're seeing that women are actually more financially included than men in these counties. The light green means that they are less financially included than men, and the mid green means that the inclusion is roughly at parity. And it's very interesting to sort of look at the number of counties where we've actually got a higher level of financial inclusion for women. Particularly interesting is the Northeast, where we know that there's sort of a lot of sociocultural norms that often do mitigate against women's economic empowerment. But here we see quite high levels of financial inclusion. The Northeast is a bit of a paradox for us as well, because we've also seen a huge growth in formal financial access in the Northeast. And I think we need to do a lot more work to understand what's driving that, and maybe that would help us to understand why women appear to be more included in those counties. His next map looks at financial health. Here again, we actually don't see necessarily that these higher levels of financial inclusion for women in these certain counties are resulting in their higher levels of financial health. Actually, there's an exception. West Pokot, women do appear to be relatively more financially healthy than men in that county. And in fact, I do believe we have somebody from West Pokot in the room, so that's very interesting. Yeah, so again, there's a relationship between financial inclusion and financial health, clearly, but there's also a lot of variation across the country in terms of that relationship. And then the third map looks at the intensity of credit rationing. So although women are more included in certain counties, when they do apply for a loan, they may still get denied credit. And there's maybe more of a propensity for that to happen in the case of women than in the case of men in many counties. They're either at parity, or we see that women's credit rationing is kind of more intense in some counties than others. And here again, I believe that the dark green in Kiplagat's maps actually connotes a positive outcome for women. So actually we see that women are less credit rationed in counties like Mandera and Samburu and Garissa relative to men, whereas in places like Kitui, we see that they are more credit rationed relative to men. So again, we see some sort of, some interesting relationships in these three metrics across the counties with respect to men and women. In terms of the gaps in financial literacy, again, this is quite an important driver of financial inclusion. And here you see sort of, we saw in the previous map that there's quite a few counties where women may be more included than men. But when it comes to financial literacy, that relationship is less strong. And in fact, there's a bigger gender gap in financial literacy overall than there is with respect to financial inclusion if you take the aggregate population, as we'll see on another slide. Similarly, we've also got, he looks at the gender gaps in financial decision making. Again, Wajir, Garissa, Tana River, some of the counties where men are more likely to make financial decisions than women. But we also see the reverse is the case in some of those counties in the West. And again, this doesn't seem to necessarily correlate with women's level of financial literacy. So it's not necessarily the case that when women have a greater understanding than do men, for example, of how to read a transaction or calculate an interest rate, that is also related to their their sort of economic empowerment in terms of financial decision making. So these are just food for thought, really. I don't think there's a way really to explain these results. I just think they're quite interesting in terms of showing us the variety across the counties with respect to gender and some of these sort of drivers of financial inclusion and markers of financial inclusion between women and men. Kiplagat then goes on to look at some of the correlation between certain attributes like financial literacy and financial inclusion, comparing women with men. And really what he's doing here is taking the county data and looking at the extent at county level representation, the extent to which an attribute like financial literacy is correlated or is not correlated with the level of financial inclusion. So in terms of the chart on the, I'm dyslexic with left and right. I have to look at my wedding ring. The chart on the right, we see that relates to women. So we see that the degree of correlation between financial literacy and financial inclusion is stronger for women than it is for men, which we can see here from the chart on the left. And we're going to be looking at this same relationship on a range of attributes. So chart on the right is women and chart on the left is men. And again, you know, we also looked at the sort of the gap, the literacy in financial literacy between women and men. 50% of men are financially literate compared to 40% of women, which gives us a 10% gap in financial literacy. So that's a higher gap than we have with respect to financial inclusion, where we've only got a 4% gender gap. In terms of income, now let's see. Okay, we haven't quite got a... I think this is the inequality in income and its relationship to financial inclusion. So again, we see that when women have, I guess, lower incomes, or we see a strong relationship between higher incomes and higher levels of financial inclusion, or a slightly stronger relationship there for women than we, again, do for men, but not to quite the same extent. Actually, no, it's about the same extent as we saw for financial literacy. With respect to mobile phone ownership, we see a very strong correlation for both women and men in terms of mobile phone ownership and financial inclusion. But again, this is higher for women than it is for men. And here we find that, you know, 82% of men own a mobile phone compared to 79% of women. And so there is still also a gender gap in terms of phone ownership, as well as a strong correlation between phone ownership and financial inclusion. Here we're looking at the gender gap with respect to sort of ID ownership. Again, we've got very high levels of ID ownership in Kenya. Women, there's 90% of women have an ID, in contrast actually to 88.6% of men, interestingly. So men are slightly lower on ID ownership than are women. And again, we see a positive association between owning an ID naturally and being able to have access to a formal financial account. And that relationship appears to be much higher for women than it does, much stronger rather for women than it does for men. Again, it's interesting that it wouldn't be for men. That would be my question there. Why is it not higher for men? Again, in terms of land ownership, women are less likely to own land. 45% of men own land compared to 39% of women. But higher property ownership is associated with higher levels of financial inclusion among both men and women, particularly for men actually in this case. But we're not seeing quite such a strong correlation between land ownership and financial inclusion as we are with some of the other indicators like mobile phone ownership. Access to the internet, again, is unequal. 30% of women and 38% of men have access to the internet. And internet access is positively associated with higher financial inclusion, again, particularly among women. Now, I think from the analysis that we've seen, what's interesting to me is that all these drivers, phone ownership, income, access to internet, even ID ownership, seem for women to be much stronger drivers of financial inclusion than they do for men. And that's kind of curious. So for men, you know, irrespective of I mean, we see a correlation between internet access and financial inclusion for men, but it's not as strong. It doesn't matter so much whether they have internet access or what their incomes are, whether they're financially literate, in terms of whether or not they can actually access formal financial accounts. And so it almost suggests that there's some sort of, why is it that these attributes are so important for women in terms of their access to formal accounts? That's a question I think maybe the audience might help us with, I don't know. So Kiplagat went on to conduct a probate analysis just to sort of really look at the strength of some of these relationships. And again, he looked at a range of different variables, including formal inclusion, but also access to emergency funding, which is a sort of an important marker as well of financial health. And he found that, again, there's certain attributes which are particularly strongly correlated with formal inclusion as well as access to emergency funding. In the case of women in particular, that includes decision-making, financial literacy, social capital. The number of, I can't remember exactly what the question was for social capital, but we have another presentation in a minute. Naomi might help me out with that if she's in the room. And mobile phone ownership, of course, is again very, in fact, more than all the other indicators, very strongly correlated, particularly with financial inclusion. Social capital, interestingly, appears to be particularly correlated with access to emergency funding. And I believe, hang on, I'm not quite sure whether this analysis was done simply for women or across the population, but we're certainly seeing a strong relationship between these attributes and financial inclusion as well as sort of a financial health proxy, which is access to emergency funding. Yes, it is. It's particularly for women. Sorry, yes, I see that now. As I say, I have not had time to prepare this presentation, so please forgive me. Now, finally, what Kiplagat does is he conducts a sort of, it's called a blinder Oaxaca decomposition analysis to understand the unexplained component that we have, that the previous variables were not able to sort of explain in terms of the gap in access to emergency funding and the gap in formal financial inclusion. So using this technique, he finds that there are some significant unexplained gender gaps, both in terms of access to emergency funding and in terms of access to a formal account. And I think the question here, this technique is often used to identify the existence of norms and sociocultural variables, which we often don't pick up in our surveys as explaining these gender gaps, or particularly with women in the workplace, for example. So this points to the fact that quite apart from, literacy, income, all these other decision-making, mobile phone ownership, all these other drivers of the gender gap, there may be some sort of bias going on in the sector. There's something else going on that we're not able to explain and quantify, which put women at a disadvantage with respect to accessing formal finance and also with respect to accessing emergency funding. And so I think that gives us some food for thought, particularly as financial providers. Where is that bias existing? I mean, what can we do about that? Because these norms, social and cultural norms, and these forms of bias are often quite subtle. So it's perhaps, but it's something that we can really, think about as a financial sector as being really important in terms of gender and financial access. So I guess, yes, Radha and I sort of slightly took issue with Kiplagat's use of pervasive gender inequalities, because actually, as we've seen across the population, there's only a 4% gender gap in formal financial inclusion. But we do see substantial variety across counties, and I think Tabitha and her team will be speaking to that tomorrow with the launch of the county report, which is quite exciting. The gender gap can be as much as 20% in some counties. So clearly it's very important to understand what is driving the gender gap, and that's why Kiplagat's analysis is important in looking at those drivers. Particularly mobile phone ownership is obviously a key driver, as is financial literacy is also an important driver of that gender gap. And in addition, I think it's very important, and Kiplagat also mentions, internet access, which I think will be an increasingly important driver of meaningful financial access as well, especially when we're getting more granular in terms of our delivery of financial solutions. So I think on top of all that, we've obviously also got Kiplagat's finding that there is this unexplained dimension which is also driving the gap between men and women in access to finance. And I think that's also, to me, very interesting, actually, and I think it does give us food for thought. So I will end there, and I will again have to beg your indulgence because I'm sure I didn't present that very well. But anyway, you can also get hold of the paper online and ask Kiplagat questions yourselves as well later. You can be in touch with him. So I'd now like to hand over Naomi. Is Naomi here? I'm not sure if Naomi is here. So hopefully we've got Sibel online, who will be joining us now to give her presentation. Otherwise, I'm going to have to give Sibel's presentation as well. Apparently there's a big storm in Florida, and she predicted that the internet power was just going to cut at this particular moment in the afternoon, looking at the weather forecast. So it's possible we don't have her online, but I don't know, team, is Sibel online? Or does she need instructions for how to join, perhaps? Naomi? Naomi, I thought was coming in person, but... okay, it's possible. Let me... Okay. Oh, okay, fine. Yeah. Okay, so you'll excuse us while we just get Sibel online. Actually, we've been seeing some of the videos that we've been seeing. One of them was actually a video done by Sibel from her work on mobile money in in Western Kenya. So she's really done a lot of very interesting work on mobile money use and social networks in Western Kenya, and particularly around gender again. I think it's better to use my computer. Sibel is an anthropologist at the... oh gosh, I better get my notes here, sorry. 1 second. Yeah. Sibel Kasimba is an associate professor of anthropology at the University of South Florida. So the book that she's written is called Reimagining Money, Kenya in the Digital Finance Revolution. And it's actually available at the bookstop at the Aya Center. So you might want to check it out. And the video that we've been seeing kind of playing in the background, one of those is actually a video based on the book that Sibel filmed while she was in Western Kenya. And she's been working closely with Naomi Wanga, who is a researcher and who specializes in research on the informal sector and SMEs. She's done some work recently, I believe, in Gikomba, and she's also done a bit of work in the past with FSD on looking at the drivers of declining financial health from a qualitative perspective. So as we get Sibel online, the topic of her... Oops, I haven't got the program with me either. But the topic of her talk is going to be on, as I said, persistent informality. Why are we seeing informal institutions like Chama's continuing to persist despite the rise in formal finance and availability of formal financial services? So that's really what Sibel will be unpacking for us now. And Sibel, I think you're online. So I'd like to hand over to you. Oh, actually, I tell you what the problem is going to be is the slides.
Oh, hello. Hi, everyone.
Hi, Sibel. Hi.
Hi. Unfortunately, you can't see me. I can try to share my screen really quickly, but it looks like I'm up as a... it looks like I don't have permission to share the screen. So, hello, Naomi. It's nice to see you. I'm glad we can both hear. Here we go. All right. Sorry.
Is it possible for Sibel to share her screen? Yeah. Okay, so Sibel, apparently you can turn on your video and then you can also share the screen. There we go. We can see the presentation now.
Oops. Hello, I'm going to start the presentation. Thank you very much for having us. This has been really a very wonderful experience. We've learned so much working together. So let me share the slides from the beginning. Here we are. So Naomi and I looked at informal groups in the FinAccess, and we also did a qualitative study. And we worked with 9 chamas in 6 counties all over Kenya during the months of June, July, August this year. So let's begin by looking at the financial landscape here in Kenya as a kind of ice-scape. So what you see here are 3 different icebergs on the surface. We've got digital finance, the largest iceberg with 29.1 million accounts. Traditional banking, the smallest but the oldest iceberg with just 6 million accounts. And then we have another iceberg, which is mutual finance, which, as Naomi and I are defining it, includes SACCOs as well as groups. The SACCOs are only about 2 million out of this 10.5, whereas the SACCOs are about 8 million and something out of this. So as you look at the surface of the FinAccess, the digital iceberg and the traditional iceberg, they're a little bit better defined in the FinAccess. We get the names of particular products, for example, when we talk about digital products such as loans, mobile money, traditional banking products. And then when we get to the mutual sphere, especially the chamas, we see there are a lot of different groups, there are a lot of people in groups, and there are a lot of different functions to groups. But nevertheless, we don't get a lot of specific information. It's all a little bit amorphous and it's somewhat mysterious too. So we need to go deeper then. And part of the reason why Naomi and I started working together is that we both had the same working hypothesis about these groups. It really seemed to us that this mutual sphere, this mutual sector where social bonds and social assets are being leveraged wasn't really distinct, but rather the mutuality of finance kind of ran through the entire iceberg when you looked underneath it. So, our mutual assets, our social bonds, social relationships, social capital, are these important across the entire ice mass? And are these groups then, the informal groups that people are forming, are these really just ways that people can come together and use digital finance as a tool, for example? Are these just really ways for people to come together and use traditional products like a bank account as a tool, for example? So maybe mutuality isn't really a separate iceberg, a separate sector, but rather does it run through the entire set of financial behaviors and the entire mix of finance on the landscape right now. So, if you really want to highlight then mutuality as an important underlying factor to finance in general, maybe we really need a paradigm shift here. Maybe we need to get away from perhaps that traditional view where finance is a set of individual decisions and behaviors. And maybe we can ask, well, maybe financial behavior is really about groups. Maybe managing your financial life is really more of a group activity. And maybe for women in particular and marginalized groups financially, maybe financial action, maybe financial capability, maybe financial agency is something that people find and access by creating financial ties, by accessing financial ties, or by severing financial ties in some cases. So maybe we need to look more at mutuality as a kind of underlying factor for finance. And that's really this perspective that we bring to these financial groups that we ended up studying, a very diverse set of groups. But you know, the kind of underlying idea that we found here that's active across all these groups is the idea of slow finance. So it's a little bit like, you know, the difference between fast fashion and slow fashion. Fast fashion is like, you know, something, you know, a t-shirt that you just buy right away because you need a t-shirt and you need it now. For example, if I need a digital loan, I need liquidity now, I'll just go to a digital lender, right? Slow finance is now a little bit different. In other words, slow finance is like slow fashion. It's like that classic shirt that you can wear for years and years and years. You love the cut, it matches everything you own, and you keep coming back to it because it's your favorite shirt. It wasn't the cheapest shirt, but it's something enduring that is going to last you for a really long time. So these informal groups then, these chamas, they take the time to build relationships. The ideal chama grows and deepens and ramifies the strength of financial assets over time that are essentially these social bonds. So people in groups, and we focused on women, although Naomi is going to bust some myths around that, but you know, a lot of the themes from the literature we still found to be at play. Social support, spiritual support is very important. Flexibility in terms of helping people meet their obligations to the group, giving people more time to repay, for example, is important. Fungible contributions is important. I cannot contribute this month, but I can cook food for the next funeral in our group. And the importance of voice, agency, social power for women is still really important. This is, for example, a group that has visited the natal home of one of its female members, and you can see they are celebrating the woman's mother, and they will be given gifts in return. So these are age-old practices around matrilineal and women's spaces of social power, and it's so interesting to see the way that they are still important in this sector. However, it is not just social bonds that are going on here. There is real finance being provisioned here to women and men who are members of groups. So you've got different kinds of financial services that people can access, sometimes from the same group. The most common being the lumpy sum that you could receive from a merry-go-round. But note also what we see in the FinAccess and what we saw in our qualitative was the growth of a more sophisticated ASCA model around giving loans, which requires a certain amount of bookkeeping and more sophisticated organization. We also see the rise of welfare and the continuing importance of welfare groups, where you don't put in a lot of money, but you're there for each other in times of emergency. And notice the rapid growth of welfare across different sectors, interestingly enough, with all of the shocks that Kenyans have been experiencing of late. A very quick case study now. This is Focused Women of Naitiri, Trans Nzoia County. These are 22 women. They are farmers. They are the wives of the teachers. Wives of teachers. The home you're looking at now is the chairlady's home. She's probably the wealthiest person in that group. Her husband is a retired Army captain, and her daughter lives in New York City and is the CEO of Enda Shoes. If you've ever heard of Enda Shoes, they're made in Kilifi and they're sold in the United States. So I got two birds with one stone there because I also was able to meet her daughter. So this group is most proud of the fact that they've been together for 11 years. They have a merry-go-round of 1,000 each month. They put in 200 each month in shares for table banking. Welfare is very important to them. They have a spiritual advisor who hears requests for aid from members in and what the spiritual advisor does is hears those requests anonymously, which preserves social bonds because it preserves the dignity and the pride of the members. And if one particular member is experiencing adversity, she doesn't necessarily need to be known to all the members of the group, which I thought was really interesting. This group really aspires to be more financial, but they just don't have the means. They received an Uwezo loan, but you know, their business plans were never really realized. They had so many household consumption needs and debts that they really just used their Uwezo loan to get their household finances, you know, back in a little bit better footing. So, you know, what do we see? That's what those are what mutuals are. Those are what chamas are. What do we see going back to that iceberg? Well, as you can see on the left, that mutual iceberg is melting. We see a decrease in the number of chamas under the FinAccess. And this question is, you know, how many people say that they are in a chama? And that number has been going down, as it has been going down for SACCOs as well. And you can see, of course, on the right hand of screen, the rise of digital banking. We're concerned about that because we don't necessarily think that this is what people want. When you ask, why are you no longer in a chama? The vast majority of people said, I don't have any money. Or some of them said, you know, I don't have access. I don't know where there is one near me. So I think there is a lot of desire to be back in chamas and to get this sector going again. Even more strikingly, to the point of the potential importance of group models, is the relationship between chama participation and financial health. Now, we don't have a true sort of econometric analysis here. We don't have causality established, but nevertheless, it is striking that you know, the people who are in a chama tend to be more financially healthy, are much more likely to be financially healthy than people who are not in a chama, and that's particularly true for women. All right, now I'm going to turn it over to Naomi, who's going to bust some myths about the demographics of chamas. Now, Naomi, just tell me to advance. I think that's the easiest way, huh? So okay, I'll advance? Yes.
Yes, please.
Okay.
Okay, great. So as mentioned by Sybil, some of the things that we're going to do some myth busting around demographics. And essentially when we think of chamas, we're thinking about these groups that our mothers, our aunties, our sisters are constantly having and meeting together and interacting, whether it's on Saturday or a Sunday, and taking over and having lunch and sharing that together. However, we are seeing that there are men involved and having chamas. So we can see that's continuously. So from 2016 up until 2021, we're seeing that composition of having men within that kind of group. Sybil, we can move on to the next one. And essentially also just to look at it in terms of what is the education level of those who are involved in chamas. So we're seeing that essentially we would think that this would be something that would be quite popular among lower income earning people with less education, but that is not necessarily the case. We're having people who have gone to university, people who have primary education, secondary education, being more involved in chamas as opposed to those that are the poorer population and those who have no education at all. And that is equally the same for when we look at the wealth quintiles, is that we're seeing it more predominantly among those who are middle and the wealthy and the elite section, as opposed to those that are more poor. So that's a kind of an interesting shift. And related to this slide is what Sybil shared, being the reasons as to why one person would not have a chama. So essentially, if you don't have money, then essentially you then would not have the chama. So Sybil, next, please. And then also one other interesting thing that we found in the data is that those that are involved in chamas tend to be essentially the bulk of them are business owners, which is quite interesting, and then closely followed by those involved in agriculture, and then those who are employed. So could it be that, what is it that would encourage people in business to then be involved in chamas? Is it that it's flexible? Could it be that it provides liquidity for them to be able to do their businesses? So we try to explore some of that in our focus group discussions, and one of the groups that we interrogate sort of helps us to understand a little bit more about this. Next, please. So related to that is also the fact that with this slide, we're seeing that there's reliance on investment in chamas. It's also quite predominant among middle wealth business women, as opposed to those that are rural food poor, and also those in the upper 20%. So it's quite similar to what we've seen with the other graph in terms of investments and who's investing in this chamas. So next, please. So one of the other things that we try to get from the Finaxis data is what are the top 3 purposes of why people save in chamas. So the biggest reason, it was a multiple response question, and one of the highest responses to this question was that they use the reason as to why they save is to purchase farm inputs or machinery for their land, which, if you do recall, that's quite similar to what we said. We had a large population of them in agriculture involved in this. And then secondly, we do have another reason as to why they're having this savings in the chama is to be able to expand their businesses, again related to what we're seeing with having business owners as being the largest percentage of those that are in chamas. And then the next reason after that was to invest in the premise for their business, which again is related to what we're seeing among business owners. Next, please. So as I mentioned, we try to answer some of these questions. We try to look for answers for some of these questions through our focus group discussions. And one of them was done in Nairobi with a group of women who are who own a salon and who have customers come in. And as women, we're aware that there are seasons that are high and days that there's more income as opposed to others. So what we did find with this group of women that were aged between 28 to 35 years is that, and commonly all of them being salon women, is that they get to contribute about 300 shillings weekly. And it is a strict system. They do have a WhatsApp group, and they have a strict system whereby the rules of the group are written on the WhatsApp page. So there's an interesting use of technology among these groups. And interestingly, when they do need a loan, it is one member gets to post it on the group, and it's a fast come, fast serve basis for the loan issuing. So that's how then they apply for the loans, and then preference is given to the person who applies for it first. And then there's also this idea of them being quite disciplined in the sense of how they, if contributions are not made by 11:59 p.m. That night, then there's a penalty incurred. So there's a very strong sense of discipline that we're seeing among such business owners around that sort of thing. So there's the use of technology in here. We're seeing this weekly contributions and use of technology, as I said, WhatsApp, and also Zoom meetings. When they're not able to meet together for one reason or the other, they're able to leverage on that technology and use that. Thanks, Sybil.
Thank you. Excellent. Thank you so much, Naomi. And so just to kind of round it and bring it home then, we shouldn't over-romanticize the mutual sphere. Social relationships are not just positive. As we know, they can also be negative. And we did collect a lot of information about adverse experiences in chama, particularly amongst the low income and food poor groups that we worked with. And I think that's really important. When we asked people what makes your chama go wrong, they said poverty. So, you know, social assets don't exist on their own. Social and economic assets always go together. People also mentioned gossiping, poor communication, and a lack of shared information or misunderstandings. And so we can see that one of the pain points with this sector is accountability, but also having the material support that is needed to be financial. Right? FinAccess interestingly enough, doesn't seem to indicate that losing money in a chama is a big problem. This may have to do, again, with the temporality of chamas as being kind of long-term. But there is definitely more work needed in terms of exploring some of these pain points around accountability. Some of the important trends in chamas that we were able to see through our qual that are also reflected in FinAccess can be summarized by the word sophistication. Chamas are becoming more sophisticated and they're connecting, as we said at the beginning of our presentation, they're connecting to digital finance, they're connecting to traditional finance in new and interesting ways. Indicators of formalization are happening across demographics. For example, the rural food poor women are the most likely, according to FinAccess, to have a constitution. And we find bank accounts, certificates of registration, and to some extent, mobile money accounts being adopted by chama groups across different segments of the Kenyan population. So a lot going on there with formalization. We also have really interesting trends in technology, as Naomi already explained. Her group had some very sophisticated use of WhatsApp. But technology even allowed this particular table banking group to meet over Google Meet. So you might ask, how can table banking, which is designed to bring cash to the table and then redistribute it in loans during a meeting, how can that happen online? Well, people basically gave the amount of money that they were returning and named the amount of money that they were requesting to be given out to them. And then this particular group, which was managed by an NGO, had an NGO manager specialist present at the group. And then she was able to do about 2 hours of math after the Google Meet and send everybody in the group a WhatsApp telling them exactly how much money to M-Pesa and exactly to which member of the group they should M-Pesa their money to. So there you go. There is table banking taking place entirely through a Google Meet, M-Pesa, and WhatsApp being assembled there in a kind of creative bricolage there. Now, this particular group also meets in person, but since they started meeting through Google Meet during the pandemic, and now they've kept it up every once in a while because they have busy schedules. So technology and NGO management are giving these groups new ways of organizing themselves. I think we have to be careful, though, not to overdo that, because according to FinAccess, we can see that cash is still by far the major contribution channel, even to these elite women with secondary who have the largest use of mobile money as a contribution channel. And elite women with secondary would certainly describe the previous group I showed where they were meeting on Google Meet. Those women were Nairobi women, all of whom were employed. So, you know, these are, you know, aspects of sophistication and innovation that, you know, take resources and take money and may not be available to everybody who is out there right now who would like to be in a chama. And we can also see that the chama members tend to be more digitized than the average population. So we can see that percentage of chama members using, say, mobile money is 92%, whereas percentage of overall people in the FinAccess in Kenya is 81%. And similarly, 31% of chama members have a pay bill. Perhaps they own a business. Perhaps they're really good at fundraising, whereas only 24% of people overall have a pay bill. So there's that tendency and that trend towards digitization as being a kind of tool of everyday life that many people who are in chamas are also getting exposed to and using. Okay. And so the final trend, I think, is really globalization, and that we can talk about in terms of this increasing sophistication. So here's our final case study then. The KNADS, Diaspora Women's SACCO. This group was founded in 2016, but it was based on a group of women who are Kenyan, who were working in the United States and Canada, who had been meeting on Facebook using Facebook video conferencing since 2011. And this is a fascinating group because their mental model for creating this SACCO was really their mother's chamas. So they came together and they did a lot of work to register their group back in Kenya with the Commissioner of Cooperatives in 2016. They had a lot of very creative, very interesting membership drives and fundraising drives. And they now have 1,600 members and about 600 million shillings in the bank at Kenya Cooperative Bank. So, you know, why did these women create a chama? Why didn't they just send money home to their relatives? Again, it's important not to romanticize the mutual sphere. Many of them felt that their relatives weren't using the money that they sent in appropriate ways. Many of them felt that they were being used by their relatives, you know, as a source of remittances, and that, you know, some of the ways they wanted to be influential in their families and in their social groups weren't really being taken seriously. So they actually created the chama to have more control over the destination and the purpose of the remittances that they are sending. And their major focus has been asset building. As women, they feel that it is difficult for them, given patrilineal and the gender norms that prevail in Kenyan societies, even in relatively well-off families. They feel that the gender norms in Kenyan society and Kenyan families, inheritance rules, and so on, make it very difficult for them to own property. So like a lot of SACCOs, their focus has been on purchasing property in Kenya. So I don't want to take too much time because I could go on about that for a long time, but let's summarize then, and you know, where are chamas heading? You know, I think providers need to understand that that life cycle of a chama is very long, and that long-term bonds are a goal that often supersedes particular financial purposes at particular times. You know, technology could be harnessed to create more accountability and to help these groups build their bonds over time. For example, a group ledger or some kind of communication protocol could give these groups the transparency that many of them want. But I think the final thing that we learned is that, you know, mutuality is not a spontaneous thing. It's not a thing that marginalized people and women just naturally have. Mutuality also takes economic investment, and these mutuals at the bottom really need support, because as we can see, they seem to be very, very important to financial health in Kenya. And otherwise, we may be headed down a road to where only elites are able to benefit from the mutuality of chamas. And I think that's it. That's for now.
Thank you very much, Sibylla and Naomi. That was a really fantastic presentation and gave us a lot of a flavor. I mean, we sometimes, with the dry statistics, we don't always get a flavor of what it's really like, what people's financial lives are really like in practice, and they're clearly very, very rich, particularly when we bring in the mutual sphere. So I would, racing on now because of time, I would like to invite Luis Trevino from AFI to give a short presentation on sex disaggregated data and its importance for our understanding of gender issues within the financial sector. Luis, over to you.
Thank you so much, Amrik. Can you see my presentation?
Yes, we can, yes.
Okay, excellent. Thank you, and thank you for the invitation to this session. Has been very, very interesting, very insightful. You know, what you have shared on the detail on the Kenya, what the FinAccess is providing, and the study on the chamas, really, really insightful. Well, I will provide, as I mentioned earlier today, I am the Senior Policy Manager on Financial Inclusion Data in the Alliance for Financial Inclusion. For those who are not aware of the Alliance for Financial Inclusion, we are a network of financial regulators and policymakers across more than 80 countries around the world. We provide a platform for enabling policies around financial inclusion, right? And well, it's really my pleasure to be here today. I will speak today about about the data collection and data usage in this important aspect of women financial inclusion. So in AFI, we have developed a theory of change, right, in terms of how the relevance of financial inclusion for enabling, financial health, for enabling, for even eradicating poverty, right? So in these regards, especially thinking on women and on women financial inclusion, this, as you're aware, this provides a reliable and efficient transfer of value, right? It enables, allows to enable a smoothing of financial flows, encouraging resilience, right? and setting and achieving long-term goals, right? And it's a catalyzer also towards additional independence. As we have seen in the last session, finance is one of the, as others, but it's an important catalyzer to enable women economic empowerment and self-decision making. That also it's part of this of these outcomes that we are looking for, right? With this. In this regards, it's relevant to measure women financial inclusion. What is happening in terms of inclusion, not only in general, but and not only on women, but having more granularity, right? And understanding the different groups that are impacted positively and also negatively with finance, right? And specifically, women are, as has been mentioned, is just is half of our population, right? So it's primary, and also is the one that drives in the majority of the households, right? It's the coessence of many of the households. So in this regards, and we have seen, there is a gap, right? But there has been a gap since we started, working on financial inclusion and measuring financial inclusion. There started to be this awareness of the gap, right? For instance, I have here some data from the Findex, the most recent of 2021 and 2014. Right now, in fact, there has been a quite positive progress, right? From especially in women, from 58% of women with an account ownership in 2014. Now, in the data from the latest Findex, it's 74%, right? Also, the gender gap has been reduced, right, from 7 percentage points in 2014 to 4 percentage points in 2021, even with the challenges that we lived on the COVID. But so this proves that there has been, a very fast increase and on financial inclusion for women, right? But still, this increase has been at a lower pace than looking at what had happened with men, right? Also, we have seen the rapid increase in the sub-Saharan Africa continent, right? From 34% of account ownerships to 55%. But not only on account ownership, especially thinking on mobile money, on digital payments. We have seen how mobile money is really important, enabler of financial inclusion, right? And not only mobile money, but also digital finance, digital payments. And but still, there is this gap. Thinking, especially thinking in the region, at the regional level, the global level, there's still an important gap that it is quite also we need to highlight that for instance in terms of mobile money, the gap it's in Africa it's lower than the gap in general account ownership. So this also indicates that there is uptake, right, in terms of mobile money, but still well that it's a signal. Of course, you know, the data that Global Findex provides, it's global, it's just provides some insights at an international level. And that's why it's very relevant, the exercise that we are discussing in this conference, the one on that developed the different authorities in Kenya with the Finances survey. Because this data provides an indication, but it's not enough for national policies, right? And in this regard, driving national policies, for driving national policy, it's important to really enable, you know, develop and collect sufficient data, right, to really understand what is happening in our countries, in the different aspects, in different groups that we want to really impact, right, with policies, and also not only from policymakers but also from the industry participants, no, stakeholders. So in the Alliance for Financial Inclusion, we have been, you know, very keen on women financial inclusion and on measuring women financial inclusion. And since, in fact, 2016, we started, there was this declaration, we call it the NRO Action Plan, where all of the members have committed to really go more, be more active in collecting data in terms of women, not only data, but also on identifying policies that can impact positively women and women financial inclusion. And we have, for instance, the toolkit that here described very briefly in terms of the different aspects that many of our members have been following to eventually collect and use relevant data to inform their policies, right? And in this regard, it's important first and foremost to identify what are the needs, right, of data, right? And in this regards, demand side surveys are a very important source because they provide an overview of what is happening, right, in the market, what is happening not only on the users of financial services, but also on the potential users and non-users, the individuals and families that are financially excluded. And it allows to identify what are the key barriers, right, and then with that, it is easier to then identify what are what data should be covered to really inform this, right? Inform these gaps and understand and identify policies to cover these gaps. The second step is on the defining the approach, right? On what kind of data, and there are different, as we have seen in this session, as shared by this panel. It's important quantitative data, but also qualitative data, right? These focus groups focusing in a specific group of the population can provide insights that sometimes is difficult to capture in with administrative data or with just a national survey. Going more in depth to understand what is behind the numbers, right? The data, it's important. So there are different approaches. So identifying what are the objectives will lead to also identify what are the approaches on the data that we need to understand what is happening in specific groups of women, right? also for collecting the data, as you know, especially when you start to focus on collecting more data from the supply side, it's important to, first of all, sensitize the different stakeholders, right? Not only the regulators and the policymakers, but also the institutions that implement, right, the financial services and that generate the data, right? The institutions that report the data. So our consultation process, especially if you identify the requirement to collect additional data from the supply side, from reporting institutions, from financial service providers, it's important to have this sensitization and also consultation in terms of challenges and in collecting and reporting the data, right? There's a need of adapting systems, and we have worked in the Alliance in developing, for instance, you know, from the experience of different members, data, financial regulatory templates, right, for reporting data and statistics. And we have identified some key statistics and data that indicators that can provide useful insights in terms of especially women financial inclusion and other groups, thinking also about youth and you know, in terms of age. So adapting the systems takes it's a process, right? For especially if we're thinking well, first of all, if we are designing a national survey like this one, the FinAccess survey, it takes time and it's a process that requires quite amount of resources, but also eventually collecting data from the supply side also requires an investment, not only from the regulators, but also from the reporting institutions. So it's important to have this consultation process and eventually adapt the systems. And we have seen in the experience of our members in this journey of enabling more useful data that it is really required to have an investment in terms of getting more systematic processes for collecting the data, right? You know, the first approach and at the beginning, policymakers collect data with, especially financial inclusion data that is not, that you know, in many jurisdictions is not under a direct mandate of, for instance, of a central bank to collect data on customers. It's mandatory to collect data on the health of the financial institutions, but not on the customers. So it takes time to adapt the systems, right? To require the additional data more in terms of what is happening with the users of the financial services. But the investment in getting more automated, you know, data collection systems, it's worth doing because it enables, it lowers in the long term lowers the cost of collecting this data, and also it provides more insightful data not only for regulators but also for the industry, from the financial service providers, right? And we have seen also in the case of Kenya that, for instance, the central bank, we know that they have invested in enabling the electronic data warehouses, right, to collect more systematic data with more granularity and enable more insights, right? Then you know, obviously this has a process of ensuring the quality of the data, right? It's essential to have to enable data that is timely, that is complete, that is reliable, and that is relevant, right? So we have ensured from the beginning that it's relevant because we have gone through the needs and the data needs and the objectives we have. But it's important that when we start the process of collecting this data, it's data that will be useful, right? The analysis and the usefulness also implies a process, but and at the end it will allow to inform the policies, and also it will inform the industry, right? When there are gaps. For instance, in terms of I mentioned about demand side data from like the ones from the surveys, the national surveys, and also focus groups, but supply side data and the importance of supply side data, it's the fact that it provides, it focuses on the actual users of financial services, right? The demand side data provides us with a vision of where are the gaps in the whole market, right? In the whole ecosystem, where the individuals, the groups that are are excluded, the barriers. But the supply side data provides how is the behavior in terms of the users of these financial services, the ones that are now included, or that we argue that we see that are included. The supply side data can allow us to understand how deep they are included, right? And then that's the reason to really go more in depth in the data collection, right? Because it allows us to understand, especially thinking on men and women, what are the trends? What are if there are some seasonality in the behavior of using loans, in the behavior of savings, to understand how deep are this, for instance, the balances in terms of savings, if there's a difference between men and women saving, right? The attrition, right, of the customers, what's the duration of, if a customer is a long-term customer or it's just an occasional customer, right? So this is the
Lewis,
hi. Supply side data.
Lewis,
yes.
Thank you so much. This is very, very interesting presentation on the data. Our issue is that we may not have time for the panel discussion, and we probably just haven't quite left enough time for this presentation. So I'm wondering if you can conclude, and we will, of course, circulate the presentation to everybody so that they can read it later.
Yes, of course. Thank you. Yes, of course. So just 2 slides more. That in this one, I provide the overview of the data cycle, right? Starting with especially in terms of segregated data with demand side data, going more in depth into details on the users of financial services with supply side data, right? Adapting the systems and having a consultative approach, and also collecting the data relative to, for instance, the gender diversity at the financial institutions, at financial service providers, to understand also the social composition inside the institutions, right? Because that also can provide, can be a trigger of eventually enabling more equality, right, in terms of generating new financial products, targeting women, etc. Yeah. So finally, I want just to mention two case studies on the usefulness of use of data. Rwanda has been very active on collecting this data, right? They have developed their electronic data warehouse. Recently, they developed a data science team to focus on the big data that they now collect from this electronic data warehouse, but they were not analyzing in all of the potential that can be. And now they are about to they are developing some dashboards and reports on that, right? On how are on key insights of gender and women financial inclusion. In the case of Mexico, they also have been focusing for many years in enabling more and in collecting more segregated data, and with the data that they have collected, especially on loans, and enabling even adapting and having more insights in terms of credit risk and risk management. They have been even able to develop policies like lowering the capital requirements for woman-owned loans, right? Because there's further evidence that the majority of the woman loans have lower risk than compared to men, right? So these are some of the examples, and well, I will be happy to discuss later. So thank you so much.
Lewis, thank you so much. Actually, at some point, I'd love to hear more about those case studies because they sound particularly interesting from Mexico and Rwanda in terms of how those countries have really grappled with this sex disaggregated data. So we could maybe pick that conversation up at some other point. But thank you so much for that very important presentation, because clearly data is not just about FinAccess. I mean, Lewis was really bringing across the sort of whole range of data collection tools that we should be leveraging to create strong frameworks for gender analysis. Now, I'd like to invite Tamara Cook, our CEO, FSD CEO, to come and moderate the next panel, the next and final panel for today, which is the panel to discuss these presentations on gender. Please could Radha and Rosemary and Mr. Mwangi also please come to the stage.
Thank you, Amrik. We have the honor of being the last panel, the only one standing between you and the cocktail Lukanya announced, which might be the only reason we still have people in the room. I do hope we still have people online who are following us. And just a shout out to those who are online, we really are seeing your questions and loving them. First question for this panel is going to come from the online group, so please do be sending those in. Great. So we'll get right to it since it's we're running a little bit behind schedule. I'm joined by three fantastic panelists today, and I'll introduce them as I ask each of their first questions. So Mwangi, who is the CEO of Kenya Women Finance Trust Microfinance Bank and has been there for more than 20 years, really serving women. I'd love to start with you. And so KWFT has been a major driver of financial inclusion for women, including your leadership in joining the United Nations Global Compact, and I hope a lot of you saw our annual lecture from the CEO of that last week, as well as signing into the Women Empowerment Principles. So given your deep outreach into peri-urban and rural areas, what do you see as the key barriers for women and the women's market?
Thank you very much. And first of all, I'm very honored to have been invited to this forum. And I've been participating alongside other very able Kenyans in making sure that the issue relating to women financial inclusion is put on the table. And I work for an organization called Kenya Women Microfinance Bank, which purely focuses on women issues. And women empowerment from an economic angle is very, very key. Just before I go to the barriers, I would like to say that women financial inclusion has been very trivialized in this country. It all boils down to giving women services. And I think that's what we are talking about here today. But the issues are wider than services, because women need to be included in decision making. Because we all assume women don't know what they want. We assume we know what they want, and they have no role and they have no voice in what is going on. So as an institution, we operate mainly in the rural area because we believe that women who are excluded from the financial sector, mainly, a majority of them are based in the rural area. So 80% of our operations are in the rural area. We are in 45 of the 47 counties, and we work with about 800,000 women households. And we do not discriminate men, but we use the woman as the entry point to the family. And when you think about financial inclusion, and then more so because we have subscribed to Global Compact and Women Empowerment Principle, we believe that women should be given a voice, not only in being served, but in owning the institutions that serve them. And so for us, 75% of the company is locally owned, and 67% of that locally owned portion is owned by women. That's where we start women financial inclusion. We don't start it at service. And out of our 3,000 employees, 55% are women. And out of our management, 60% of our managers are women. So now at that point you start talking. 2/3 of our board members are women. The top leadership of the board is a woman. So it's an issue of dealing with women issues in a holistic way, not in tokenism, not saying we want to come up with programs, we want to have initiatives that are able to address women issues. So it is an issue of focusing on women empowerment, but from an economic point. Because a woman who is economically empowered is empowered. Is empowered, she can make decisions, she can show the direction, she can be able to participate at the family level, at an economic level, and at a community level. So for us, we have subscribed to the Global Compact, and we are members, and we have taken the 10 principles and incorporated them in the way the institution is being run, even in the policy level. And we are also subscribed to the 7 women empowerment principle, and we report regularly to the UN based on it. Not because we must, but because we want to benchmark with the rest of the world. So what are the barriers towards women financial inclusion? I'm a practitioner, and I am on the ground, and I talk to women, and we are on the ground on a daily basis. One of the biggest barriers is financial literacy. And the issue of financial literacy needs to be addressed on a daily basis, because women who are not financially literate, it's not the issue of interest rate, but even understanding how to manage their business, differentiate between profit and turnover is very key. The other issue is general literacy, especially when you are working out in the rural areas, you are out there, you find the general literacy of women is a little bit more lower than men. Then there are inherent cultural biases that have been there since time immemorial, where women are deliberately excluded. You see, when we talk about women inclusion, we also should talk about deliberate excluding women. And I keep saying, any good institution should do what is naturally correct. That is, include women. Whether you are a corporate, whether you are in public service, women should not be given 1/3 of the position. They should be given 50% of the positions. That tokenism, the tokenism that we have been going through, it is not only in the financial sector is where we find it. In fact, I keep saying that deliberately the men use tokenism to oppress women. And I keep saying that in the rural area, to oppress women, you use the 3 Ps. The 3 Ps are, she's permanently pregnant, poor, and powerless. Those are the 3 Ps that I use. And so, if we can address poverty issues and provide economic and support to women, then they are able to judge the level of the family they need to have, and they will have a voice. I think that's what we do, and I would say the access to products, cost of serving women in the rural area, those are other barriers. These are barriers that as an institution and as a country, we can be able to overcome. But we have to make deliberate decisions as a country and as a sector to actually put women at the forefront of decision-making and financial inclusion. Otherwise, that's what we do for a living, and I have done that for over 26 years, and I have no apology for it. Thank you.
Thank you for your leadership in that area. I don't think any of us are going to forget those 3 Ps, which are different, perhaps, than the 3 Ps we're used to. Let's move to you next, Rosemary. Rosemary is the head of social statistics at the Kenya National Bureau of Statistics, and has also been working for more than 20 years in the statistics area. We've just heard a really interesting presentation on sex disaggregated data. And so my question for you is, how could better sex disaggregated data, gender-aware data, at the macroeconomic statistic of macroeconomic statistics contribute to our understanding of women's economic empowerment? And specifically, which macroeconomic statistics would be most illuminating, especially for policymakers?
Good afternoon. I want to say that I've appreciated to be in this panel this afternoon, and to be part of those that are giving enlightenment on the issue of women economic empowerment. Given my background of providing statistics official statistics that are used by the government to plan for development. All of us know that our population is half women and half men. But then, when we look at statistics, we realize that the contribution of women is less, not because they contribute less, but maybe because we don't measure properly what they contribute. So I want to say that I appreciate for being here, and I also want to appreciate the fact that the FinAccess survey has provided for the first time information on financial inclusion from national to county level for the first time. And therefore we appreciate this particular direction that we are taking as a country. On my part, I want to say that we have demand-side data, some adequate data on financial inclusion and on economic empowerment for women. But then, the area that we are lacking in this country is the macroeconomic indicators, and mainly the supply side. That is, the sectors or the players that are providing financial services, we do not have information. For example, the kind of data that we would be happy to have as KNBS and as a country would be in the area of, for example, gross domestic product. Is it possible to disaggregate it by male, female, or women, men, so that we know, since our population is nearly half men and half women, what is the contribution of men and women in terms of the size of our economy? In terms of interest rates, we know that there are products that women access from the informal financial service providers, and those that are accessed in the formal. But a lot of times, the one that is accessed from the informal have higher interest rates. It's a gender issue. The other information that we do not have is about loans. Can we be able to disaggregate the kind of loans that are provided by the banking sector by sex? The other one is the non-performing loans, or the ones that are overdue. Is it mainly the women that have got overdue loans, or the non-performing loans, or it is mostly the men by age group? Leadership and ownership of the micro and small enterprises. And yes, what sort of leadership do we have? Do we have women making decisions? Do we have women owning, or men? And then, of course, like the savings and the deposits, what is the proportion of those savings and deposits in terms of men and women? It's a gender issue. In terms of employment and earnings, it's a macroeconomic kind of statistics. And that is information that we do not have in full. That could give us some direction in terms of supply side data for planning, for economic empowerment, for both men and women. Thank you.
Thank you, Rosemary. And yesterday afternoon, those of you who were here, you heard the regulators, some of the regulators talking about the potential of sex disaggregated data on the supply side. So I hope that that conversation can be connected with this ask, and we can see more supply side sex disaggregated data coming. Radha, let's move to you. And Radha is a research fellow at the Institute of Development Studies at the University of Nairobi, and also serves on the Program Investment Committee for FSD Kenya, for full disclosure, and has done an excellent job on that. Her term is coming to an end soon, sadly. So we've seen that there's quite some variation in the gap in inclusion between men and women across counties, especially in Kiplangat's presentation. So I'd love to hear from you what you think might be driving some of those variations based on the research we saw today and research you've done on your own. For those of you not familiar with Radha's research, she's done quite a bit on banking regulation, banking sector, digital credit, and regulation. Radha.
Thank you very much. Thank you to the Central Bank of Kenya and KNBS and FSD Kenya for inviting me today. It's actually really nice to be on this panel. I feel like I'm connected to each of the presentations. My first work in Kenya after I finished my PhD was actually doing a study funded by AFI for the Central Bank of Kenya on data gaps. And actually, at that time, that made a very strong case for sex disaggregated data. So it was kind of nice to see that. And you know, Kiplagat is a good friend, and then Siba Kusimba has actually given a lecture in my class, and Naomi is one of my students. So it's really nice to be on this panel. I think for me, one of the most surprising things on this panel on the first Kiplagat's paper is actually some of the dark green areas. So I think we should actually celebrate that. And even if you link that to the AFI presentation, Kenya's financial gap is much lower than Africa-wide. And so the gender gaps, actually, we have made good progress. So whilst we should focus on the barriers, I think we should actually also kind of celebrate some of these dark green areas. I must say I found some of them quite surprising. I think especially some of the counties like Mandera. I actually think I'd just be conjecturing to say why those counties are higher than other counties. I think this does call for some sort of, again, a deeper dive into more qualitative. I think the really interesting things were two things: that the gap in literacy is higher than the overall gap in financial inclusion. So as Mr. Mwangi said, I think that's something we really need to focus on. But what was even more interesting is that the gap in decision-making, women's decision-making, was even higher than the gap in financial literacy. So it kind of means that even financially literate women are less involved in the main financial decisions in the house. So I think all these kind of combine to give an answer to partly why this gender gap has gone down but is still there.
Great, thanks. And as you've referred to one of the papers, I'd love to hear from the other two panelists. Were there any surprises as you were listening to the presentations today? Maybe we'll start with you, Mwangi. Anything you saw that you were thinking, that wasn't what I was expecting, based on your information?
Thank you very much. I think what was presented, told the story the way it is. In fact, what I had never conceptualized is rapidly moving in that direction that it is the issue of chamas. Because we use chamas because women do not have access to securities, that's collateral. So what we use is, as an institution, we use social collateral, where they guarantee each other and they stand out for each other. And because we serve not totally the bottom of the pyramid, but the near bottom of the pyramid, the shift that chamas are getting more effective in the middle level, that worries me a little bit, because it means there is a major shift. And the decreasing popularity of chamas in itself tells us that either the market is shifting, people are getting more individualistic. So then it means then as we finance women in future, then we may have to start thinking about them collateralizing their own credit rather than using the chama approach. So that sharing was very incentive, and it tells us a story about where as an institution we need to be going. But that also puts questions whether are women now accessing more security? Do they own RAD? Can they be able to go to the bank and give collateral? Or are we still having the biases where women have no access to securities that can be used to borrow capital from the banking sector? So those are issues that still need to be dealt with. But that shift is a little bit worrying, and we need to think exactly what is causing it. Yeah.
Thanks. Rosemary, any surprises or anything that you wanted to highlight from the presentations today?
Just something small. I was surprised to see that the membership that is involved in chamas are more, they are using mobile money accounts more than the average population. And they are also, I realized that we also have very learned people that are in chamas. At first, I thought it is maybe the average, maybe the primary school or those who have not gone to school who are in chamas. I was surprised to find a very high proportion of those that have got tertiary education. Thank you.
Back to you, Radha.
I think what would be useful to see here is not just to focus on the recent drop in CHAMA use, because when I look at the FinAccess data, 2013 it had dropped dramatically, use of savings groups, and everyone's like, oh gosh, this means formal finance is replacing informal finance. Then 2016 it jumped again, then 2019 it dropped, and now I think it's dropped. So I think the linkage to the economic and the broader, you know, the demand and just the kind of the multiple shocks we've experienced in the last 5 years, I think explains a lot more about the drop in savings groups rather than the kind of people becoming less mutual. Yeah, so just to add to that.
One of the things that we've always made a point about when we're looking at the FinAccess data is, you know, there's, for those of you familiar with the access strands, there's the informal only, which is actually a very small percentage of people who only use informal finance. What's interesting is how many people use informal finance and formal finance. And so what is the value they're getting from both? And why do they continue to choose to use both? And I always ask formal financial sector providers, what can we learn from the informal finance solutions that are out there? Radha, let's stay with you on this chamas. In Sybil's presentation, she was looking at, or actually I think it was Naomi, she was showing that those in chamas are more likely to be financially healthy than those not. And so I'd love to hear any reflections on that finding, and again, not to speculate, but what could be some of those drivers?
So I think I'd like to link that to your other question about how formal and informal have been intertwined. I think some of this work actually reflects on like other work that FSD has done, like Susan Johnson's work on the Rift Revealed, is the issues they mentioned as well about negotiability. And I think if there's one thing that formal financial providers can learn from informal finance is trying, and especially some of my recent work on digital credit has shown, is what people want is this negotiability. And I think it's almost not surprising that people who are in chamas are more financially healthy, because that's just one way that people then feel less left out, because the financial health questions in the FinAccess are like, you know, linked to that. Like, and I think one of the other really interesting things that came out of the chamas, particularly the data on that paper on this more formalization, was this really interesting concept of like asking people their needs whilst preserving their dignity. And I think that's so important, because I think that's one of the reasons why you know, digital credit has been so problematic in the last 5 years, is people almost use the digital credit thinking it's anonymous and then realize it's not preserving their dignity. So I think my 2 takeaways from that is negotiability is part of the reason that people still really want to use chamas, and you know, trying to ensure that when we're providing this finance, it does preserve dignity.
That's great. Mwangi, let's come to you now. Earlier this morning, we were looking at an interesting index, and one of the questions that was looked at was, are financial services meeting people's goals, meeting people's the purpose or needs that they have? As we think about finance, nobody really wakes up thinking, I'd really like a loan. It's about, what do I want to do with that money? And so as we think about many different ways of life, but the Sustainable Development Goals are potentially one way of thinking about what are the needs that people are trying to achieve with financial services. So I'd love to hear how Kenya Women has really thought about the Sustainable Development Goals and really sought to help your customers meet and progress in those areas?
Thank you very much. As an institution, what we do is we are driven by a strategic focus, and our direction is mainly we look at the triple bottom line approach. That is, we look at social impact, that is people, we look at planet, that is environment, and we look at profit or incomes. So what then we do is that for all our services and products that we generate, we try to address the people first. So we ask ourselves, as an institution, a financial institution, are we being a good corporate citizen? And because we are looking into the whole area of financial sustainability, sustainable financing, can we be able to finance our customers in a way that we leave a positive impact in their lives, so that we are not only using the customer to make profit, but we are also leaving them empowered and improved. So social impact becomes one of the key things. And under social impact, then we are able to address the strategic development goals number 1, 6 to 6, and 11, 16, and 17. And deliberately, we look at that. And that in itself is put in our policies and our procedures, so that everybody who joins the institution knows that. So if you come up with a product, then it should be able to address social impact. And we look at it, and we are able to report on it. Then we also look at the environment. What are we doing to the environment? Are we coming up with products and services that are harmful to the environment? Are our customers destroying the environment? If they are destroying the environment, what do we need to do? If we look at the issue of cooking, because women are generally the ones in the kitchen, how do they cook? Can we do it in a way that they do not cut trees? Can we bring in the issues of biogas? Can we bring the issues of renewable energy? Can we bring it in a way that they are more or less destructive? Because women will cook anyway, but then can they do it in a way that is less destructive to the environment, both in the household, where we are dealing with internal air pollution, and externally, where we are destroying the environment? So we look at it and come up with a product that can be able to address, and that we are able to address about 4 strategic sustainable development goals based on it. Then we look at now profit. When we talk, our mission is to partner with women in creation of wealth. But whose wealth are we talking about? On one side, their wealth. On the other side, the institution has to make income. But you must look at then how are you leaving these customers? Are they improving their lives? And you develop products that can be able to address. And in that, we are able to deal with the 17 SDGs. And even as we report to the UN and report to our board, and we also are accountable to our customers, then we are able to deal with the issues that not only are profit-making for a financial institution, but you become you are engaged to become a good corporate citizen, and at the same time you are pursuing the sustainable financing. And for 2 years in a row, we have been voted as the #1 in sustainable financing within the banking sector, and it tells us that that's the direction to go. So, for example, we provide capital for business, we deal with agriculture, but agriculture mainly for food security. We look at water and sanitation, avoid women traveling long distances looking for water, because that's what the work women do, so that they can be released to do business. Don't ask me where men are when women are looking for water. That's a discussion for another day. Deal with renewable energy, cooking, writing. At the same time, deal with rural housing, because rural housing is a key issue that is destroying this country. And then in the end of the day, when you do all this, then you are able to curb the rural-urban migration, because people migrate from the rural area to the urban areas looking for opportunities that are not there anyway. So that's how we deal with the SDGs. Yeah.
Great, thanks. Rosemary, let's come to you. I'd like to do a bit of a public service announcement. Rosemary has been involved with some very interesting research that's been released, including the Women and Men Facts and Figures 2022. Really interesting data in there, and also a time use survey on the amount of time spent on different forms of paid and unpaid work. So as you think about these two resources that you've been involved in, what do you think the gender division of labor and women's economic empowerment is contributing to the gender gap in financial inclusion?
Thank you very much. So recently, we released a Women and Men booklet, which provides information on the facts and figures about the situation of men and women in our country, that ranges from population, that is demographics, to education, to financial use, financial access and use, and even poverty. So this booklet is giving highlights on the situation of men and women. And in this context, I would point out one of the statistics about participation of men and women in economic activity, that is labor. So one of the statistics there is showing that the proportion of women that are involved in paid employment is lower than the proportion of men. And then for paid apprentice and paid volunteer, the proportion of men is high. So the implication for women economic empowerment and inclusion is that if more men are in paid employment than women, if a higher proportion of men are in the paid volunteer and paid apprentice, and then the converse is true for the women, then it means the women are not getting remunerated, and therefore they may not even find their money in the bank. So they are not financially included because in their participation within the labor force, they are not in paid employment. And then you find that the women are contributing family workers, or they are doing certain things that maybe even they are paid in kind. So it disadvantages them in terms of being financially included. So that is one of the findings that we saw in the Women and Men. The other statistic that we published in the Women and Men was about the priority of any, whenever the woman has money, what is their priority, the priority need. And I think that was from the FinAccess. And we realized that the first thing that a woman would want to do is to put food on the table. But the priority for the man is to buy land, to expand their business, and to educate themselves. Now, that one is a gender issue, and it means that over time, the woman is disadvantaged. So within that Women and Men booklet, which looks like this, there are very interesting statistics that shows the divide and the differentials for various dimensions of development between men and women in our country. And it is in our website. You can check to see the details. Then there is this time use survey that was done in 2020. And the main reason why it was done was to be able to quantify the amount of time that men and women are using for unpaid care work. Now, when there is unpaid care work or any work, it means that we do not quantify the value. And therefore, the country is not able to estimate the value of how you are spending your time. So the reason for this time use survey that was done was to be able to quantify properly the time that is used for paid and unpaid work. And in that manner, then we are able to properly quantify the invisible, actually the unpaid work is not visible in the economy. And therefore, when we are measuring our GDP, we are not able to measure properly. And now bringing in financial inclusion. If something is not measured, if something is invisible, then you are not even able to put value to it, and you are not able to quantify, you are not able to bank it, whether in the formal or in the informal financial institutions. So it's a very important study. The results are not yet out, but before the end of the year, these results will be published. So that is the much I can say about the time use and the Women and Men booklet. Thank you.
Thank you, and I'm sure we all look forward to going through this little booklet and also seeing the Time Use survey when it's out. So let's turn to some questions. I understand, I don't know if we've got any online. Jackton, do we have any questions available online? Nope, nobody's listening anymore. They weren't promised the cocktail, right? Great. Do we have any questions in the audience, either for the panelists or for the on the presentations? Yes, there's one there. If we could get a mic right here. And please say your name and institution or university.
My name is McKenna from UN. And mine is to Mr. Mwangi. I mean, we've seen right from the beginning that women really don't own land much as the men counterparts. And they are the ones, especially in the rural areas where it's your focus area, where they are the ones who actually plow the land, they work, but the land is owned by the men. Therefore, again, they may not really have a say on the proceeds that come out from the sale of the produce. I don't know what have you done so far to enable women to own land so that they're empowered and therefore, they have a bigger voice, as you've said, moved out of the 3 Ps you mentioned. Thank you.
Thank you very much for that question. And first of all, the picture of women disempowerment is a national issue. It's not just at the family level. It's bigger than that. It starts from the political angle, where we don't vote for women. You go to parliament, we can only have 1/3 gender maneno. We don't talk about 50%. So this whole thing is all over. And by the time you get to the family level, it only accelerates itself. And I know a lot has been done by government to say even our daughters can be able to inherit land from their fathers. But you see, cultural issues are there and they are very oppressive. So what do we do as an institution? What we do is that, because we have been doing this business, Kenya Women has been there for 40 years. What we argue women is that you cannot be empowered unless you are able to be economically independent. That's the issue. And we are talking about women in the rural area, we are talking about women in the cities, where women should, even when you buy a property, put it in your name too. I don't know who said that two shall become one and the one is the man. That has to be overcome. And we can talk about the rural women, but even professional women repeat the same mistakes over and over again. So what we do is we educate women, we give them input, we do not remove them and try to pit them against their husband, but we teach them that you should be able to deal with your financial issues independently. And we talked about mobile phones today. We said that women need access to mobile phone. When we introduced mobile banking and people accessing their account through the mobile phone, we discovered that the phone belonged to the family and the family was the man. So the first thing we did is to start financing mobile phones for women so that they can have independence of their bank account. Those are issues that are continuous. We take women through 8 weeks training. We give them financial training. We meet them on a monthly basis. Women also teach each other. And that's why the groups, the shamas are important. I wanted to say something about the shamas. Women shamas and men shamas are totally different. I'm a man. Men shamas mainly rotate around financial issues. Women shamas rotate around social issues. Finance is only one of the small things they deal with. There is a lot of training, there's a lot of information that is passed between one age group and the other age group. And within those chamas, you pass knowledge and skill, and you give women an opportunity to know they can also own land, and they can be registered in their name without removing them from the family setup. Because again, if you go the other extreme, then you have introduced the crisis. That's what we do.
Thank you. I'm going to have one last question for the panelists. I'm going to give you a chance to think about it. Radha, I'll come to you too. If you had one piece of policy advice related to the gender gap, what would it be? And at the beginning of this conference, we heard about how we're talking about the nexus between research, industry, and policy, right? And that's why we're here together and why we're digging deeply into these issues. But not that question yet. Radha, what did you want to say? And if there's any other questions, please let the person with the microphone know.
I actually had a question for Professor Kusimba. Whilst I really like this concept of slow finance, and I think there's some other work that's been done to show like when credit can be useful, I found this analogy with fashion not appropriate, because fast fashion is cheap fashion. But digital credit and fast finance is not cheap finance. So I think we need to be careful when we make analogies like that, because, I mean, FSD's own study, when you see the APRs on digital credit, they are not cheap. So I think we need to avoid that analogy because it automatically assumes that fast finance is cheap finance.
Thanks. Let's get that question, and then I don't know if Sybil's still online. If she wants to respond, we can come to that. But question first, please. Thank you.
Yes, this is Adan Shibia from Kipra. First, I wish to thank the panelists for the very insightful discussions. I just have one question for Mr. Mwangi. I think at the beginning he highlighted three challenges facing women: issues of financial literacy, general literacy levels, and cultural biases. Perhaps issues of financial literacy and general literacy, in my view, could be a bit easier to address. Now coming to cultural barriers or cultural biases, I wanted to hear what will be your advice in terms of how policymakers should approach this issue of cultural barriers, perhaps highlighting from the experience of the Kenya Women Finance Microfinance Bank, how do you approach it? Then thinking more broadly, what will be a suggestion in terms of how we should think from policy point of view?
Thank you very much. I think, the country has genuinely to make decisions that this 52% of the population need to be put in decision making. That we have to decide as a country. Because, and I like what Obama said, he said, in a team that goes for a football match with 50% of its players, we'll just lose. Women, we take girls to school, we educate them, but we discriminate them, even when it comes to the workplace. And the discrimination is not very loud, it's not in paper, it's not in policies, but it is ingrained in the way we do business, even in the workplace. So the first thing to do is that we should remember that women are homemakers. They are the ones who give life. Actually, all of us are born through that process. And in itself, every time a woman goes on maternity leave for 3 months and another 6 months, but remembering that a woman is doing much more, even at the home level, by the time you get to the workplace, she should be given more space and be given an opportunity to move up. And those are deliberate things that have to be done. When we think as a country, those cultural biases are at the family level. We started at the family level. When you have a small child, even we, the professionals and the educated people, when you go to buy a doll, what do you buy for your daughter? You buy a doll, you buy a baby, a small baby doll. Then for your son, you buy a car. What are you saying? You are saying to the girl, your work is to give birth. You guy, your work is to be the macho guy who owns assets. So we've started it early. This stereotyping are at the family level. We are the ones who do it on a daily basis. And it's not just about Kasha. Kasha is dynamic. We can keep changing it. But we need to deliberately put this girl to an equal position as the boy. So we need to remove it at the workplace, we need to remove it at the community level, and we also need to remove it at the end, the financial sector, because I can tell you that these are challenges that even women who look for loans, even in the banks, the first thing she is asked is security. The second thing she is asked for the husband to be a guarantor. These are things that are done, and it's a continuous process. Things are not the way they were in the 80s, neither in the 60s, but we need to deliberately keep making policies and laws that are able to guide us in that direction.
Thank you. Sybil, if you're still online, did you want to comment on Radha's question?
Yes, thank you. And thank you, Daktari. I think that's a really excellent point. And I think you're right. I probably misspoke when we say fast fashion, it may appear to us as a consumer to be a cheap option. But in fact, fast fashion is very expensive, and our world is paying the price for the way fast fashion is produced and distributed. So I think that, in that sense, the analogy could work, but I think you're very right. Fast is not cheap, right? And so that brings even more to the fore the value of something that is slow. So thank you so much. For that correction. I think you're quite right.
Thanks, Sybil, and it's nice we got to see you. We didn't see you earlier. Great, so let's go to the final question. So for each of the panelists, if you could provide one piece of policy advice on closing this gender gap, what would it be? Rosemary?
As a representative of KNBS and provider for official statistics, the first policy recommendation I would make is to provide adequate financing for gender disaggregated data from both the supply side and the demand side, so that the policymaker has in their hands information to be able to plan well and to clearly be able to see the direction where we are going. So it is information, it is statistics.
Can I get an amen? No?
Thank you. I think for me, your guess is as good as mine, that I would like women to be included in the decision-making table. We can't continue doing what we are doing. I keep saying, it takes effort to do the wrong thing. So it doesn't take effort to do the correct thing. The correct thing is include women in decision-making at the household level, in decision-making in public sector, and in decision-making at private sector level. And we should avoid tokenism. We should avoid situations that we are saying we are doing it because it's good to do. The other thing I would say is that women need to claim their space. There's nothing that is given for free. You've got to fight for it. Go for it, women. Fight for it.
Thank you. Radha?
I'll make my recommendation very specific, and it's actually to financial institutions. And this is both from an observation of data of the amount of money now going to the Unclaimed Financial Benefits Authority, and also very personal experience recently from a death in the family. Instead of doing CSR, banks, can you ensure, and financial institutions, can you ensure that every account either is a joint account or has a very clearly nominated next of kin? I just don't get it, how these millions are going to the Unclaimed Financial Benefits Authority. Make sure you provide your clients the ability to make a will, as just a service. I think that would benefit Kenya and the gender gap much, much more than any tree planting CSR that's often done by banks. Thank you.
Great. Those are some great policy recommendations. And even if there aren't as many policymakers in the room right now, there's going to be a lot of them here in the morning. So we'll make sure that those are heard loud and clear. Can you please join me in thanking this fantastic panel and the presenters earlier? And Lukanya, I think back to you to wrap us up. Thank you.
All right, it's time for the cocktail. Yeah, thank you so much. It's very eye-opening. It's a process, but we know we have data has a place for it. And also Mr. Mwangi has brought in so many other aspects that we need to think about. Yeah, so tomorrow is going to be our final day, and it's going to be exciting, I know. It's when we'll get to launch the county report. And happy to see many county representatives here. We'll meet again tomorrow, where we'll get to the county report launch. It's the last thing you're doing. That's why words are just getting out of my head. Just to mention, tomorrow the guest will be the CS, the National Treasury, Professor Njuguna Ndungu. And then we'll also have the CEOs of all the partners here. That can be CBK, and of course Tamara is here. And then we'll have Dr. Habil Olaka. And we didn't have Kip present, but Dr. Olaka will speak a bit about the KBA. And then we'll also have the CEO, County of Governors, Miss Mary Mwiti. And then the first thing we'll do is award the university students, the winnings researcher, where we'll have Professor Tavneet Suri being part of it. And just want to thank everybody who's here. The university is represented, and I'm sure I'll see you all there, at least the ones who are here. And just to say that the numbers have been great the whole week. I think we're about 1,000 since we started on Tuesday. But now, I think right now, guys watching are maybe 40, and I understand why. Yeah, but generally, I think we've been having a good turnout here virtually. But being our first kind of event, we're learning a lot on how to make it more effective, whether it's virtual or here. But we will take on the lessons forward. Yeah, I think that's it. Unless there's anything else to be announced. Yeah, as Kemo comes here, the cocktail will be where we had lunch, and will be directed.
I wanted to announce that tomorrow we shall have breakfast served from 7:30 to 8:30. So come early. We'll have a good breakfast. Number two, because we expect high-level dignitaries, all of us are expected to be seated by 8:45. From 9, we may have some issues to get in, so we come early tomorrow. Thank you so much. See you tomorrow.
All right. Thank you, Kemo, my co-colleague from CBK on FinAccess. So let's clap for everybody. We'll see you tomorrow morning. And the ones here for the cocktail. Drink and music is there. Thank you.